better person to start the show with than my partner, the queen of macro, Kathy Lean, who is the FX whiz. I have been partners with her for more years than both of us can count. And I will tell you that there's nobody better prepared to follow major currencies, to understand where the major currency markets are going than Kathy, who literally trades them every single day, knows every single piece of news, every tick and every pair, and is so wired into this market that it's just astounding to me whenever I watch her. She's obviously had tremendous success with our BK traders trading every single day. And today, she's going to take some of her longer term ideas and share with you exactly where she thinks the big trends are going. I will say one thing that I think she's probably going to agree with me with, that as we enter this 2024 year of great uncertainty, lots of geopolitical risk, lots of uncertainty about where the economy goes and where central bank direction goes, I think she will agree with me that volatility is definitely going to be the one unifying theme. And volatility, of course, means great trading opportunities. So she's going to share some of those with you. So without much ado, because she's got so much to do, she's always comes way more prepared than I am, and she has so much to share with you. I'm going to give the mic to her, say hi, Kay, and I'm going to give you the presentation skills. Everybody, feel free to type questions. We have somebody who is monitoring the questions all the time. We'll answer everything. The basic question: is this webinar recorded, and will you be able to get access to the recordings? Are yes and yes. They'll be posted eventually in a couple of days after we're able to process the videos. But don't worry, if you signed up and you're here, definitely you're going to get a recording. One thing I want to say to everybody: this is a really, really cool show. I've never done this before, and I think this is something you guys are going to love. We are giving away prizes at this show every single speaker. So one of the things we're going to give away today is Kathy's currency trading book. We're going to have a raffle at the end of the show, and everybody at the show gets my free one-click trading tool. Some of you have already received the link to it, and I will post the link at the end of the show. So do not worry. Everybody gets everything that I promised you, plus an incredibly lucrative offer that I'm going to share with you just a little bit. But without much ado, I'm going to turn the mic over to Kathy and let her take over the show.
Hi everyone. Boris, I need to grab the screen.
Yep, I'm gonna give you the screen right now.
Hello everyone. I am delighted to be able to join. Just give me 1 second to share my screen. I want to make sure that. Okay, can you confirm to me that you can see my screen and everything is coming through? Okay.
Absolutely see your screen. I'm going to let them look at your wonderful face and get off myself. Feel free to ask me any questions, guys, because I'm hanging out with you guys, and I will turn over my mic and the show to Kathy now.
Okay, wonderful. So once again, welcome everyone to our 2024 Outlook. Welcome to everyone that's on our live stream here, as well as those of you that are coming through from YouTube. And I'm going to go through a lot of content today, so please feel free to type in questions, but I'm going to save the Q&A session to the end because I'm not going to be watching both screens, and it would be kind of distracting to go back and forth. But I'm very excited to be sharing my content with you. And today, as Boris said, you're going to hear from a number of very experienced market experts covering not just the Forex market, which is what I'll be talking about, but also stocks, gold, crypto, many different markets that you may be interested in and you may be trading in. So not only am I excited to share my content with you today, but I'm also excited to hear from Blake and Nick and Rob and Ashraf and of course Linda, who is the queen of trading and legendary market wizard. So I'm assured that you'll learn a lot. And today I'm going to talk about the outlook for pretty much all of the major currencies. In the past, when I've talked about what could be in store for 2024, we talked about it from a broad perspective. We talked about it from what could happen in the markets this year. But we didn't necessarily drill down to what could happen in the dollar, the euro, sterling. So for those of you that are trading Forex, that's what we're going to cover in today's session. So without further ado, let's go ahead and dive right in. So in 2024, there are three primary themes in the market. And these themes that will, kind of transpire as the year progresses is basically, we are going to see a year where growth is going to slow, central banks are going to shift monetary policy, and we're finally going to start to see central banks go from interest rate hikes to interest rate cuts. And, we are going to see how the geopolitical tensions around the world in the Middle East, and there were actually, I think today, is it today? Today, I think there's elections in Taiwan, if I'm not incorrect. And did the results come out? Let me see. And that's going to have a significant impact on the markets as well, because the outcome of the Taiwan election will determine how aggressive China is with their threats. I mean, I'm checking right now. The election is today, and hopefully the outcome will come out, in a couple of hours. But the reason why this matters is because the current regime is very opposed, obviously, to the aggression from China. The opposition and the votes are tight, although the current existing party that's in control is more likely to win. The opposition party seems to be more willing to be conciliatory to China and try to work together in a kind of one Asia solution. So we'll have to see. But the elections are going to be very important. This is a year where we have elections in 70 different countries. For the first time ever, over half of the world's population has an election in their nation. So this is significant. And because of all this, and because you're coming here, joining us, and thousands of you registered for today's session, is because you understand that fundamentals matter. I'll be the first to admit that I, trade off of fundamentals, but not fundamentals alone. Fundamentals determine what I'm going to trade and how I'm going to trade it. But technicals determine when I'm going to trade it. So fundamentals is a very, very important piece of the puzzle. And I appreciate that those of you that are joining us today understand that. And that's why you're here. And that's why you're listening to our Outlook, because you understand the importance of getting a good grip of where those markets, the countries are headed. And of course, we are going to start with the US and the US dollar. And the reason why we always start with the US and US dollar is because 80% of all currency transactions include the US dollar. And that is why, as a trader, regardless of whether you're trading euro or pound or or anything, or even if you're trading gold, you have to watch US data. You have to watch what's going on in the US economy, because gold is priced in dollars, oil is priced in dollars, equity markets are determined by what's happened in the economic landscape, and of course, all of the major currencies are affected by what's happening in the US dollar. So, the most important thing to understand about the US dollar is that rate cuts are coming. Traditionally, there is a 10-month average period from when the Federal Reserve last raised interest rates to when they are going to deliver their first interest rate, cut. So, the last time the Federal Reserve raised interest rates was in July of 2023. So, so what the market expects is the Federal Reserve to lower interest rates in March or by March, which would pretty much be within this average. Basically there's a 10-month average between a hike and a cut. And what this graphic shows you is how the markets tend to perform 6 months before the last hike, the rate pause period, and 6 months after the first interest rate cut. So you can see that equities do not necessarily underperform when the Federal Reserve, yes, equities do underperform when the Federal Reserve is raising interest rates. They tend to perform the best, like we saw the Dow hit record highs during the rate pause period. And then, we tend to have what I want to describe as diminishing returns in the 6 months after the first rate cut. And that's what, I think is going to be important, because this is going to be the year of diminishing returns in the equity markets. And that's why it's important to look for opportunity elsewhere, including the Forex market, because by trading Forex, by trading crypto, by trading gold, you have more opportunity to generate return than just sitting with your stock investments, and that may start to deteriorate in value. So what's interesting here is that the market is looking at, and let's just say January because I just updated this morning. The market is looking at a 65% chance of an interest rate cut, the first interest rate cut in this cycle by the Federal Reserve in March. And it's still pricing in 150 basis points of easing this year. And this is interesting because US data hasn't been terrible, right? Just this past week, we had the US inflation report, which was better than expected. And then earlier in the month, we had the jobs report, non-farm payrolls report, which was stronger than expected. And jobless claims have been very low. So if US data has been so good, why is the market still looking at 150 basis points of easing? Why is the market still looking at 65% chance of an interest rate cut by March? And before the non-farm payrolls report, it was at 70%. So the good data only led to like a 5% drop in expectations. Why is the market still so convinced that the Fed is going to cut interest rates? And the reason is because they don't believe that the improvements that we've seen in the economic reports is durable. They don't think that we're going to see inflation remain high. And the first hint of that was in the producer price report that we had on Friday that came in weaker, telling us, wait, producer prices are lower. So even though consumer prices are lower, next month's consumer prices could end up being weaker. So that is something that the market's thinking about, and that is something that they're not trusting the rise in CPI. And as for the jobs report, anecdotally, I can tell you, I live in the US, the economy, the labor market feels like it's going to soften more significantly this year. And many Americans are more worried about their jobs this coming year than they were last year. And next week, we have the US retail sales report, and spending is probably the most important, because are Americans belt tightening as they express their concerns about the markets? So how does this affect currencies and the other markets? So here you have the orange line is the Fed funds rate. And the Fed funds rate shows you that, and I think you can see, I'm not sure if you can see my pointer, but basically when the Federal Reserve lowers its interest rates for the first time, it tends to coincide with an initial sell-off in the dollar, which is where my green arrow is pointing. And then eventually the dollar rallies. In this case, the Fed got more aggressive with interest rate cuts, and that slowdown in the economy led to a flight to safety in the greenback. So initially, you can expect the dollar to sell off. So first, the dollar rallies, the Federal Reserve raises interest rates. In the pause cycle, it grinds with a general upward bias. And then when they start to cut interest rates, it then starts to fall. And then flight to safety flows come in, maybe because of other issues, and then it ends up, possibly recovering. This is a longer term chart of the dollar index and the Fed funds rate. So the orange line is the dollar index, the blue line is the Fed funds rate. And you can see, once again, right around when the Federal Reserve starts to lower interest rates, if you look very closely, we tend to have a drop in the US dollar. So if the Fed really comes through with a March interest rate cut, then we can expect a more significant sell-off in the dollar. Also, in the last, basically in the last 30 years of Federal Reserve interest rate cuts, that has all pretty much coincided with a recession, either a shallow recession, like this thin, narrow line that you see in the right-hand side of the chart, or a deep recession, like the one in the middle of the chart. And so that's what a lot of people fear. That is why the Fed funds expectations haven't changed that much, because many of the people in the markets fear that there could be a more significant slowdown in the US and maybe even a recession. And I would say that the risk of recession is actually greater in some of the other countries that we're going to talk about later. But this is the historical path of interest rate cuts preceding recessions is what the market is worried about. So the prospect of interest rate cuts is good, is bearish for the US dollar, and can lead to further declines in the dollar this year. But it is very, very good for gold. Fed fund peaks have in the past signaled major rallies in gold. And we saw gold break out last week, right? I posted a video, a short on my YouTube channel. You can go to YouTube/BK4X and go to our shorts. And I posted about how gold is breaking out to the upside. And I talked about whether it's durable or not. And one of the reasons for the gold rally to continue and for gold to move higher, aside from geopolitical risks, is that Fed fund peaks have in the past signaled big gold rallies. And so this is important, and I think could be a sign for those of you who are trading gold that you may want to lean into those long trades, because there's a good chance that that gold is going to rally this year, and which would be consistent with a sell-off in the US dollar. So where's the opportunity? Short dollar, long gold. I think that's what is something that could be an interesting opportunity this year, with the Federal Reserve expected to lower interest rates. So dollar yen, you can see here, we're not too far from our recent highs. It has been rallying. This is a slightly older chart, so it's a bit lower. But I think it's going to head back down towards the 140 level. And I think with the dollar itself, probably the best way to express it is dollar yen, because if we believe that stocks are kind of at their peak, and stocks have been consolidating near their highs, and I think vulnerable to a deeper correction. And I think one of our speakers are going to talk more about that. Then dollar yen has a very strong correlation with US stocks, and that should come down as well. And then long gold. This is a weekly chart, so it doesn't necessarily show the most recent price action. But I think gold is going to head back towards its highs, and I think we could see further gains in gold this year. Now, we can't talk about the outlook for the US economy without talking about the election in 2024. This is probably the most important. Well, I think everyone believes that their elections are the most important, but this is one of the elections that the market's watching the most closely. And while it's going to be a talking point throughout the course of the year, let's get real. The election isn't until November, and that's at the end of the year. So the real market impact isn't going to be until the end of the year. There could be some, volatility around who the Republican candidate is when he or she is selected. But the reality of the matter is that the outcome won't be until November, and that we won't necessarily see what's going to happen in the markets till then. So all of the other things that we're going to talk about in terms of the other countries, the growth prospects, the Federal Reserve interest rate cuts are going to have a more significant impact. But I think what is important to understand is some of the patterns of the markets during election years, irrespective of who wins, because the elections in November, this talks about how the markets could behave in the election years in general. And the S&P 500 has not declined during a presidential re-election year, which is what this year is, since 1952, with a 13% average annual gain in re-election years. But stocks are at record highs. The Dow Jones Industrial Average is at record highs. This measures how stocks end up at the end of the year. It does not take into account the volatility that could happen during the year. So I still think we could see a correction in stocks in 2024. Maybe there'll be some factors, especially with the Federal Reserve actually lowering interest rates and that getting more aggressive in 2004, that could lift equities, but not necessarily before we see some pain. Now, the reason why the policies are so important is because if former President Trump actually wins the election in November, there's going to be a lot of protectionism. There's going to be a lot of America first policies. And this could have significant implications for the U.S.-Ukraine war. I mean, Trump doesn't understand how we could shed so much blood for such a tiny nation, and that we probably shouldn't be involved. And so he's probably ends the U.S. involvement in the Ukraine war, and he'll probably abandon the Taiwan deal. I mean, why? He'll look at the up and down sides of supporting an island nation against a big behemoth, and he's going to step aside. It's going to be more about America first, economic protectionism, and looking at things like import tariffs that could impact many countries around the world. And that's why it is so important. But once again, this is not until November. There's a lot of time between now and then. This is more a story for 2025 than it is a story for 2024. So the main thing for this year is that we know these stock markets tend to perform well during a presidential election year. And interestingly enough, even though I think that the dollar is going to sell off as the Federal Reserve kicks off its interest rate cuts, the dollar could also end the year higher when we revisit this in December of this year, because the dollar index almost never, rarely falls in election years. And this chart doesn't include 2020, where we had a 6.8% drop, but pretty much during this period, we only had 2 years of declines in the dollar during an election year. And so, that is obviously something to keep in mind as well. So in a nutshell, I think the dollar is going to fall as the Federal Reserve kicks off its easing cycle. But, as we saw in one of the earlier charts, the dollar initially falls, then when it catches a safe haven bid on some concerns about recession, it ends up rallying later. And that's what, could be the same historical pattern that we see this year as we had in the past. So let's talk about the Eurozone now. The most important thing to realize about the Eurozone is that growth is going to be weaker this year. The ECB lowered its inflation and its GDP forecast. This is their estimates. This is the yellow is where they previously thought things were going to go, and the blue is where they now think things will go. So you can see that the GDP for the European Commission, their forecasts are halved this year. But we're beginning to see signs of stabilization. And there's some reason to believe that this could be a better year for the euro as headwinds diminish. One of the big fears is that we were going to have very high gas prices. And, those gas prices come down a lot. I was just driving around last night, and here in the US, I know it's very different in many countries around the world, but I actually saw like $2.99 a gallon. And, it's probably cheaper in much more other parts of the country. So how high gas prices are will be less of a drag for the US and the euro area in this coming year. And central banks are done with raising interest rates, so there'll be less of a drag from rate hikes. And there'll be weaker global industrial activity. So some of the weaker global industrial activity is going to recede as well. So the headwinds are going to diminish in the coming year. And disposable income will grow, and those disposable income will increase because they're paying less for gases, and also inflation is lower. So they're dealing with less price pressures, and there's going to be more normalized wage growth, especially in Germany. So this could be a better year for the euro area. But what's important is that we need to watch the manufacturing sector, because this is something that could tell us whether this is going to be sustained or we're still going to see problems in the euro area economy. Now, the one thing you're going to see is, we're obviously going to see inflation continue to fall. But the one thing that I am looking at is, this is an interesting chart. The yellow line is the PMI index from the Eurozone, and the blue line is the employment situation in the Eurozone. So you can see the yellow line oftentimes leads the blue line by 6 to 18 months. So what this chart tells us is that we could soon be seeing a more significant deterioration in the Eurozone labor market, more job cuts. And that could, especially in the manufacturing sector, and that could be a big problem. And that's why I'm telling you, watch the manufacturing sector, because if we start to see more job losses in general, that is going to offset some of the headwinds. Now, in terms of the ECB, the ECB is expected to lower interest rates this year. In the most recent ECB meeting, they said that they expect a temporary rise in inflation, which could delay tightening. The first rate cut, this is very important, for the ECB is expected in the early second quarter, but it could be later. So the Fed is expected to lower interest rates in the first quarter. The ECB is expected to lower interest rates in the second quarter. If that is the case, the Fed is the first one to lower interest rates between these two, then that means Eurodollar will rally. And I don't see a situation where the ECB is going to cut interest rates before the Fed, because inflation is a bigger problem and a stickier problem in the Eurozone than it is in the US. And the risk for the Eurozone outlook this year is another spike in energy prices or renewed geopolitical tensions. And we're going to see the end of energy supports. A lot of countries, a lot of nations provided fiscal support to offset the drag in energy prices, and that's going to go away in this year. So, but in a nutshell, what this means for euro is that traders are scaling back the scope for ECB interest rate cuts. They're looking at less, I think, they're looking at maybe 140 basis points of rate cuts, so it's pretty much along the lines of the Fed. But they're expected to start later than the Fed. So what this means for the euro is that we could see in the near term a rally in the euro, because if the Fed ends up cutting interest rates before the ECB, this is going to be positive for the euro. Now let's talk about Japan. This is a huge year for Japan. And this is a huge year for Japan because this could be widely expected to be the year where the Japanese start raising interest rates and drop their zero interest rate policy. And I'm very bullish Japan. Warren Buffett is bullish Japan. Why? Because Japan is enjoying its fastest price growth in 30 years. Inflation is above 2%, and that's supporting wages and spending. And the wars that we're having in Ukraine, in the Middle East, is sparking new investment into supply chains and manufacturing. And while Japan doesn't necessarily produce the actual machineries, they produce a lot of the intelligence and AIs and things like that, and new technology behind the machinery. There's also a demographic shift where the old generation is starting to leave the workforce, and you're seeing a more percentage increase in the younger generation. And as a result, there is hope and belief and investment into more venture capitalism in Japan this year and in the coming years. And so the demographic shift could lead to renewed energy in Japan as well. Low cost of capital, a lot of low valuations, and they're also a stable economy, second largest democratic capitalist country in the world with stable geopolitical and economic outlooks. So that makes Japan very, very attractive. So what does that mean in terms of opportunity? that means that, I think this is going to be a very good year for the Japanese yen. And Warren Buffett in particular has been investing heavily in trading companies. And those trading companies are pretty aggressive in the commodity space. And so this could be a good year for Japan, as well as a good year for a lot of natural resources and commodities as well, which plays into our gold trade and gold and copper trade ideas, and oil that could be, big opportunities this year. But in terms of Forex, what this means, in my opinion, is that this is going to be the end of the golden year for carry. We had carry trades work out very, very well in 2023. They were strong performers. But this year, with a lot of these central banks, and what this chart is showing you is these central banks are all expected to lower interest rates, except for the one at the very bottom, which is the Bank of Japan. The Bank of Japan is the only one that is not expected to lower interest rates, but expected to raise interest rates. So this is going to be bad for carry trades. And I actually just posted a carry trade video on our YouTube channel, youtube.com/BKForex. And that explains what carry trades could be in store for this year. And so this could be the end of carry trades, which means that shorting a lot of the yen crosses could be a very interesting and nice opportunity, including dollar yen, which is one of the trades that I talked about earlier. I think that between the Federal Reserve lowering interest rates and the Bank of Japan expected to raise interest rates this year, this could be a year where we see a more meaningful correction in dollar yen. Now on to sterling. As for sterling, what we have here is with the UK, the UK basically narrowly avoided a recession in 2023. And unfortunately, the latest UK numbers that we have was pretty terrible. The 3-month number dropped back into contractionary territory. So that is something that I think is, going to be a huge problem. And that is something that I think, the market is going to watch very closely, because in this coming year, we're going to see little to pretty much no economic growth from the UK. And inflation is falling quickly. And so I think that, that is something the market is watching very, very closely. And, that is something that could lead to, possibly some worries for the UK economy. Inflation has also been falling quickly. It was 10% in January. Now it's at 3.9%. So that's a huge change in inflation. It's more than half what it was. But unfortunately, inflation still remains sticky. The labor market remains tight. Wages are firm. And so the Bank of England is expected to cut interest rates less than the ECB and the Federal Reserve. I think only about 120 basis points of interest rate cuts are priced into the market. So if only 120 basis points of interest rate cuts are priced in the market, and the Bank of England is expected to lower interest rates later than the ECB and the Federal Reserve, what does this mean? What this means is that, we could see pounds outperform euro and pounds outperform the US dollar. We also have an election, a possible election in the UK this year. And the reason why this matters is because the prospect of an election this year means that the existing government is going to focus only on short-term political objectives in order to get the votes and to appease voters. And what that means is tax cuts. So sorry for the typo, but there'll be no last mile support for the Bank of England's inflation fight. So they're not going to do anything to help, the Bank of England ease inflation faster. So what does this mean for the pound? Now, what that means is we could potentially get pound dollar to rally. I like that too, because the Federal Reserve is expected to raise and lower interest rates before the Bank of England. But I think the better opportunity is in pound CAD. And the reason is because, the Bank of Canada, which we'll talk about later, should be one of the first central banks to lower interest rates. So talking about commodity currencies, which is next, we can't talk about commodity currencies without talking about China. And in terms of China, the most important thing to be aware of in China is that this is going to be a year of a weak recovery. China is going to struggle to meet its 5% inflation target. And, they've had a target which could be their death knell this year, where they're going to really struggle in order to meet this target. Deflation, as we saw in the last inflation data we had this past week, is going to persist. They're the only one of the few countries around the world that's dealing with deflation, whereas everyone else is dealing with, inflation. So that's going to lead everyone to think that the People's Bank of China could lower interest rates this year, because there are a lot of troubles ahead. Aside from slower growth, aside from deflation, they can no longer count on a post-COVID rebound. They have been very underwhelming in terms of government stimulus. The youth unemployment rate is at a record high, and people have returned to being full-time children, which means that they're going back to living with their parents. They're going back to school. And so they're no longer contributing to economic growth. And of course, we're watching the Taiwan elections, which is today. But all of this trouble in China means that, we could have an interest rate cut in China that will be reflected in, the impact on the Australian dollar as well as the New Zealand dollar. I'm actually bullish the New Zealand dollar. And the reason why I'm bullish the New Zealand dollar, I think it's going to outperform, is because, number one, the RBNZ raised their rate forecast for the coming year and two. They don't think that interest rate cuts need to be cut as aggressively. The last time we heard from the RBNZ head, he said we discussed even raising interest rates in November, and that they could hike again if inflation doesn't fall. And New Zealand has some very unique situations that could lead the economy to outperform. And what they are is basically they're expected to have a rebound in tourism, which is going to support the economy. And there's been record migrant arrivals, which is also expected to support the economy. So New Zealand could be set to gain momentum in the coming year, which could lead to outperformance in the New Zealand dollar. The Australian dollar is more of a mixed bag. We know that China's slowing. The Australian manufacturing and service sector activity has been weakening. There are serious concerns about recession in Australia. Inflation is falling, but not falling fast enough. But at the same time, growth is falling. And on the bright side, wages are rising at the fastest pace in 15 years. Tax cuts will boost disposable income, but I think Aussie is going to underperform, whereas Kiwi could outperform. The same story for the Canadian dollar. With the Canadian dollar, we expect slower growth this year. And like Australia, there's a risk of a recession. And at the same time, there could be a softer labor market conditions. We already saw weaker employment numbers. High mortgage debt could mean that consumer spending could weaken into 2026. There will be more pain from higher interest rates. So the Bank of Canada is expected to be the first central bank to lower interest rates. And if they are the first central bank to lower interest rates, it will be the currency that it sells off the quickest in the coming months. The first central bank to cut interest rates will see its currency fall the fastest in the near term. And that's the currency you want to short. And that's what we're going to be looking at. I think that in the near term, the Federal Reserve is resisting interest rate cuts from the market. The Bank of Canada is the first expected to lower interest rates. So I think that dollar CAD could have some good near-term opportunity. So I like that to the upside. And I also like Euro CAD because the ECB, as we spoke earlier, is not expected to lower interest rates until the second quarter. And data recently has been better. So I like dollar CAD and Euro CAD to the upside. So that's basically the outlook for the markets and the currency market in a nutshell. And I hope that you learned something. And now I'd like to open up the floor to any questions that you may have before I turn it over back to Boris.
Great, thank you so much, Kay. So sort of like basic takeaways for Kathy, maybe you can just summarize us. Your strongest, most confident directional trade ideas this year, what would you say? People are just really kind of interested.
So I think that the Canadian dollar is going to sell off, and I think that the Japanese yen is going to rally. Yeah. So I think actually CAD yen could be a really good trade this year.
Yeah. there's a lot of I think very interesting macro analysts that I'm following who are super bullish Japan, and both economically, but also, as you were saying, the BOJ may be finally moving away from the quantitative easing type of monetary policy, and just even a tiny shift toward more tightening policy is going to create a massive outflow, I think. So you're absolutely right. I really like the long yen trade as we go along. There was a couple of questions here regarding, for example, Europe. Some people were asking, what do you think about the fact that there is employment, problems in Europe? How is that going to affect the euro?
So, I mean, the ECB is definitely going to be lowering interest rates, but because inflation is so high and there's a 6 to 18 month lag between the PMI deterioration and the job losses, that in the near term, I think Eurodollar is going to rally. And when the ECB starts to lower interest rates, it's going to fall, but that's going to come later. As I said at the beginning of my presentation, fundamentals determine the direction of what I trade in, and also what pairs I select. But watching the technical landscape, the technical picture is also very important, which is why my zip indicator is what I use to trade the markets. And every single day with our BK members, I'm doing these outlooks and live streams and what to expect, because markets change week to week. And so as one of the benefits of joining 8cap is that you're going to get one whole month of experience in all of this, and you'll get to also get updates as things progress.
Yes, Kathy is kind of pitching what I want everybody to know. I'm actually going to put this link here to everybody in the room here so you can see, and I'll be talking about this to everybody much later. But I've put together a deal that is unbelievable for everybody who's listening in the room here. As long as you're not a U.S. customer, I know there's a couple of U.S. listeners here. Those are the only people that cannot participate in this, but I'll have a different deal for you guys later. The deal that I just put the link into the room, and I'll talk about this a little bit later. You guys who are here in the webinar are going to get literally $1,200 worth of services from every person that is going to be talking at the show today for absolutely free. All you have to do is simply, I'm going to take the screen and just show it to you. Hang on, let me make me the presenter.
And for those of you that are asking about gold and crypto, Ashraf is going to be coming up next and talking about gold and crypto. And so you'll hear a lot more about that.
Right. Before we let Ashraf on the show, I just want to explain to you, Ashraf actually is going to be one of the great contributors to this package. He is offering a free webinar with him. And after you hear him speak, you'll understand why that's an incredibly valuable deal. In addition to which, you get to trade with Kathy and I. Blake, you get to have his Forex analytics tool. You're going to have Nick's Edgefinder AI tool, and you'll have a private webinar with Robbie Booker as well. All of this for literally $0. I pretty much pulled every string I could to get this for you guys. $1,262 value. All you have to do is just simply open a tiny $100 deposit account with 8cap. So I'm happy I put the link in there right now. You want to do it right now, lock it in, please do so. I'll obviously remind you guys as the show goes on, but this is why I really wanted you guys to start 2024 on the right foot. I couldn't think of a better way of doing it than giving you all of these tools to be able to trade really, really well. There are a lot of new people in the room. They're asking a lot of new questions. These guys are all the experts. Imagine having mentorship for literally nothing from some of the best traders in the world. That's what I try to put together for you here. So enjoy. Please take advantage of the deal. We're going to say thank you and goodbye to the queen of macro, Kathy Lean, who I think probably is making a great call in FX with being long yen. CAD yen is sort of her favorite trade going long here, so just remember that. And we're going to turn our attention to our friend Ashraf Laidi. Let's see if Ashraf is going to come up on the camera. Can we get? I don't know if he's going to.
Thank you, everyone, for joining me this morning, and I'll talk to y'all soon again.
Thanks, Kate. Thank you so much. We'll see you later. All right, we're going to see if we can get Ashraf's audio up, and hopefully he's going to get his mic working and his video up. Let's see if he's.
Hello, hello. How are you?
Hello. Legendary Ashraf Laidi joins us. I don't know if are you coming on camera or?
Yeah, I should be doing the camera. Let me see webcam. I haven't used share my webcam.
There you go. That's it. I see you right
Okay.
there. Look how handsome he looks in London. Very, very cosmopolitan.
Listen, well done, guys, for waking up on a Saturday at 6 a.m. But that's nothing. This is late for you, isn't it?
It's for me late. For Kathy, it's not that
Kathy.
late. I really,
Yeah.
I had to call in some favors to get her up this early on Saturday. She's really been a trooper. Ashraf, of course, is enjoying leisurely afternoon here. He's probably already had his cup of tea.
I did.
London. For those of you who are not aware, Ashraf Laidi is literally one of the most legendary figures in our business.
No, don't say that.
He's been an analyst for longer than many of you have been in the markets. He's sort of the original Forex king, but he has since really, I think, moved on. He's as he'll be the first one to tell you, a very, very big fan and proponent of crypto. So I asked him today to talk about crypto, which is really reviving right now, and I think it's fascinating because there's just so many countervailing themes and stories coming out around crypto. So I'd love to hear his point of view. But then the other thing that he's sort of very good at is also gold. And the most important thing that Ashraf is really, really good at is intermarket analysis. So he's going to show you some incredibly interesting charts. He kind of shared them with me a little bit earlier that have to do with how these two markets interact and how they may be signaling some very, very big moves. I'm going to turn over the screen. I'm going to give him the panel and talk to you, just letting you guys know. Ashraf's book, Intermarket Analysis, kind of like the Bible in the business. I will be raffling that off at the end of the show. So hang out. You're going to get a chance to get that book for free from me at the end of the show. In the meantime, let me just turn over the screen and let Ashraf take over the show. Let me give you the.
Thank you, Boris. I'm having issues choosing which screens to select.
Hold on. I haven't made you a presenter yet. Let me just.
I haven't. Okay. So when you do, perfect. Okay, so let me choose which one. Audience. So
we see your Gmail right now.
Yes, screen. Here it is. Perfect. Yes. My God, I haven't used GoToWebinar in a while. Listen, thank you very much for that. First of all, thank you very much for that introduction.
For GoToWebinar, but it really works well. So there we go.
Yeah. So let's do the clean one. So now you can see the PowerPoint.
Yes, we see your PowerPoint. Perfect. Yes.
First of all, thank you. Thank you, Boris.
So much. I'm going to get off the screen and let Ashraf take the show and post up questions, and I'll be happy to answer them while he talks.
Excellent. Thank you, Boris. Thank you, Kathy, and thank you, 8Cap, for having me. And again, it's good to kick off the year with these webinars and these sessions. And basically, Kathy did a very good job in covering the macro and the FX. And like Boris said, over the last really 2 years, I've been focusing a lot on gold, a lot of technicals and intermarket analysis. I wrote the book in 2007, but there was not much really about the trading part. So I think 70% or 80% of the presentation is really going to be about gold and about metals. And how on earth do you know? What are the tools that you want to try to use if you are close to a margin call, if you're close to losing your money, if you don't know what to do? What is the difference between funding your account and between letting it be margined out? What are some of the things, the last vestiges of confidence and analysis when you are sitting in a long gold position in November? Things like that. And then I will talk about, when I say a crypto, it's really going to talk about Bitcoin, and it's the main thing here. So let's just kick it off, guys. And basically here, so this, by the way, in this presentation, guys, I'm going to be posting a lot of slides from previous presentations that I did, like back in October. And you will know why. There is a reason why. It's basically, I will show you what I said and why I said it and how it progressed. But I did something in October in London, and they said, "What is the first thing you see in the morning?" Well, there's a lot of things I see in the morning. You know, you go to the desk, you have the 3 screens, and some people have 6, 7, 8. I have 3, and one of the screens that I always look at. This is the first thing that obviously, you know, the levels is this. You know, you got the carry, you've got the regional banks, you've got the ES1, the S&P, the Nasdaq, you got the DAX, oil, 10-year. Dollar versus the yuan. This is important. A lot of people are looking at the DXY. I look at the dollar versus the yuan. I look at the 10-year yield. It's very, very important. And this is looking at bonds, but from a price point of view. And the XME. This is the metals ETF. So you know the XLE. You know the XLK, you know, the spiders, S&P, which is the mother of technology. You know the XLV for health. You know the XLY materials, XLK. But XME is the miners. Obviously the DXY and gold versus silver. And gold versus silver, I've been following this for a long time, but now I try to refine it every 3 to 4 months, try to use it sometimes as an intraday indicator, and sometimes as one of those things that I try to use before I decide whether to quit a trade or not. And believe me, we've all been there. You are long gold, you know, you have a stop, it's about to hit your stop, you don't know what to use, a mental stop, or you don't know whether to execute it, or you don't know, or you know whether to actually take partial. But then what are the things in the market? Do you look at the dollar chart? Do you look at the euro dollar chart? Do you look at the yield chart? Or do you look at the gold chart? And there's many things. And intermarket analysis is one of those things that basically, if you're trading A and you're trading B, and you know that C and D are correlated with A and B, so if you don't have much clarity in the thing that you're trading, you look at the thing that is related to it. And sometimes you can glean some clues and clarity from the things that you're not trading, but the thing that is correlated with what you're trading, right? Whether it is what I'm trading is testing the moving average, is testing the Fibonacci, but the other factor there is correlated with it may have already broken out, and sometimes they lead, sometimes they lag. Okay, so I hope this is going to be a helpful hint to that. So stick this chart in the ceiling, in your night table, by the TV, by the dining room, in your albums, in your mobile wallet, in your espresso machine, in the bathroom, in your partner's phone, in the favorites, in the cloud, children's mobile, under the desk. These next 3 charts, the reason you need to post them everywhere, because they remind you of the game at play. Okay, whether you are long and the market is against you, that is gold. Whether you're short and it's against you, you need to know where on earth you are. You need to know if you are, basically it's the forest from the trees. Okay, you go camping, you go hiking. Okay, oh, my point of reference, oh well, half hour ago we passed by that big tree and then it's the green tree, but where is the forest? Where's the north? Where's the south? And this is your GPS. So this is deliberately an old chart, November 2022. This is November 2022. Do you remember what is November 2022? It was the low point of gold. It was at 6 when gold hit 1615. Sorry, this chart was not. This chart was actually when gold was in 1909, but I put in November 22, just you will know why. But this is a weekly chart. So look at this. So basically you have the high of 1996, and I don't want to get into too much history here, but so you got 96. 96 basically when gold was getting ready to fall, and it's when the dollar was commanding everything, and when the dollar was the only game in town, and it was called the technology miracle. Capital, markets were there was emerging markets, but the technology revolution was just getting started. And as a matter of fact, 1996, I was actually working as an analyst, but it was the time when we were starting to do day trading. And but 1996, I'll tell you the story, guys. 1996 basically was I was approached by some guys, and this is a true story. We were in Stamford, Connecticut, and this guy said, hey guys, do you know that internet thing that we have? You know, we use Netscape. You know, the browser, we use Netscape. Well, guess what? Netscape is going to have an IPO. And I know some guys in Morgan Stanley who are going to be able to let us in on this IPO, but we need to put in some tranches. So basically 1996 and 97 and 98 and 99, the technology miracle, the productivity miracle, you know, the dollar was up and stocks were up. There was none of that risk on, risk off. Okay, the dollar was up because capital flows was coming in the U.S. dollar and chasing U.S. stocks. So and obviously as a result, you know, gold was coming down and stocks were the only game in town. But look at this chart. 10 years later, you've got a high. So I'll take you to history. So 2006, please pay attention. 2006 was the final rate hike because we had the bubble and we had the recession in 2001, 2002. And then what happened? When things started to stabilize, the Greenspan started to raise rates, and then Bernanke came in, and it was and then they started to raise rates in 2000, I believe 3, 4, or 5, or I believe in 2004 and 5 and 6. And June 2006 was the final rate hike, and then things stabilized, and then the crisis happened, and then they raised, and then they cut rates. So June 2006 was the final rate hike, and there was a sell-off in gold. Oh, by the way, those who are wanting to know about ETFs and all of that, it was around that year when 2 of the 3 biggest gold ETFs started. Now, how is that for history and analysis? So, but look at this. 2011 obviously was the September 2011 high, and then the bear market started in gold. So 2011 plus 10 years, almost 10 years, 2020, that was the next high, okay? It was basically the post-COVID stimulus of the Fed, where the Fed was buying everything in sight, and they revolutionized basically buying corporate bonds, and they threw everything, and it was QE on steroids. It put the QE of 2008 and 9 to shame. And obviously metals and everything that is priced against the dollar went up. But you look at this. So for those of you who like, and cup and handle is one of the biggest, most important technical analysis, classical analysis formations is what you see inside. But this is a bigger chart. This is a bigger chart. So this is a weekly, but look at this chart here. This is from 1974, and you can see the picture. You've got a high, you got a lower high, and then you come in, you got a high, you got a lower high. So basically, this really tells me there's many fundamental, many technical aspects that tell us that gold could be going to 24 and even to 2,500. Now, that's why I said, if you're short, if you are, you know, if you're long gold and gold is down $50, $60, as it can do that easily, especially when something is priced now as 2040, 2030, it can go down much easier by $30 or $40 than when it was in 1900. But this is what you need to have. So this is an approach that I use. It's called applied intermetals technicals. Okay. So when I look, and here's what you need to see. If you're long gold and gold breaks your trend line and you have a trend line support, how do you do a trend line? If you need to tell me something, Boris, you can text me on WhatsApp if you want to tell me a big dark secret that nobody wants to hear. That is important. That you don't need to wait regarding the session. So I hope the sound is great and the image is great and all is good. I've got some of my WhatsApp broadcast members here. We see you perfectly.
You're doing a great job. You're doing a great job. Yeah.
So guys, so I know I'm going to talk about gold silver ratio, and I look at the relationship. But when gold was falling and silver was falling, I tried to see what on earth is copper doing. And before I show you the chart, you need to know that yes, copper is not as liquid as gold market. Silver is not. Platinum is not. Therefore, they are less vulnerable to the playing around, to the volatility, to the unexplained volatility. Some people say to manipulation that gold is. And I'm not here to tell you what is manipulated, what is not. What I'm trying to say is that gold is much more volatile, much more liquid, much more amenable, and much more vulnerable to volatile and swings. And therefore, if you want to know whether this thing is really going up or it's going to go down, you want to see its cousins, its other metals that are less vulnerable to these swings, and you want to see whether their major trend line is intact. And I touched upon something called major trend line. It's classical analysis. It's the overall trend line. It doesn't matter whether something broke by 30 or 40 pips, okay? The hedge fund managers, the hedge fund trading desks, they basically, when they trade, they have a global macro analytics service, they have a technical analytics service, they have an Elliott wave service, and they bring it all together, and they are looking at the overall picture. Some of them look at the, the TD, some, at the DeMark. Some of them look at Elliott wave. Some of them look at the point and figure. But what I'm trying to say is that when these big guys, these movers, they're moving money and they're trying to find inflection points. Yes, they decide which has, what analysis gets the advantage depending on the discretion of the trader, of the manager, of the owner of the hedge fund. And some of it is AI, obviously, as Boris will tell you. Some of it is, what the robot is doing. But, they're not going to pay attention. They're not going to look at the 5-minute chart or the 1-hour chart. They're trying to know, what is the thing that is going to lead the airplane to turn, okay, in the airport, and how does it turn? Is this a shift or not? Obviously, if you're trading, if you're doing day trading, if you're doing scalping, that's a whole different story. But the reason I'm looking at these trends, and I'm going to go into the daily chart, but the reason is because this gives you the confidence whether if you've been long gold, and wrong, is it time to close those longs that you had at 2050 when it went down to 1900? Some people said, what? You still have them? Why did you close them? Some of them have them. If the size is very small, if the size is 2% of the account, yeah, he's paying swaps on it. You're right. But why doesn't he want to close it? If he can afford to close it, if it's 2% of his account, let him do it. Let him hold it. And then when it goes back up, and it happened to me, when it goes back up, it will basically take over and it will erase, it will make up for the swap fees. But I'm exaggerating, $300, you're long something and it's a $300 down. But when you're long something and it's $30 down or $40 down, and you want to know, and you're close to the stop, and you're, because everybody thinks that they know, because here is the caveat. When people says, but technical analysis does not work. Think about what you just said. Technical analysis does not work. It does not work. It's the way you use it. It's the way you interpret it, okay? So it's the way you interpret, and technical analysis is very much in the way of interpretation. And then you've got money management. And what I'm trying to say is that when the Fibonacci that you've been in love with all your life, when that retracement that you've used so much, when it breaks, you think this is the end of the world. But I am trying to get you to look at the big picture because it can mean something. So let's go here. So basically, if you look at this chart, okay, so copper is up, gold is the yellow, platinum is white, and silver is down. So I want you to start focus. So there were two major lows. There was the low of this year, of last year, okay, which was basically 2023. But the scary low, the major low, was in November 2022. Okay, and I'm not going to get into this, but one of the major forces that helped gold was the Bank of Japan intervention, because the Bank of Japan intervention indirectly helps caps bond yields. And when bond yields come down, that's something that nobody is going to tell you that. People are going to say, what is this? I woke up on 6 o'clock in the morning for this guy to tell me that the Bank of Japan weighs on helps gold. Yeah, you'll surprise yourself. You wouldn't know what you can hear when you wake up at 6 in the morning or 7 in the morning, or if you're in California. But that's important. But I'm not going to get into the fundamental catalysts. What I'm going to get into here is that when copper fell and when gold fell in November 2022, look at that. Look at silver. Look at platinum. It respected the support. Look at silver. It respected the trend line support. And I'm going to give you this anecdote, and I kid you not. This is an important anecdote that I want to relate it to you, because I hope you will read it too. But listen, I was in it was October 20th and 21st, 2022. So Friday 21st was when the Bank of Japan intervened. I was in Dubai. I was in an expo. I was sitting in a booth, and I was looking at the chart of gold, and gold was going around 1620. And I don't need to look at the chart. I know this by heart. 1620, 1630. And I showed the chart of gold. And all these gold dealers and gold traders, and I say dealers. So for instance, there is a major company, a big broker it's a Swiss company. I'm sure you know which one. A big Swiss FX broker and it has a branch in Dubai. Its biggest client, its biggest business is the gold dealers in Dubai. So a lot of these guys were at the expo. They saw my chart in gold, and everybody had an opinion. And some people they were long gold at 1900. Some of them were long cash 1900, and it was at 16. And they were looking at it, and they said, "This is going to go to 1550." Do you know that feeling when something is going down to $100 and they say, "This is it," and then you add a nice figure and say, "Oh, this is going to 1550." And I said, "I'm sorry, but," and then there was a party, and we went to a yacht in Dubai. It was that night. It was Thursday night. The Bank of Japan intervened that Friday evening, or Friday afternoon, depending on your time. But Thursday night we went, and it was a yacht, and one of the gold dealers was looking at the water. He was looking at the engine of the yacht, and he was looking at the water. And I said, "It's okay. Do not throw yourself out of the water." I said, "I'm going to say something that is so mundane and silly, but look, I'm telling you, silver is still in the upward trend line. If this is any comfort, copper still didn't break, platinum didn't break." And he said, "Really? Is this the difference between funding my account or letting the margin out and stop throwing good money after bad?" Now, one of the important things that is related to my trades of the year is this. 10% is a crucial magnitude, but in what? In what? Now, let me tell you something. I am a gold bull, but I was also proactive. I was short gold, and I'll tell you, and I was short gold just around before the war started, the Hamas-Israel. But there was something interesting. So this is from October. I mean, when I say I was short oil, but I'm a bull, I had longs, but I had sort of a tactical short trades. Pay attention to this chart, ladies and gentlemen. Pay attention to this chart. This chart tells you that the major gains in gold, when gold goes up 10%, and when gold goes up 10% or 12%, it drops from important lows. It happened here, okay? It went up 11 to 12%, and it dropped, it retraced, okay? Look at here. Here, so this is what you call a major low, okay? From here to here, you went 9.6%, and then you dropped, okay? Even this one here. Look at this one. From this low to this high, 10%. And this is, I couldn't expand this and zoom in on it, but you can test it yourself. It goes 10%, it retraces 38, 50, 38%, 40%, and then it drops. But why is this information important to you? Please pay attention. This chart was done in October. So the attacks, the Hamas attacks were, I believe, in the weekend of October 7th. And that's and gold rallied. And so what happened, gold, so this is the time, because this was written on, this was done from an expo in London on October, I don't know, 25th or the 26th, when gold was up 10%. Do you know what happened afterward? Here's what happened. Gold went up 10% and it dropped. Now, here is what is crazy. Do you remember that big spike in gold, which was 2130, 2140, depending on your platform? Okay? That was from this retracing low to up is 10%. And then we dropped. Okay? So this is very important. There was another thing which I forgot to do today, which is there is something called the 13-week cycle. And if you look at the cycles, all the major cycles lasted 12 to 13 weeks, the up cycles. But I'm not going to get into this now because we have a lot to speak about and how I relate Bitcoin to gold. And nobody has ever done. I'll pay you anything you want if you find anything in the internet of how do you look at the relationship between gold and Bitcoin and one of the inflection points. Applying silver signal to gold. So I started to speak about the mint ratio and the gold to silver ratio back in 2010. 2010, do you remember where you were? I was quoted in the Financial Times that I had a piece about the gold to silver ratio, and I even had a view of the day here. Okay, back in the days when I was working for CMC. So, but this is back in the day when I was an analyst and I was just looking relationships. But trade-wise, this is today. So one of the things you want to know whether gold is going to go down or not, obviously you look at the dollar, but looking at DXY is not always good because DXY is biased to the euro dollar because the euro dollar is 57% of the or 67% of the 6 currency basket. So it's biased. That's why you want to look at the CNH and also, but all the gold to silver ratio. So the gold to silver ratio, as long as it is in a downtrend, and DXY is a downtrend, and this is what matters, whether it broke, whether this is false or not, then you are not ready to throw the towels on your long gold. So this chart is the daily, and this is the weekly. So the weekly, it gives you an idea, okay? And like I said, I'm going to show you something like, so for instance, so again, one of my views is one of the things I look at the first thing in the morning is gold to silver ratio. Okay, it is in my, it is here, okay? It's right here. Okay, well, this is one of the things I look at. If it is up, that means it's good for the dollar. And I'm not going to get into, because we don't have much time, this is why I'm on Twitter. This is why one of the webinars that I'm going to be offering for free is I'm going to show you how to trade these things and how you look at them. But right now, I'm not going to explain exactly why gold to silver ratio, when gold silver ratio is inversely related to gold against the dollar, to silver against the dollar, and and it is directly or positively correlated with the dollar. You see it here. Now, so this is it. Now I'm looking at together. Now I know, hey, Ashraf, this is weekly. I can't wait for Boris to tell me about the swing trades, about the scalping. Oh, I missed Kathy. She tells me about the zip trading. But this is too weak. This is weekly. This is too long. Okay. Yeah, you're right. So but first of all, you look at a top-down approach. So you look at a top-down approach, you look at the overall picture. The overall picture, ladies and gentlemen, you see this? June 2022, when that gold dealer was almost stopped out, when he didn't know whether to go bankrupt, whether to borrow money, I don't encourage people to borrow money to trade, but whether to fund or to let it margin out. When he was here, November 2022, I have this anecdote, what I did in October 2022. I'm going to share it with you, and I'm going to tell you when you put your money where your mouth is. But look at this. Look at silver. Silver, we're respecting the lows. DXY was at the high, but then that was the high, and gold to silver ratio. So because here's what you need to know. This is a weekly chart, right? The first low in gold was this, but then it rose and then it dropped again. So it was October, and then it dropped. And it went up, and then it went up, it went down, it went up $50, $40, but then the last low was November. It was around the Federal Reserve meeting, but look at this. Here is what you need to understand. While gold was still testing, embracing the lows, silver said, that's a waste of time. I'm going up. Do you want to know what platinum and copper did? Is this too long term? Okay, let's look at the daily chart. Look at this. Okay, so this is 2023. I don't want to talk about 2022 anymore. I'm talking about 2023. And you see this low here? Remember the pre-war low when gold fell? Look, it respected this low. The low, I know it by heart. It was actually, I made a big mistake, and this is one of the, please, now here comes advice number 53. I told our WhatsApp broadcast group that gold we're shorting and we're testing 1805. We are targeting 1805. Do you know what was the low? It was 1810. It was 1810, and then I got sucker punched, and the war came in, and then it dropped, and I was expecting to go. So do not mix your ego with your forecast. Oh, I usually get it right, 1805, because we had a lot of calls that were so right, like buy the dollar, like when we day trade and we said, well, we're going to 2043, 2044, this is the major resistance that we had. And then when it broke yesterday, we said 2053, 2054, and it hit 2053. So when you get things right, you tend to fall in love with your own, with your own analysis, and he went to 1810 and he never looked back, and it was costly mistake. It was a costly mistake. But look at this. But what gave you the benefit of the doubt that this is really not going to go down? Because silver respected, and let's combine them. Copper is still in an up, is still on a rising trend line. Platinum, rising trend line. Gold is rising trend line. And guess what? This is the XME. This is the miners. When things were going down, it never broke, and now it broke up. So let me go back to why am I doing all of, and so this is what I just showed you. Now let's go combining a few technicals. I'm going to look at the gold to silver ratio, and I'm going to combine a few avenues, different avenues of technical analysis. This is the gold silver ratio. Again, to recapitulate, ladies and gentlemen, the gold to silver ratio, okay, when it goes up, usually the dollar goes up. When it goes down, usually the dollar goes down. Stocks do well, yields usually do well, gold goes up versus the dollar. Again, do not confuse. Gold silver ratio goes up inversely to gold versus the dollar, inversely to silver versus the dollar. Okay, basically because when the market is going up, is the smaller market is the one that moves a lot faster. So you see this. If this is one of your maps, and this is a weekly chart, pay attention. This is today's chart. Basically, if you are, let's say, if you are a dollar bear, or if you want the stock market to push higher, you want this thing to be facing resistance, to be, facing a trend line resistance, not breaking it. But look at this. So I'm going to do a confluence of various technical analysis. Voila. So now you've got the RSI, trend line resistance is still down. This is a weekly. You've got these highs. Some of you may say it's two shoulders. Okay. Call it two shoulders, call it whatever you call it, but markets have memory. This high respected, well, this high, it kind of broke above this high, but on a closing basis, look at it. It is not only bear in mind with it, but people talk about the neckline, but there is something in technical analysis, a lot of people don't pay attention. If this is the head, I call it the bottom of the head. And usually the bottom of the head, not the neckline, not the shoulder, the bottom of the head, usually it is it's a support or resistance. So this is a confluence. If you don't like this school of analysis, guess what? This level is a 50% retracement of this move from this high, 2020 high. Okay, again, for those of you, what do you know? 2020, when markets were damaged, where markets were being destroyed, the dollar was pushing higher, right? And hence gold silver ratio in that famous March 2020, I was in New York actually. I did a video next to the Federal Reserve Bank of New York in that weekend of March 6th. Remember, Boris, I saw you in that expo. And I did a video about why the euro was going.
It was literally like weeks before the pandemic lockdown. Yes.
It was, and it was the Saturday before the Sunday when Saudi Arabia decided not to cut oil. You remember? And then oil crashed, bonds crashed, and it was the famous Monday, Tuesday, the 9th. And I did a video, and I filmed it in English and Arabic next to the Federal Reserve Bank of New York, and saying the euro dollar is 108, and here's why it's going to go towards 119. I never filmed it, I never posted it, but I think it's one of those things maybe. So what's important is that if you know about history, this is your map. So the high gold silver ratio was the high in the dollar, was March 2020, was the spike in dollar yen, it was the plunge in bond prices, it was the soar in yields. But here's what happened. So that was the high. You take from that high to the low, okay? You retrace it, 50%. They respected it. Now, the other thing that you look at is a technical, you can apply technical analysis to commitment of traders report, okay? The speculators activity net longs in the CFTC, and you can see it. In the gold COMEX, net longs, again, what is net long? This is 189. This is 189,000. 189,000, ladies and gentlemen. Boris, do we have 10 minutes?
Yes, we have 10 minutes. You have about 10
okay,
minutes.
so I'm going to accelerate. So basically, I'm just going to accelerate this. So basically, the net longs here also respected the trend line support. The price respected the trend line support. Net long silver respected the trend line support. Let's go quickly. So this is for, yeah, why do I have it twice? Oh, yeah. So basically, just to highlight the trend line. You see that? Now, mastering these intermetals relationship makes the difference between knowing when to let your account be liquidated and throw the towel, and between funding your account. Or again, I'm looking at the worst case scenario, but I'm taking things to extremes because it happened to all of us. Intermetals technicals added copper, platinum. So this is what I just showed you. Don't forget the US dollar. So Kathy talked about the dollar, but basically I talk about the dollar a lot, but this is my original, what brought me to the markets. And this is from a chart from October, and this is a chart today. This is October, this is today. This is from October, this is today. So back in October, the DXY, I identified something. It was the biggest weekly consecutive gains in October in the DXY since 2014. But then I said to myself, wait a minute, 2014, there was a reason why the DXY went up by 13 or 12 consecutive weekly gains. Why? Because Federal Reserve, Fed funds minus ECB rate, the spread, it was up. Because 2014, 2015, the Federal Reserve was the only game in town. They were the only ones who were getting ready to raise. Okay, if you remember, the best time in the market to have made money was selling dollar in 2020 or buying dollar in 2013 and 14, because the Fed was the only one getting ready to, remember tapering? Remember tapering? June 2013, May 2013, and then 2014 they tapered and then they raised rates. While Draghi closed his eyes, he said, I'm going all in, I'm doing QE. That was the best time for you to buy the dollar. But so that was justifiably why the dollar was up. And that's why the spread, Fed funds minus ECB, was up. But when I looked at the chart in October, I said, yes, the reason, because there's so many types of dollar gains. There's so many types of dollar. There's the dollar because of risk off. There's a dollar is rising because of yield differential, because of the growth differential, or because things are really bad everywhere else, or it's because it's a safe trade. So what I was saying, I said, this is not justified because why? Because the spread of the Fed funds minus ECB is down. That is against the US, that is for the US. And then you had gold and gold started to push hard. But here is October and here is today. You see that? Here is today. So this was the bubble of looking at those, 13, 14 consecutive gains. And I said, this should not run because the spread, one of the reasons, because the spread is in the direction of the ECB. But here's what happened. And then gold took off and this guy came down. Now, seasonalities, I'm not going to look into this. We don't have time. I'm not going to look at yield curves, Bitcoin. Now, you need to understand the past. And that's why I'm going to look at some previous charts. You need to understand the past to grasp where you are in the present and to better anticipate the future. So this is a BTC, Bitcoin weekly chart from October 2023. 2023, when it was at 29,000. Why is that? Classical technical analysis is the best in Bitcoin. If you are, again, I don't recommend that I strongly warn you, you do not touch Bitcoin or Ethereum or anything on margin. I don't care. Even 3-to-1, 4-to-1, 5-to-1 margin. I don't care. Even if your account is $500,000 and you are using, 20,000 or 10,000, I wouldn't do it. I've done it and it's not a good thing. Now, I'm sure 80% of the people who are going to listen to this, they said, well, Ashraf, you don't know how much money I'm using. I'm not using. I can do it. That's fine. But stick to this. But classical technical analysis. So this is from October 2023. You can see this chart. Inverted head and shoulder works like a charm. Okay. And again, I'm going to show you guys the way I applied and I used technical analysis, a classical analysis back in October. Okay. And so you basically the distance between the neckline, the head, and you overlay it and so on and so forth, and then you broke it. But there's many things I can add, but I don't want to talk about this. But right now, there's a strong confluence. Again, this is from October 2023, XBT daily, and this is weekly. The confluence is that what you had basically, the confluence was that the 55 was about to go and break above the 200. It was going to be a golden cross. Okay, but the confluence here is that everything is moving in the right direction. Now, Bitcoin assessment. So this chart, how do you make money? Now, I'm going to tell you a small anecdote. My last purchase in gold in Bitcoin was at 45,000. So I was waiting and waiting and waiting. And when it started going up from 15 to 17 to 20 to 35 to 45, some people were tempted to close and then get in and then use the cash and to go in. But no, you don't do that. I bought the miners, and this is something that nobody was talking about. Basically, the miners, there's a 6-to-1 relationship, and as gold went up 160%, the miners were up around 500 to 600%. This is basically now because the miners are down. But I just want to show you something here. So I put in a snapshot of, I started telling our WhatsApp group members, I do a snapshot, I did it back in April 11th, 2023, where I told the group member, why did I go into Riot? Why did I go to Mara? Okay, this was, yeah. And this is important because what we had a high, a temporary high in July in Bitcoin. But we started to buy the miners back in April of last year, and Riot, Marathon, Hot, and then we sold some, and then we went into, and this is, so why is it important for me to stress on this, ladies and gentlemen? Let's look at the psychology of it. You had bought Bitcoin at 50 or 40 or 30, and then you were down, down, down. And when the market was getting ready to your break even, everybody was talking, you know, this is back in June, around here, back in June. But what? We were saying, forget this. Take the others that are cash, you buy them on cash. They are leverage plays because they're mining, but you're buying it on cash. There is no margin call, okay? But they move. When Bitcoin goes 100%, they go 400%, okay? And a lot of our members, they doubled their money and all that. So, but here is what I want to talk about. Now, Bitcoin and gold, I put a piece, you can go to my website and go to October the 29th, and it says why I choose gold versus Bitcoin. You can go to my YouTube videos. The first YouTube video that I did was the one when I was in Madrid, was here, when the ratio, Bitcoin to gold ratio is 16, but then I did one. So if you guys find my explanation very brief, because we don't have much time, please, please, please go to my YouTube channel and look at this. The first part is at 23 minutes. The first 12 minutes is in English, and the second half is in Arabic. And it tells you what's the big deal about $16 gold, Bitcoin to gold ratio. So here we are. Oh, by the way, and my approach about ratios. So this book I wrote in 2007, just pay attention here. So if you look at this, using gold to identify currency leaders. This was written in 2007 during the crisis. I was in New York. Carry trades. This was the first book to talk about risk appetite. It was 2007. Risk appetite, risk on, risk off started in 2005. I wrote about it in 2007. But here's what's important. Tying interest rates to the gold oil ratio. So you can see that I look at gold in ratios, I use that a lot. So let's use it. Let's see how we can use it with Bitcoin. Pay attention to this. How much time do we have? We have another half hour. Okay, just kidding, guys. Okay, so this is Bitcoin, this is Bitcoin gold. The goal of this chart is to show you the following. Please open your eyes. When Bitcoin to gold ratio gets to 16, it is a key inflection point. You either fail or you break. And when you break, you're all out. So here is the example. Pay attention. You see this? So the vertical lines, they align. When we got to the ratio, what did Bitcoin do? So you can align it. So here's what happened. When we first hit 16 in December 2020, this took off. But here's what happened. When we came down in summer 2021, what did the market do? When it saw 16 ratio, it respected it. And then it went back up. Okay. A lot of people said, this is it. Oh my God, this is going back towards 5,000, towards 4,000. But no, and I'll be honest with you. Obviously, I had no idea about the ratio back then. I only started looking at it in July of this year. And I'll tell you why it's important, of last year. So it worked. And once we finally broke the ratio, so look at this. the ratio corresponds with key support, and it respected it. Here, it respected it with key support, but then when you break it, it is a big deal. And you broke it, and it was in the middle of the bear market. Pay attention to this. In March of last year, when we were getting ready to buy Marathon and Riot and all of those, here's what happened. There was an inverted head and shoulder. The target of the inverted head and shoulder, because from 19, okay, so it's 19 plus 10. 15 plus 10 is a 25. 25 plus 10 is 35. 35 was a big resistance. Are we going to break it? Everybody was happy, but guess what? The ratio said, no, sirree, no, not yet. We're not ready to do that. All that excitement of June, July 2023, it failed. Yes, maybe some people said, why do I need to look at the ratio? This was a simple technical analysis. Basically, the target held and we didn't break above it. Fine, but you need more tools. We failed it. But then once we finally tested it and broke it, we went up. We don't have time for this, but what I think, and this is not a trade, but this is an analysis. I do think that a Bitcoin drop to 35,000 to 36,000 is looming, meaning it is close, it is inevitable, it is necessary, and you need to know every Bitcoin gold market, every Bitcoin bull market involved a 30% correction. Some people said, oh, wait a minute, but when something falls 20%, it is a bear market. Not in Bitcoin terms, okay? You need to know that something, and we can talk about what's called the crypto summer, a crypto spring. Last year was a spring, this year was a summer, okay? And in about 2 or 3 weeks' time, Bitcoin may finally see its first ever weekly golden cross. Yes, unless I'm mistaken, but the 55-week moving average has never broken above the 200. Sorry, this is a typo. Has never broken above the 200-week moving average. Okay. For those of you who want to know what ETFs do and gold, here is what happened when the last 3 major gold ETFs were released. Okay. The GLD, it came in here 2004. Actually, gold went down a little bit. I got the order mixed up. It's IAU. The GDX came in before, the IAU came in after. But when each of the other 2 came in, gold dropped, but then it went back up. So, and I think, some people said, well, do you remember when the CME started to trade, Bitcoin in January 2019, that correlated with the drop and everything. But there's many reasons, technical and so on and so forth, why Bitcoin should extend the correction, I think 34 or 36,000. This is a YouTube channel, what I have here. This is my WhatsApp broadcast group. Some of the trades that we have. By the way, just to give you an idea, I just want to show you something. And the WhatsApp broadcast group, people who have access to me, they can get a trade from me 4 o'clock in the morning, and I'll give you this, or 3 o'clock in the morning. I'm not gonna be spamming people. Actually, this is the reason I don't want to do it. Like around the BOJ intervention, when it's at 3, 4 in the morning in London, I don't want to tell people that, because then they're gonna start responding and this. I said, no, don't respond. I'm just telling you this. But I just want to show you this example. So, do you remember what happened 2 nights ago when the United Kingdom and the US decided to have a coordinated attacks? Yes, they were talking about it and so on and so forth. But here is what you need to see, guys. So bear with me a second. So basically, there was a trade. Why is this not moving? Yeah. So. I'm trying to maximize it. Okay, let's try again. So this is what's important, because when you're minding your own business and you're looking at the market, and then you hear headlines and somebody tweets, are you a watcher or are you an actor? Okay, so most of the time you read the news, you scroll down by sometimes expected news. So what happened is that shortly before midnight Thursday, I messaged the WhatsApp broadcast group that I bought US Crude, immediately alerting them. So not only I say, well, there's breaking news. What do you do with it? Sometimes you do something, sometimes you don't do. But what did we decide to do? So I broke the news to them on Twitter. I said, gold up. US UK launches airstrikes on Houthi targets. This was 11:43 p.m. Thursday. So it was around 17 minutes before midnight Friday, right? And I said, I bought a small size US crude oil at 73.40, target 74.80. It hit, it went to 75.20, okay? So you see it, whoever takes it, takes it. Who doesn't take it? Some people said, oh, but you had no stop. If the thing goes against us, then I'll tell you what to do with the stop. But this is what we did. We did in Arabic, we did in English. So basically, if you're a member of the WhatsApp broadcast group, you know, you have access to me 12 hours a day. And it's not for everyone. That's why I didn't want to make it one of the deals, because you have to have at least 1.5 years trading experience. And yeah, and this is basically, this is why.
And that's why I had Ashraf offer a free private webinar to kind of, you know, walk you through and explain his process. You can see analysis by Ashraf is like getting hit by a hurricane, right? There's just so much information, so much data, so many ideas. But out of those ideas come out some incredibly brilliant insights. One of them, of course, the Bitcoin gold ratio and how strong it is. The most interesting idea that's coming out right now, I have so many people on YouTube actually messaging me, how come if this is so good for Bitcoin, how come it dropped like from 46 to 42? And Ashraf addressed this right now by basically telling you, not only is it normal that it dropped post ETF news, but he actually thinks it will drop further, precisely because it needs to correct after these rallies. It means but it doesn't mean it's a sell. It actually means it's going to be a looming buy, as you say, as it comes into those support levels. So
can I just say one more thing, please?
Sure.
Because I don't want to be, you know, we don't want to be accused of misleading people. Oh, Ashraf said he's going to talk about crypto. But so here's the thing about crypto. Maybe it's this question, Ashraf, when is a good time to buy the other thing, the smaller thing? Okay, so I will just be honest with you. 87% of my crypto holding is in Bitcoin. Around 10% is in miners, and the rest is in Solana and Near and EAR. But here is the thing: I think that I don't want to leave all my money in these miners. I want to take some of that and put it with MicroStrategy, MSTR, and maybe Coinbase. But that's when we get the drop. So that's one thing. But two things, Ashraf, what about the crypto? What about the altcoins? When is alt seasons? Alt seasons happens, and again, I don't know about this, but we can refine this more. Please pay attention. Alt season usually, well, not usually because we don't have that much data, but the last time alt season took off, when the Fed started to cut interest rates, which was in summer 2019. So in that 2018, so Bitcoin started to rise, and then what we had, and then the Bitcoin dominance peaked and it dropped, and then the altcoins started to take over. But please, you know, people say, what about Dogecoin? I hang up. I turn off the TV. I turn off the phone. Right. I said, you know, forget about it. Solana, you know, Near, maybe Cardano, but it is Bitcoin and maybe Ethereum. Ethereum is solid. Everybody's talking about the upcoming ETF of Ethereum in 6 to 7 months. But please do not get complacent, because listen, Gary Gensler was the deciding factor in the SEC. He's the one who decided whether they approve it. Right. It was a 3-2-2. Right. And so be careful. Don't get so complacent.
Anyways, the thing is that's interesting is that if you want to express your views on not just Bitcoin, but all the altcoins, the only broker in the world that has 300 different crypto pairs is ACAP, and both Ashraf and I, of course, are partners with ACAP, and that's one of the things that I absolutely love about the fact that I have so many great traders here. As I said, you want to talk to Ashraf privately in his webinar, all you have to do is simply deposit $100. That is less than the brunch I'm going to have at my New York City diner after this, okay? That is literally throwaway money. I did this precisely because I want everybody to have access to some of the best trade ideas. So if you are a global citizen, not a US citizen, if you're a US citizen, message me, I'll talk to you about that later. But if anywhere else outside of the US, you can open an account with ACAP, please do so, get access to Ashraf. Best idea coming out of this particular session, that Bitcoin is a sell and then a buy. That I think is really, really interesting for those of you who are trading, and you can obviously trade that on ACAP with great ease.
And just one thing, because sorry, I did not actually put in a PowerPoint slide that says here are the top here are the top trades of 2024. You know, because people are going to say, what is this? You know, this is a bait and switch. And but I think one of them is the 10% extension of gold.
Yes, yes,
So
that was my
if
second.
you see from a major low, you don't buy it and then we can calculate it. Where do we do it? That's one thing.
That was another really, really interesting idea, and I actually snapshot that picture and I posted on Twitter already because I thought that was a really, really brilliant way. As you can see, what makes Ashraf so unique and so interesting is how he's able to bring in all sorts of other variables to weigh on the trades. There's many forces that we don't see that drive trades, and Ashraf is very good at uncovering those forces. So thank you, my friend. Again, as always, great presentation. And
Sorry, can I have just one last thing?
Sure.
Sorry, one last thing, please. The TLT, this is for anybody who trades anything. As you know, the cost of money is important. The TLT, which is the inverse of the yield, okay?
Right.
If you look at the weekly, it is suggesting we might be having a giant inverted head and shoulder.
Right.
What that means if the TLT goes up, yields could be going down. Now, I don't want to be accused of a deflationista or an inflationista. I know this is like a big argument, but
Right.
if the TLT is showing you this, if this is the left shoulder, if this is the head, if
Right.
this is going to go down towards the right shoulder, that means
Right.
yields will have one big run up again, and then we're going to break. And if this happens, this could set up one of those big rallies. And usually in election years, the major rallies are after November, but we may have something before the summer.
No, indeed. Thank you so much, Ashraf.
Sorry, guys.
We're going to move the show on because I need to bring in Nick, who is going to talk about my favorite subject, which is equities. Nick, where are you? Let me see if I can.
Thanks, guys.
Thank you so much, Ashraf. We'll see you later. Thank you, my friend.
Have a good one.
We're gonna let Nick come online. He's gonna just open up his mic and get his camera on board. I see him over there. I see him pulling up. Hey, Nick, how are you? Okay, we don't hear your voice. Yeah, I don't hear you. Let's make sure that you have your mic settings correct.
Can you hear me now?
There we go. Yes, I hear you now.
Right, cool.
Sound like the
Awesome.
Verizon ad. Can you hear me now? I can hear you now.
Yes. Wow, that was awesome. Just listening to Ashraf, it's a tough one to follow. I'm not gonna lie.
No. I want to introduce everybody for just a second to Nick Sayek, who runs an incredibly interesting and very broad-based service with Edgefinder. But what I think is fascinating is Nick has actually sort of taken this incredibly interesting software tool that feeds everything, fundamentals, technicals, everything else, and distills it into a really clean, crisp picture of trading signals all across the variety of instruments. But today specifically, what I really wanted to talk to him about was all the equity indices, Dow, NASDAQ, S&P, Russell, because as you know, I'm an inveterate stock market junkie. I day trade every single day in BK. And that is sort of my bailiwick. And I'm dying to sort of see what he thinks the trend will be in 2024. I mean, nobody called the stock market correctly in 2023. And I wonder if nobody's going to call it again correctly in 2024. The complacency trade right now is that, longer forever. That what we saw last year, we're going to continue going forward. I think it's going to be a little bit of a different story. So without much ado, I'm going to turn my mic off, my camera off, and I'm going to give Nick the screen. Let me just make you a presenter.
Okay.
Make sure we get your screen. Let's test your screen.
All right. Let me see. Can you see? What do you see right now? Do you see?
I see.
Hold on.
I just saw the A1 for a second. Trading company. Your desktop.
Okay.
We see your desktop. I see your slides presentation.
Okay, cool. Okay, so if I go full screen, you're good here?
Full screen, you're good. Nick is clearly the fan of the dark mode versus the light mode.
I am. I like my dark. Us traders, we have a long horizon. If you're going to be trading for decades, I'm a fan of the light, the easier on the eye stuff. So we can.
I agree. As you can see, I've turned my eyes out with the light mode. So I will let Nick take the mic. Thank you so much, guys, and keep asking questions, and I'll answer them as best as I can. Go ahead, Nick. It's all yours.
Awesome. Thanks, Boris. Yeah, and guys, I've been listening along with you for the last hour or so, 2 hours. What a remarkable event we've got going here with Kathy taking the lead on currencies and the macro, and then Ashraf's concepts on gold. Absolutely brilliant just to listen to everybody. And like I said, a tough one to follow those two, but I'm going to do my best here to kind of give you a little bit of an outlook, a little bit of a foreshadowing of the indices side of things. Now, of course, if you're an 8-cap client, you already know you can trade like anything under the sun in 8-cap. You can trade all the indices, you can trade cryptos, gold. So I imagine after today's presentations, you'll have all sorts of different things that you might want to look into. Today, again, my goal is to give you an outlook on the indices, and I'm really excited to do that. Boris mentioned something that's going to be perfect to kick us off here. He mentioned some of the recent history. Markets have been a wild place ever since 2020. And a quick way to look at that, I don't have the chart pulled up, but the VIX would tell you all you need to know. 2019, 2018, you had just this super low volatility era, followed by 2020, which completely changed the landscape and perhaps set the precedent for this decade. But we'll get into that in a moment. I think that what is interesting here is just to do a little bit of history lessons. 2021, some of you have probably been trading since then. Some of you may not have been trading during that time, but if you haven't, it was a crazy time. Everybody was talking about crypto. Everybody was talking about IPOs left, right, and center. The ARK Invest had its heyday, right? It's flying too close to the sun moment. And the point is, markets were incredibly enthusiastic and excited about everything. And as Boris mentioned, they got it wrong, right? They were so optimistic post all of this stimulus, and 2022 came along and absolutely was very different. Here's the point that I want to get at. We had firms predicting this is going into 2022, and you'll see a pattern here that will emerge in just a moment to Boris's point that he kind of foreshadowed for us. Analysts, firms were expecting into the 5,000s, like upper 4,000s. I'm talking about the S&P 500, by the way, your SPX. People were thinking the S&P would get up to the 4,800s, 4,900s, 5,000s. We're not even there today, by the way. And this was the forecast going into 2022. And if you remember, 2022 was a tough year. We saw a correction that was pretty substantial, and noticeably, it was the tech area of the market that got hit the hardest. What you've got on your screen right now is you've got in orange, this is the Dow, in the teal color there in the middle, that's your S&P 500, and you've got the white line representing the NASDAQ. The point I'm trying to get at here is 2022. Remember how optimistic everyone, people calling for massive gains in the stock market following the 2020 and the 2021 just super bull moment? Well, it was the exact opposite. Everybody got so enthusiastic, so bullish, and the NASDAQ dropped 30+%. It was a massive slide to the downside, as I like to say. And what happened? Well, sentiment, again, incredibly bullish going into 2022. And you might be asking, Nick, what does this have to do with 2024? And I can promise you everything, because markets and understanding your history is really important. I have this, I'm a history nerd. I love learning about history. I love watching documentaries, and it's perfect for what I do as a career, which is markets and commenting and trading and all of that sort of stuff. History is so important to understanding certain environments. If you understand the 90s and I'll get into all that. You can understand your history. It's very important for understanding today. Anyways, what happened? Well, stimulus was everywhere, right? Remember, the Fed was printing money and pumping it into the system, and it wasn't just the Fed, it was other places and areas of the world doing the same thing. So there was this money flood that came into the system. Everyone has probably seen the money supply chart that went parabolic during this period. Ashraf pointed to it as why, or one of the reasons why gold exploded during this time. And although my topic isn't gold, it does also help to mention that during that 2020 run-up, we had a huge spike in the money supply, but we also had massive fears of recession. You link those two things, that's gold's Super Bowl era. That's why gold outperformed, by the way, in that year, at least from what I can understand, from my opinion. 2021 was a year of many IPOs and peak optimism. However, what happened? Recession fears started to spike once that inflation problem was less transitory than everyone was expecting because of what Jerome Powell was saying. The Fed was trying to lead the data, and what we saw was an aggressive downside move with the NASDAQ, specifically tech stocks, right, down tremendously. A lot of those high-flying names that everybody loved in 2020 and 2021, like, you know, Shopify and Spotify and all those, not yet profitable businesses that were flying high, they got absolutely crushed. Many of them down 70+%. But again, we're talking indices here, so let's keep going with this topic for a moment. We're talking about 2023 now, last year, right? Really, really interesting year to look at this. Let's look at sentiment again. Let's repeat this process, and you might see a pattern here that I'm trying to get to. All the firms were super bearish. After 2022 absolutely battered the stock market, well, everybody thought there was pretty much going to be mild to no gains. You could see the median target as of the end of 2022 was a 3.9% gain. My point is, markets were spooked and the sentiment became super bearish, especially for tech stocks. And what happened? Well, 2023 was a remarkable year. And if you were long tech stocks, then you were probably pretty happy, because look at what happened to the NASDAQ, up 50+%. The S&P had a nice gain, and the Dow actually was the laggard. So completely flipped, except for the S&P 500, which stayed in the middle there, which is something worth noting. And we might discuss that a little bit more in the later parts of this presentation. But I'll try and keep it quick, because we'll try and move on to 2024 in just a second. Sentiment has been really bearish going into 2023, right? Or it was very bearish going into 2023. The consensus was that a recession was basically certain. Economists everywhere basically were expecting a slowing in GDP and that company earnings would suffer. Company earnings did struggle a little bit, but the economy weathered the storm pretty well. Unemployment remained low, and by the way, has continued to remain low, which has led to the consumer staying strong. Another side factor, and this is a little bit more of an advanced topic, but a lot of people locked in interest rates before the interest rates went crazy high, right? So a lot of people bought houses at much lower interest rates, and so they weren't as affected. So the consumer stayed in there in 2023, as they say. Like they didn't die off. People thought the consumer was going to completely have no money whatsoever. And while I'm sure all of us, especially anyone in a country where inflation has been high or is still high, the pains, but it was a remarkable difference from what was expected. People thought the consumer was just going to completely collapse, and we didn't quite get that. And company earnings also were better than expected, noticeably in the big Mag 7. Everyone kept talking about the Magnificent 7 leading the market, carrying the whole market on its back, and it did that for a lot of 2023. Stocks rallied huge, with the NASDAQ up nearly 50%. So what about 2024? What is sentiment now? What do people think the markets are going to do in 2024? Well, let's look at some current sentiment. And this is where Boris gave me a lot of hype about our software. My company, A1 Trading, we build tools for traders. That is pretty much what we do. This is our flagship tool, the Edgefinder. It helps us to look at investor sentiment. And I think it's an interesting picture that we'll get into. So I'd like to start just real quick looking at the AAII Investor Sentiment Survey. Now, this is a pretty cool survey. It just surveys a ton of investors, a ton of traders, and asks them essentially, what do you think the market's going to do in 6 months? Is it bullish? Is it bearish? And again, I think this is a pretty useful report as we're trying to forecast for 2024, which, as you know, if you've been trading for any amount of time, forecasting is difficult. What we're doing here, in my view, is less sort of prediction heavy and forecast heavy, but more so kind of reacting to what we see going on and trying to play our cards well. Anyways, let's get into the investor sentiment here real quick, keeping it simple. When this reading, I view this as somewhat of a contrarian indicator. When people get way too bearish or way too bullish, that's a read. And what you can notice here is that, you go back to the end of October, and I just want to pat myself on the back for a second. Going into September and October, I was really bullish in the markets, and I'll share some insight on that in a moment and why that's relevant to 2024. I was really bullish. I was really early to the trade. I took a couple losses trying to find, a breakout point on the NASDAQ and the S&P. But I was early. But what I saw was that the investor sentiment was getting increasingly bearish. And when it gets really, really bullish or really, really bearish, it can be an interesting signal. So sure enough, investor sentiment absolutely peaked out on its bearish side right near the lows, right before that massive end of year fourth quarter rally that we saw in November and December. So with full transparency, I caught all of that November move, but I also caught some of the downside waiting for it to happen. So I didn't play it perfectly, but my point is watching sentiment can give you a nice read on what the market feels. And so when we take a look at where we currently are going into the turn of the year, right, we're here in January, sentiment is bullish, but it's not screamingly bullish. So I think, you know, keeping an eye on this will be useful, even if you are bullish, which I'll go ahead and I'll oust myself. I am bullish on the year, and we'll get more into that in just a moment. But I think keeping an eye on sentiment can be an incredibly useful way to play a market when it does become too stretched, when it does become, and that could go either way, either looking for bullish setups, or if you are bullish already and you're in trades, I use this as an opportunity to either take profits or to trail a stop or to trim trades, whatever you're looking to do. But I think this is a useful indicator to keep an eye on. Another thing that I want to show you guys here while we're on the subject of sentiment, I view this as another really key one. This is the COT report, and Ashraf mentioned it. Actually, we'll pull this up. I believe, yeah, I looked at gold while he was talking, just to point out, he was very correct in pointing out that this move here that has happened, you can see the blue line represents the net COT positioning from the non-commercial traders. It's been riding this trend. Meanwhile, retail trading has been very bearish on gold. And again, gold's not my subject. It's one that I love, but let me quickly move away from it because I don't want to get in trouble here. Indices is the topic of the day. What you can see here is here's the US 30. And look at this, guys. This market rally, for people who are saying, you know, hey, this is not real and it's all going to crash and come crumbling down, what I would say is that, you know, the COT report would suggest, and so would the Fed's 3 rate cuts, that we have a pretty solid basis for why the stock market could be set to break out. We've also been in a multi-year sideways move. So the longer you stay in a sideways move, if you look historically, that typically when it does break out, it has more room to kind of make a move higher, right? If it's been ranging for some time, you know, another side study is you could actually even adjust for inflation, the S&P and the NASDAQ, and we're not quite at the highs yet. So it's another thing to consider. We have room, I think, to continue, and we'll talk more about that. But again, investor sentiment here, retail traders seem to be more on the bearish side. Meanwhile, institutional money is following this trend. So that gives me a little bit of confidence as we turn into the new year. Again, these tools, stay tuned to the end of this. As Boris mentioned, we are going to be handing out free access to this for anybody who signs up with an 8cap account. If you'd like to play with our software, trust me, I do it all day long. It's a lot of fun, and we'd love to have more people checking it out totally for free. So that will be coming later. Let me get back to my presentation here because, again, I've got some stuff I want to show you. Hopefully, what you take away from my presentation is data-centric analysis is huge for me, and I think that it might also be helpful in all of our analysis of the new year. So here's a couple things to keep an eye on the NASDAQ. I want to defend why I was early to the trade. Well, pre-election year, which was 2023, last year, right, was the end of kind of this first term that Joe Biden is serving here in the US. An election is a theme that Kathy spoke about earlier in the presentations. If you missed it, then you missed a good one. And there may be a way to go watch it back, I'm not sure. But one thing to keep in mind is that right now, this is the end of a presidential term, and we're going into election season this year, right? Last year, part of the reason I was so bullish was because of that. It was, you can see here in the kind of purple, dark blue color, that is the sort of move here prior to the S&P 500 during a year before an election. So historically, a really strong period. And we can see if there's any trends that might help us with 2024. And okay, so this is election year seasonality, and seasonality is a big one that I find to be very, very useful as well. We'll discuss that here a little bit. So what we're seeing here is that if you actually take a look at this year, we're going into a presidential election year, right? So this is a presidential election year, not a pre-election year. So 2024, we are now in election territory. And also, to Kathy's point earlier, she mentioned that this is mostly an end of year, perhaps even 2025 trade to consider, but something you should consider for now is that if you're bullish on indices, during this election industry, or if you're bearish, this first part of the year is expected, historically speaking, to be a bit rocky. You can see here is all the other years, right? Not election years, in the teal color, trending well in the first half of the year and throughout, most of the year, except for that kind of lull, second half, a little bit beginning. However, you take a look at this election year, you can see there's a rocky start usually. So I think that that's worth noting. I'm not necessarily, yes, Boris.
Sorry, I'm just going to chime in on this because it's such an interesting point from a trading degenerate like myself who only day trades. If you notice something about equities since the start of the year, the last hour of the day, which used to be incredibly trendy, very, very volatile, literally dead money. I have never seen last hour of the day be so dead money. And that really speaks to this whole notion of choppy seasonality. So I'll just, that's my 2 cents on all of this. Thanks, and I'll let you continue.
Well, and I'm really glad you said that, Boris, because if you're somebody who's listening to this, I want to try and speak to the fellow day traders like yourself, Boris. I imagine that a lot of day traders might be saying, well, this is fun information and this is cool information, but I'm not a swing trader, I'm not an investor, I'm a day trader. So how is this relevant to me? Boris pointed something out that is super relevant. Let me also oust myself. I'm a short-term swing trader. So this data that I'm showing you, I'm not just showing it for fun. This stuff is still relevant to you, even if you are scalping, even if you're day trading. Why? Because of what Boris just said, right? If you understand the bigger picture, you can take it with you down to the lower time frames. One thing, I'm a fundamentalist, I'm a data guy. It triggers me to no end when day traders completely dismiss fundamentals because they say, oh, yeah, that doesn't matter to me. I just look at the charts. And while I do understand, I'm not discrediting technicals. I think that there are some wonderful other panelists here today that are going to spend more time on technicals, as we saw with Ashraf and stuff. That stuff is super valuable too. But I think that dismissing some of this data that we can just straight up see with our eyes that has historically played out well is huge for day traders, for scalpers, for swing traders, and investors. It is relevant to all of us, and that's why we're doing this. So let's keep going. Again, thanks, Boris, for that. That's a good point. Presidential cycle. Again, I keep going on this topic because it is the theme of this year. Not just yet, but I can promise you that conversations about politics are going to be everywhere. I don't really care too much about politics, but I do care immensely about markets. And politics just happen to be a huge driver of markets. I'm not saying like who is going to win or what my opinions are. I'm saying the market will be watching what's playing out, but just the very nature of it being an election year has some people on edge. I like to say in the US, during like Thanksgiving, right? That's a gathering point for United States people every year. And during that time, during election years, it's always an interesting time because everyone's kind of, hyped up about what they think in the politics side of things. But the point is, it carries over to markets. And that's why seasonality and these observable trends are so important to keep in mind. Again, fourth presidential term, that was fourth year of a presidential term, that was 2023, right? So, well, I'm sorry, that's sort of what we're getting into is the end of a presidential term. And the point that I'm trying to make with that is that when you have that end, if you were running for president or if I was running for president, it doesn't matter if you're Democrat, Republican, whatever, you want to look good going into your next election. That's just human. That's just, hey, we need to finish the project. Doesn't matter who you are or what your opinions are. So what happens is typically we see a strong end of the period. And so we're kind of still in that game. And so that's why, another reason why I think being outright bearish here this year, to me, seems like a hard trade because you have interest rates expected to be cut. Sure, is the market perhaps a little bit greedy with their idea of how many rate cuts are coming? Maybe. The point is, though, rate cuts are coming. That fear of infinite rate hikes is right now off the table, could creep back in, but that's not the consensus. I'm trying to stay reactive with my trading. We're in a end of a presidential term. We see, again, rate cuts are expected, and we see earnings that are doing okay. All those things point me to be generally bearish, but we'll get more into that in a moment. I wanted to mention just my thought process there with the S&P. So I mentioned that I caught the end of year rally on the S&P, and I wanted to make a point here. I pretty much was bullish from the far left-hand side of the screen to the far right-hand side of the screen. I took several trades along the way. So the reason I'm pointing that out is my idea fundamentally was right, but I was early to the trade. So you can see if you had just bought the left-hand side of the screen, you would have experienced some drawdown before markets rallied. I was in and out of this market. I won't get too far into the specific entries and exits, but I caught that low there at the bottom almost perfectly once it started to break out. Again, full transparency, I also was incorrect several times before that. I just wanted to point that out because when you have these theories, how do they actually manifest into trades? Because a lot of times you'll hear people talk about something like this and say, well, that's great, but how do you actually execute? Well, I want to just point out that I was right about this fundamentally. That end of the year run up, I thought was, partially due to the rate cuts, but also partially due to the election cycle, and that was my bullish narrative. Also, seasonally, the end of the year is historically a really good time for the S&P 500. So that was my basis. I took that trade, and again, I think we can use those same tools to try and capture opportunities this year. So I want to talk a little bit about this year and the bull bear case. There is a good argument for both sides, and I think that it's pretty much always that case is actually a healthy environment. What you don't want is, again, going back to that sentiment that we discussed earlier, you don't want the market to just be all on one side of the bench, because as you can imagine, if everybody's sitting on one side of the bench is going to fall over, right? And that's where you don't want to be overly bullish or overly bearish. I actually like to see a market environment where there's a good case for both, because what that tells you is there's upside to if you're right. If everyone is already bullish and then you buy, you have to ask, who's buying from me? Who's buying behind me? You need a loser in order to make money in markets. That's just the reality. You need somebody to take a fall. And if everybody is already on that trade, you have to ask yourself what's going next. So I do actually want to see a little bit of the stagnation that we've seen recently in markets. I'm looking for some pullbacks, and we'll talk about that in a moment. Anyways, the bull case and the bear case. Let's do optimism first. The bull case would be that the economy and consumer stays strong. And to the credit and recent track record of the economy and the consumer, it's been much more impressive, much more resilient than many economists thought would be. And so right now, it does kind of bode well for a potential new year. Are we going to see earnings and the stock market hold up because the economy and consumer are staying relatively strong? If inflation continues to cool, I think that is, of course, going to be a bull case, but it's not the only bull case, right? I think inflation cooling could lead to a weaker dollar, at least for a portion of this year. As Kathy mentioned in her presentation earlier, she mentioned that the dollar could potentially be weak for some time as this period it goes on, but then perhaps it changes and the narrative changes. I think at the end of the day, stocks and equities, they generally trade around earnings, right? If we do see earnings stay relatively strong this year, they could come out of that earnings recession. It does look like that is going to be the case. That bodes well for stocks as well. Again, 3 times plus is what the Fed is. Well, the Fed is signaling 3. The market thinks it's going to be more than that in terms of rate cuts. Remember, rate cuts, that takes more pressure off of borrowers and allows money to flow through the system a little bit easier. If companies and individuals can essentially borrow money for cheaper, they're going to put that into all sorts of stimulating activity, whether that be buying homes, whether that be borrowing for a business to offer new areas of R&D or growth or whatever. Money flowing through the system helps equities to perform. So if we do see that, if we see a lot of that, depends what we see from the Fed. But again, Fed has signaled 3, market's thinking more like 7. Maybe the answer, maybe the truth is somewhere in between. We'll see. Or maybe the Fed is just telling the truth and it's going to be 3, which in that case, again, means probably a decent year for stocks, but no 2023 type environment where we just see a massive run up. Geopolitics, this is the other one. This is always the tail end risk whenever you talk about equities, and also for gold, the tail end risk to the downside, I guess, the upside potential. If geopolitics stay calm, relatively calm, there's always turmoil in the world, but if there is sort of a more passive, more calm year, that's going to be okay for stocks and allows them to do just fine. Now the bear case, if the economy lags and if we see the effects of all those rate hikes start to come into play, and we also see potentially unemployment start to really ramp up more than forecasts are for, I think there's like an expectation of like a 4% unemployment rate. If that surprises in a negative way, that could really seriously change the landscape. And you also have that, of course, would probably lead to earnings disappointment. And oftentimes with GDP numbers, if there's a lag in GDP, that can seriously impact corporate earnings. Anyways, there's also the concept of inflation potentially ramping up again, and we don't, there's that theory here. I think I'm not exactly sure which time in history it was, but there was a period of time in which inflation came down meaningfully and then ramped back up. And I don't think it's one time. There's several instances of this happening. Right now, the market is very positioned for inflation to keep cooling calmly. Well, we just had the CPI numbers and they were hotter than expected, but I think you need, again, for this bear case to really materialize, you probably need a couple hot inflation readings and then you start looking at it differently. I don't necessarily think that, Thursday and Friday's inflationary numbers really changed the landscape. So as you can probably imagine, just by my speak overall here, I'm leaning to the left-hand side of the screen. I'm more on the bull camp. Geopolitical tensions, if they do escalate, again, this is not something I think is forecastable, right? If something massively escalates in the Middle East, if something escalates with China, Taiwan, if something changes or escalates with the Ukraine and Russia situation, those are all potential negative catalysts that could, again, scare the market, could change the landscape a little bit. But again, I think I lean more to the left-hand side of this screen because that's kind of the consensus right now. And I don't necessarily think it's entirely wrong to keep an eye on the consensus, but also not to just blindly follow it. So I mentioned earlier that if rate cuts are expected to be 3 times, at least from the Fed's standpoint, but then 7 from the market, I think you can get yourself into trouble just being too consensus heavy and just saying, oh yeah, it's going to be 7, because any slight disappointment could change that picture completely. So again, I made this is my personal opinion. Unless conditions change, it does seem right now like a soft landing is possible this year. Now, what that means for indices is an interesting topic as well, because a soft landing, there's all different types of landings. This idea that you can keep the economy relatively stable while also seeing inflation come down to a moderate level and not have a massive spike in unemployment. A hard landing in sort of comparison would be you get a massive uptick in unemployment, and we really struggle to get that inflation reading down meaningfully, and corporate earnings go to nothing, right? That's more of a hard landing. Right now, it does seem like a soft landing is possible. Unemployment has been impressively low, and I don't see anything on the horizon. You're seeing a slight uptick in layoffs, but I don't see anything right now that would tell me, oh, massive unemployment is coming. And so again, I trade what I see as a trader. I'm not a magician. I like to say this often in my live streams and in my videos. As a trader, you're just a probabilities-based educated guesser. You're not a magician. You're not a crystal ball holder. You're not a forecaster. Your job as a trader is to place trades that, again, manage risk properly, and you take into account the evidence for both sides, the bull-bear case, and you basically make educated guesses. That's what a trader is, with responsible risk management behind it. The interest rates look likely to come down. I mean, that is consensus, and it seems like we are seeing overall the labor market is cooling. It's not too hot. You're seeing inflation readings overall come down, maybe not so much on Thursday, but overall we're still seeing inflation. We're not at 9% like we were, right? We're seeing some progress in the inflation area. But here's the thing, okay? The market is positioned, the consensus is for a perfect soft landing, meaning inflation is going to continue to moderate with no issues, and there's going to be 7 rate cuts and all that sort of thing for 2024. I think where you get into trouble is just blindly thinking that and saying, oh, there's just no downside. So where does that bring me? Well, I think I am bullish. However, I think it's not going to be a repeat of 2023. And I'll talk about this a little bit. When 2023 happened, we go back to the beginning of this presentation, I discussed how everybody was positioned for a massive, recession period. People were super scared for what was going to be 2023. when we go into 2024, I don't have the chart, and I apologize for not having it. I'm not sure where it went. I think I might have deleted the slide. There was basically a mixed consensus for 2024. So where does that leave you? If consensus is not so extreme in terms of bank forecasts, if it's not so extreme, where does that leave you? Well, maybe you're less likely to get something where if everybody is leaning on one side of the trade, the unwinding of that trade creates massive moves like 2023, like 50% on the NASDAQ. The reason I don't think we get another 2023 NASDAQ massive run like that is because the VIX has come down a lot. We're seeing some overall kind of a trend towards normalcy. And in normal market environments, the market doesn't go up 50% in a year, right, for the NASDAQ. It typically moves like 8%. So this year, when we discuss the different indices, which areas do you like? I'll give you my opinion. I like that middle of the line, the S&P 500. I think there's going to be increased participation of other areas of the market. I don't think that it's just going to be a tech, AI run forever. I think that there could be at some point this year some corrective move in terms of the 7 rate cuts perfect landing idea. If that it's so fragile that during that time you may see tech kind of rebalance a little bit. And again, I think that there's room for other areas, whether that be healthcare, whether that be energy, or again, other areas of the market to participate. And that's why I generally favor the S&P 500, but I don't think you're going to have just this smooth as butter, especially with that first half of the year being it's an election year. I am bullish, but I'm cautiously bullish. That's the best way I know how to explain it, in terms of this year. So, Boris, how did I do? You're the indices guy too.
I think I think you're correct. I think there's a big tug of war now between people who are calling sort of for an early collapse of equities. I see a lot of guys who I respect, but who are also, by the way, looking at a lot of the sentiment data. Their data is a little bit different. I was going to ask you, some of the people like Jason Shapiro, for example, who is somebody I've had on the show. He does a lot of COT data. He's arguing that the market is way too long, and that not the specs, but the wholesalers are actually short the market, so therefore the market is about to fall. I don't see that. What I was going to say though is, what's great, what I want people to see is the Edgefinder tool that you were just showcasing. I don't know if you can pull it up a little bit more, because I don't think people can really appreciate first of all, the beautiful level of simplicity you've been able to create. You have to understand how complex all of this data is to be able to pull it all into a single panel dashboard like this.
And the COT report is a terribly ugly text file. So. Oh
God, I mean, anybody who's ever looked at it, it's like being in the DMV. It's literally the worst of government.
Oh, absolutely.
But what he has done, of course, here is to be able to put everything at your fingertips. Now, what I just want people to understand, that this is a tool that doesn't even, you can't even get this except for an annual subscription of more than $1,000, right? And I was able to convince Nick to give this to you guys for free for a whole month to be able to test drive this thing. It literally is better than a Bloomberg terminal, in my opinion, in terms of retail trading, because it consolidates huge amounts of both sentiment, fundamental, and technical data to give you lots and lots of breakout ideas, trade ideas, all sorts of stuff. Maybe you could just run through a little bit of the panel, because I just want people to understand the data-rich aspect of this and how easy and intuitive it is to use. And literally, all you need to do is open up a tiny ACAP account in order to be able to fully use it to your heart's content.
Well, I want to say too, Boris, that you mentioned the Bloomberg terminal. One kind of gap in the market is that I know that a lot of our listeners, obviously, I appreciate those of you who are not necessarily indices traders, that we know there's a lot of FX traders, there's a lot of commodities traders. The Bloomberg terminal is really built specifically for equities. But for my FX friends, the Edgefinder, its roots are in actually currencies. However, we've expanded it to commodities, and again, you can select anything you want here. It is tailored specifically for people who are 8-cap type clients, people who can trade, CFDs and FX and that sort of thing. And as you mentioned, there is a ton of data. We are, Boris and I, we've both been working alongside ACAP for a long time. There is no company, I will say, obviously they have a wonderful platform and they have a wonderful thing, but I don't know any other platform that does these sorts of events and this much value packed into one event. So absolutely.
No, and not only that, but like, you know, the reason why we all like ACAP as a broker is precisely because literally every product that Nick has on his Edgefinder platform is tradable on ACAP. Every one of these things is tradable, which is really, really beautiful because, you know, you want to have full choice, complete choice of trades and structures and instruments. I was going to ask you one thing. So you sort of bullish S&P relative to NAS, which I agree. But in the CFD world, most people trade US 30. I wonder, you know, if your bullish tilt, you know, move can be applied to US 30 as easily as it does to the S&P. Like, do you think the Dow is going to outperform NASDAQ this year?
So that's a good question. So I think, you know, staying true to the tools that we use, the S&P and the Dow are getting a nice bullish reading on the Edgefinder.
Yeah.
And to kind of clarify this, you know, this is not a black box thing. We've tried to orient the Edgefinder to be pretty recognizable. You know, you don't have to have a PhD to understand it. The idea is pretty simple. It's looking at all of these different metrics and it's assigning a score: bullish, bearish, higher number, lower number, and it's saying, what's the read? And right now, I mentioned, you know, the COT. I view that as not a contrarian indicator. I know some people like to look at it, and I would say, you know, yes, if it gets overly positioned, that is worth looking at. But generally speaking, a money flow from professionals in a certain direction, I view as actually a consensus that's okay to look at. Anyways, you have all these different metrics. We look at you know, the economic figures. These are your GDPs and your PMIs and how they are currently reading and how they impact the scoring of each asset. Again, you mentioned it, Boris, but I just want to reiterate to everyone in the audience, as kind of a thank you to Boris and ACAP for putting on this event. We're giving out 30 days access.
As we say in New York, he's a mensch to do this, because this is really, you know, an unbelievably valuable tool that he's just letting you guys test drive, not for a day, not for 3 days, not for a week, but really for a full month, which is amazing. So I hope literally this reason alone is to be able to take care of the deal, in addition to all the stuff that I have everybody else giving away. But this is literally one of my favorite things in the world, to be able to look at this stuff. And I'll tell you what, even though he says this is not, you know, he's tried to make it very, very simple, you have to understand that all the hedge funds in the world with their macroeconomists and when they talk about macro models, that is literally what they do. He's taken the macro model that the professional hedge fund traders do and made it very accessible to the retail trader, putting you essentially on the level playing field with all of those guys and be able to call and make really, really good trade ideas off of that stuff. So I can't say, you know, good enough things about all of this. As you can see, it, you know, it's a web browser, and yet it has so much power to be able to make interesting and very, very unique trade ideas out of it.
Yeah, absolutely. And if there's anybody who has questions, again, we'll be happy to answer them, whether they're right now or you can hit us up on our website, a1trading.com. But again, I would highly encourage you to take it for a test drive, literally open up $100, even if you put $0 beyond that, try out our software, and not to mention all the other wonderful offerings that are here today. I think I can't even do it, and I want to open up an account with ACAP. It's
me too. You stole my line. I need to figure out a way to to get rid of my US, get a dual citizenship somewhere else in order to be able to do this. Anyways, guys, thank you so much. Thank you, Nick, very much for coming on board. I hope you guys really, really enjoyed this. As I said, amazing little tool and very interesting read. I love the idea, and this is, I think, a super interesting idea, because I remember when we were at FXCM, same idea. Just because sentiment is bullish doesn't mean it's going to fall. What Nick said today, which I think is super interesting, is it's only negative when everybody is on the same side of the boat. If most people are on boat, the boat is actually going to go that way. So sentiment actually is a concurrent indicator until it just gets extreme, and then it's a contrary indicator. Yeah,
that's good. Really, that's a good way of putting it.
Yeah, exactly. Again, thank you so much, Nick. Everybody, take advantage of the deal. I'll post the link again one more time. And now, let me see, where's Robbie over here? Robbie is in the room. The next guest I have is...
Boris, can I say one thing real quick, just to preface our next guest, Rob Booker? I have watched Rob Booker for the better half of almost 10 years. So you guys are getting, this is, I'm biased, but this is probably gonna be my favorite part of the entire day, just because, again, it's somebody that I learned a lot. Keep your position sizes small. These are classic age-old lessons that I've learned from Rob. So I'm honored to be ahead of him.
Not only that, but who does not like Robbie Booker? He's literally the most entertaining person in the business. You know, I want to watch his shows, even if I have nothing to trade, just because Robbie is literally the most fun presenter you ever see. So I'm going to, let's see if he's going to actually come up there online here. I see him in the room. Let's just make sure he's going to get connected and put himself on camera and bring him online, because, you know, I brought Robbie Booker. There he is. Oh, and you know, he came dressed as usual. He came well dressed.
Nick. So good to see you, man.
Rob, I gotta say, I sent you a message one time, and again, I'm the biggest fan. So I sent you a message one time. You didn't. I don't think you even. I messaged you on Instagram one time, but I also sent you a Telegram message one time, like way before I had any sort of following. And I just asked you, like, "Hey, I'm struggling with this. What do you think?" And nobody else responds to a DM from like you're a busy man. I know I'm doing stuff too, but you took the time to write me the nice message ever, and I just absolutely loved it. So I really appreciate you, man.
This is the first time on my shows that I've had one speaker fan out, fanboy on the other speaker. So I love this. This is we're truly fanboying here.
Well, the feeling is mutual, Nick. I've watched your I've watched your career. I've watched you do some great things, and I have so much respect for somebody who takes the complexity of all this data that is useful but not understandable in its current form, and you put it into a form that's understandable. And I don't think
I mean, right? It's like the coolest thing. He's just done a really cool job. Good job, Nick. Thank you so much.
Thank you. I'll get out of here.
Thank you. Guys. We will see you in the markets, and everybody, of course, follow Trader Nick. Trader Nick FX is his Twitter, and he's got an amazing YouTube channel. Lots and lots of followers. Definitely go follow him on all of that. Okay, thank you, Nick.
Thanks, Boris.
And now we're going to turn our attention to the man of the hour, Robbie Booker, who literally doesn't have any agenda at all. I'm like, just talk today, you know. No, I asked him to talk a little bit about stocks, because some of you may know that, you know, Rob is, for the longest time, used to trade FX only. And I think about 4 or 5 years ago, he's started to shift his emphasis more towards the equity world, just as I have too, quite a lot. And I just think he's got so many interesting ideas as to where the equity markets are, and more specifically, some of the more specific stocks, the big stocks in the equity markets that are going on, that I'm just literally not going to talk, because I actually want to listen and give Robbie the screen. So let me just give you the screen, Rob.
Okay.
And we can catch up afterwards. Where are you? There we go. Okay. And I'll let you, do you have the control? Let's make sure you get on the screen.
I can see it spinning, so it's coming.
Okay.
It's just kind of frozen for a second here, but I'm sure it's on the way. There we go.
Okay.
There we go.
Don't scare. Oh, look at this. Okay. Here's Robbie. Okay. Great. Thank you so much. I'm gonna be quiet and get off the camera and just let you take over the show.
All right. Hey everybody. Thanks Boris. Thanks Nick. My name is Rob. I'm super happy to be here. I'll introduce myself to you for a moment or two, and then I'm just going to dive into the charts and kind of answer some questions and talk about a big picture view. I'm all dressed warm today. I'm cold all the time this winter. Can't figure it out. Also, I did recently start, totally unrelated, a diet where I eat a pint of ice cream every night. And that started, Boris, in New York when you took me to Van Leeuwen ice cream or whatever, and then I just can't stop. I can't stop eating ice cream, and I just love it. And so anyway, I'm happy to be here. I'm freezing cold. It's Houston, Texas. It's 38 degrees outside. So I don't know where you are. I don't know how you're all doing or staying warm, but I'm very happy.
All the Canadians are going, hold my beer. Robbie's complaining about 38 degrees.
That's great. Say hi to Santa Claus for us, everybody. Yeah. All right, that's great. Welcome, everyone. I'm happy to be here. My name is Rob. I've been trading for 24 years, and I have a theory, anyway, that life, trading, wealth, happiness are remarkably simple. but we tend to overcomplicate things in our trading. We tend to look at too many financial instruments, or we tend to look at too many strategies. And what I love about this crew is every single person who speaks, Kathy, Ashraf, Boris, Nick, everybody, Blake, that everybody that speaks is dedicated to a simpler approach to looking at the markets and making trading decisions. And I have a lot of respect for that. So I'm a former commodities trading advisor. I no longer manage money professionally, but I did that for about 7 years. I actually managed money at an old broker that Boris used to work at. I was the host of the Traders Podcast, but I actually sold the Traders Podcast and the YouTube channel and everything else 4 years ago now, 4.5 years ago. I didn't know you could get Joe Rogan money at the time. I probably need to restart a podcast. Hey, 8Cap, do you want to sponsor a new podcast? Founder of the 922 AM Club. We can talk about that a little bit more later. Author of Adventures of a Currency Trader. My trading strategies are primarily two things. I love shorting stocks. I'm a short seller. I'm not a pessimist, and I'm not like an angry short seller that has a chip on his shoulder. I'm kind of like a gleeful, happy short seller. I don't think there's an easier way to trade stocks. I don't think there is an easier way to trade anything, actually. We can take a look at that if anybody is interested. It's a very, very, very small niche. Most people aren't interested in it. But if you want to, I'll run through actually the strategy that I trade for short selling stocks. It's very simple. Because you can use CFDs and you can actually trade some of these instruments at 8Cap, I think actually it's probably easier to even execute the trades than what I have to do. And I also sell puts for income. So I typically, here's what I do to be just openly and transparent. We can look at my accounts a little bit later on. I take $4,000 or $5,000 or $6,000 and I run it up to 40, and then I withdraw that money, and then I put it into the income trading account where I sell puts. I trade a Warren Buffett style selling puts strategy for income, and that's all I do. I don't do anything else. And I like pizza, shorting stocks, and baseball. And Boris, the best pizza that I've ever had in my life is Linda Street Pizza in Brooklyn, a stone's throw away from where my mother was born. So anyway, so anybody in New York City, in Brooklyn, that's the best pizza in the world. It's absolutely ridiculous. All right, let's talk about the markets. We're going to look at some top stocks, some options potentially if you're interested, and other trades for 2024, and maybe a super secret, nobody knows about it, ETF with a dividend yield of 85%, and that is not a joke, and it's actually a real financial instrument, and nobody knows about it. Nobody's ever heard about it, and it actually has tons of volume, pays 85% a year. Think about that. So that's a wild dividend yield, and it's a completely reasonable and totally normal strategy. And yes, I buy that ETF on dips, and we'll talk about that. All right, let's get right to it. Let's kick things off here, and I'm going to walk you through the process that I use for evaluating the markets at the beginning of the year. And I'm going to talk to you about sort of the way that I look at the big picture. And this is something, so on a day-to-day basis, I short stocks. On a day-to-day basis, I'm looking at something like SYT yesterday. On a day-to-day basis, a piece of garbage company jumps up, it moves 100% higher, it drops back lower, and I short that stock. I'm currently actually short that stock, and I'm holding it through the weekend. Okay, that's all fine and good, but there's a big picture approach that I take every January. And what I do at the beginning of the year, not for the purpose of like making bold bets that are get published in Barron's or something like that, but for the purpose of just organizing my thoughts about the overall themes in the market, I get myself ready. And last year in January, I have a bunch of webinars about this. Last year in January, I was ultra bullish. The S&P or the Russell were down 22% the year before in 2022. Out of almost 100% of the time when that happens, the next year is a double-digit gain. This year is a mixed bag. And I think if you talk to analysts and strategists and you watch TV, you're going to find that there's a case to be made for interest rates coming down, and that's bullish, and a case to be made for the fact that inflation is not yet tamed, and that's bearish, or a case to be made that when interest rates start coming down, it's a signal that the Fed went too far in raising them, and it's bearish. And you can't get a real clear read. So I agree with Nick. It's a mixed bag, and you got to be ready for things to go a little bit in both directions and for it to be a bit of a choppy market. All right, so with that said, I want to talk about the way that I look at the big picture. And all of the first three instruments that we look at are easily tradable on 8cap. By the way, I love those guys. I am absolutely, you know what? I might as well just move to New Zealand for part of the time, just so I can get an account. All right, let's take a look at things. I'm going to remove an indicator from my screen and re-add it. And I'm going to have a really simple approach to analyzing the US 30. So I go to indicators here and I type in pivots. And I see pivot points standard. And then I put this on the screen and there's all this mumbo jumbo. There's all these lines all over the place. What is this? What is this garbage? So we click here and we're going to change some inputs. I'm going to change pivot time frame.
Could you just explain to people what a pivot is? Because there's
Absolutely.
many.
Yeah, I'm going to do that. Right. Yep, absolutely. So I'm going to set it up and then I'm going to explain exactly what the purpose of them are and how they're calculated. But yeah, absolutely. I'm going to do 100 of these back. And then I'm just going to organize things here. Just wanted you to know every single charting platform, including MetaTrader's got them. Every single charting platform in the world that anybody would use is going to have these indicators. And I'm going to use the monthly time frame. And this purple line that you see on my screen is a monthly pivot point. So to answer Boris's question, a pivot point is a horizontal level of support and resistance that once drawn doesn't move, stays in place. And you get a new one of these every month. You're looking right here where the arrow is dropped down to. You're looking at the January pivot point. It starts on January 1st and it ends on January 31st. So you can, at a glance, see 1 month of time extending across this one horizontal line. Now, this is going to be really, really important in a minute, and I know that for some of you this is basic, but we're gonna turn this into a strategy. There's a pivot, there's a monthly pivot, and so forth. Now, there's two kinds of pivots in my world. One is a pivot that was touched by price, and most pivots, 85% of the time, will have candles or bars that touch the pivot in the month, the week, or the day that it was created. And that's the case here on the US 30 and every other financial instrument in the world, 85% of the time, and usually at the very beginning of the month, price will rise or fall to hit its monthly pivot. Now, a monthly pivot, what is it exactly? All right, this monthly pivot for the month of January is at, on the US 30, 37,120.61. That is December's high, December's low, and December's close added together and divided by 3. To simplify things, we're just going to use this rule of thumb. It is the average of last month's price action. It's not exactly the case, but that will answer the question in a really basic form. The specific formula is last month's high, low, and close added together and then divided by 3. And it gives you an average of last month's price action. Why is this so friggin' important? Why am I spending so much time on this stupid pivot point thing? Why are they purple? All right, in 2007 or so, a guy named Lance had been let go and he was no longer trading at the Chicago Mercantile Exchange. And he brought his jacket with him. I think he was actually a Refco trader. Anyway, he brought his jacket with him, and inside of his jacket pocket that he brought was a card. And he brought this card to work with him every day in the pits as he traded. And on that card were a list of levels, and they were pivots, daily pivots, weekly pivots, and monthly pivots. And he said, this is the key to what I used with my group of traders in the pits, pivots. If it was farther away from a pivot and it started to move toward it, it would hit it. And if it were at the pivot and it started to move away from it, it would be moving onward to another pivot. And it never really occurred to me at the time to really care about that. And it was just a bunch of numbers on a card. And so we went through, I was just helping him transition from trading on the floor to trading at a computer. 2 years later, Gary Fluker, who was a fund manager at Julius Baer, his wife, for his birthday, bought him a ticket to come out to my office without really asking me first. But this hedge fund manager, Gary Fluker, you can look him up on LinkedIn. I'm sure he's still there. He came out to my office and we spent 4 days never leaving the office. And we sat in the office for 4 days and we asked the question, downloading all the data from his Bloomberg terminal. We asked the question, how often are pivot points hit? How reliable are these as levels of support and resistance? And how magnetic are these levels? Turns out that 85% of the time, any financial instrument will hit its monthly pivot in the month that it is created, meaning price will rise up to it at the beginning of the month or fall down to it to hit it. And sometimes it'll happen in the middle of the month. And it acts as a really super reliable level at which when it gets hit, price will bounce off of it. And then some of the time price will just race right through it. Now, this is going to be really important in just a moment because when it is not hit or touched by price, it becomes a profit target and it becomes a very reliable profit target. I've used this in the last year to trade Carvana, Apple, Tesla for the biggest trades that I've taken. I used this to trade the UVXY right before the COVID crash, and I used pivot points as targets. These are the biggest trades that I take. These are the biggest, longest positions that I hold. They are the most profitable positions that I have. They've told you, hold your winners for a long time and cut your losses short. This is really the only strategy where I really do that. I think day trading is probably better suited to quickly taking your profits because the whole game is so tough. Position trading is all about holding your wins for really, really big runs. We're going to talk about that right now because this year is kind of a mixed bag and it makes you wonder if you can hold on to them. But I'm going to tell you right now, there are 2 indications that show me right now that the market needs a little bit of a correction. The US 30, or the Dow in other words, needs to drop to and hit its current monthly pivot. How likely is that to happen? It's 85% likely. Now we'll talk about entries and how to, time an entry and whatnot. So we'll get to that. But also, there's a suggestion here that the Dow needs quite a correction, something more substantial. And if it does correct all the way down to 35, let's say 35,000, if it does correct all the way down to that level, people will be screaming, they will be running around in the streets with their head on fire and their pants down around their ankles, and there will be dogs and cats living together, mass hysteria. But it will probably bounce off of that level. And it will probably at that point be ready to turn around and do exactly the opposite, thus screwing with everyone's head. Most people aren't ready for a market that bounces around based on interest rate forecasts, but it seems like every month we're getting a little bit of a different reading. Oh, we're ready to lower rates, and then inflation ticks upward. What are they going to do now? That's kind of what I'm getting at. So it looks like there's a need for a bit of a correction. Let's look at the world's, I think, most interesting index right now, and that's NASDAQ. NASDAQ predictably dropped and hit and touched its monthly pivot at the beginning of the month. That is not a surprise. And then it rose back up and then it dropped to it. And it's just sort of floating around that right now. But we've got a very, very clear, obvious level down here on NASDAQ. This is also the tradable instrument on 8cap. And if you had to pin me down for a trade idea today, I'll tell you exactly the trade I'm going to take. I'm going to draw a line simply. I told you everything that I do is, I think, remarkably simple. And I think life and trading and whatever else, I think all of it is very simple. I'm going to draw a line underneath the recent low that it made. This recent low that it made was actually a recent high that it made before. What was once resistance is now support. There we go. If it can break through this level at 16,155, I will short the NASDAQ or sell it down to the very obvious 15,484. And I'll do that with options. And if I had access to 8cap, I would just press the sell button first, and I would ride that thing down. It is a highly, highly likely thing. If it breaks this level right up here, it is very likely to move down to the next. And what about this area of support and resistance over here? Sure, it could pause there for a minute. Sure, absolutely. Price, all of the market, all of everything that you hear today, everything that you hear from all of us can be reduced to a simple phrase. All market activity is price moving from one level to another. All price activity, everything. It's all just moving from one level to another. And there are these mysterious areas where price suddenly seems to stop, or in the midst of a crash, a stock just suddenly seems to bounce, or a currency, which we'll also look at. But that's a trade. That's the entire methodology. These are for long-term position trades. And like I said, I'm happy to look at, the way that I short a stock in just a moment. But let's look at the S&P. Not surprisingly, looks a lot like NASDAQ. Looks a lot like it. There's only one missed pivot, and it's down at 44.41. And yes, the same thing is true. A break of the area that it dropped to should lead to a pretty substantial decline down to this other one. Now I'm going to do something else. I'm going to double check that there are no levels that it is trying to get to above. No, it doesn't look like there's any. It doesn't look like there's any old missed pivot levels out in this area. Above where we are now, it's just outer space. It's just the wild frontier of outer space. It's already hit all the old levels that we could have even imagined. It really is kind of ready for a drop. Now, if the S&P starts to move higher, we can pick some targets and we can find some areas that we're interested in. But we can get to that in a little bit. I think to start the year off here, I'm more bearish than I am bullish, but not because I'm a perennial pessimist, and I am perfectly happy to buy stocks. I'm perfectly happy to do that kind of thing. I'm just saying that it just appears more likely than not that we're headed for a bit of a correction before we continue upward. So let's talk about one stock, or maybe one or two stocks that I really love. Well, maybe three. I've got actually three right here. I'm going to talk about three stocks that I love for this year and why. Let's kick it off with the one I love the most. This is Occidental Petroleum. Occidental Petroleum is now 34% owned by Berkshire Hathaway and Warren Buffett. I actually buy Occidental Petroleum stock in the same way that Warren Buffett does. And if you're interested, we can talk about that in a minute. That's the other strategy that I trade. Occidental Petroleum is my favorite stock. I think Occidental Petroleum is a $70 stock living in the body of a $57 stock right now. And every single time this stock drops, let's just go here, Oxy, 12-hour chart. Might even go to the daily to see this a little bit more easily. Every single time this stock has dropped in the last year and a half, Warren Buffett has bought it, and you find out later that he was doing it. Every single time. These are all Warren Buffett bottoms. He's like a stop loss. It's the Warren Buffett put on Occidental Petroleum. It looks like Warren Buffett wants to own 50% of this company, and it's probable that he will. Why would he want a company like this? Well, it's a Warren Buffett darling. It's got positive cash flow. It's in an industry where it has a moat around what it does. It's a leader in the industry. It's a well-managed company. It earns money every single time that it reports earnings. And there's also an argument to be made, although it is an argument, that there's a bullish case for oil, especially considering current world events. So let's not discuss the world events. Let's discuss something more important. It's a missed pivot all the way up here. A missed pivot, once again, is a pivot that was not touched by price in the month that it was created. In the month of December 2022, the pivot point was at $70.72. Occidental Petroleum went into a bearish move while Tesla and Airbnb and other stocks were rising. This traditional, hard brick and mortar style company was dropping, and it left this pivot unhit. That's my target. That's where I think Occidental Petroleum is going. I actually think Occidental is probably a $100 stock, but on the way up, that is a very likely level. How likely is it? How likely is it? Well, when Occidental Petroleum missed its May 2023 pivot, it spent about a month and a half before it jumped up and hit that level. And most of the other ones, as you can see on the screen, are always hit in the month they're created. It's just a magnetic level that price wants to hit. And when it misses it, it wants to go back to that level. I like Occidental Petroleum because, well, frankly, Warren Buffett likes it. He likes it every time it drops to $57 a share. I like it because it makes money. I like it because it's in an industry that's likely to benefit from a shortage. And I like it just because it's a well-managed business, all those reasons. But I like it the most because it's got a nice missed pivot above where we are. Every single time Occidental Petroleum drops near $57 a share, here's what I do. I'll just tell you what I do. I don't know. Do you want to know what I do? Here's what I do. I sell a put and get paid to do it. What does that mean? When price is dropping toward $57 a share, I sell a put. When I sell a put, that's a promise that I will buy Occidental Petroleum at $57 a share if it falls below that level and stays below that level. And I get paid to make that promise. So I have to put up enough money to buy those shares, which I wanted to buy anyway. Now, the easiest way to buy stock is just to buy more stock. That's the easiest way to buy stock, is just go in your platform and boop, 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 and buy it. That's a dumb way to buy stocks, because if you want to, you can sell a put and get paid to do that. And then at the end of the week, when that option expires, if price is below that strike level, that 57 that I mentioned, you'll get assigned that stock. And you got paid for the put that you sold. And so it lowers the cost basis on the shares that you bought. And then you can immediately start selling calls against your position. It's the way that Warren Buffett does his acquisitions. If you read Warren Buffett's old annual reports, you will read stories of in 1994, 95, he kept selling puts on Coca-Cola, the $35 puts. It was trading at $39 a share, but he didn't want to pay $39 a share. He wanted to pay $35 a share, but you can't make it go down to 35. So every week after week after week, he kept selling puts, the $35 puts, and he got paid $7 million every single time he did it. And then eventually Coca-Cola fell to $35 a share and below, and he had to buy the shares that he said he was going to buy, but he had made like $49 million selling puts on the way there, thus lowering the cost basis. If I already know I want to own Occidental Petroleum at $57 a share, I could just keep selling the $57 puts that expire every week. I get paid, and if it doesn't fall to 57, I don't have to buy it. And if it does fall to 57, I have to buy it, just like I said, but I got paid to do it. What if it never falls to 57? Well, then I just kept getting paid, and I'm not going to overpay for a stock that I want to buy. I'm not going to chase it. All right, that's kind of how I do it. We can talk more about that at another time, but that's how I'm doing the same thing on Altria Group. Now, this is the part of Philip Morris that kept the cigarettes, I think, right? I think it's the part. There's the food part of it, and then there's the cigarette part of it.
Yeah, it's the good part.
It's the good part. That's great. Altria has been dipping. It's been dropping, and as you can see, every single pivot, every single one of them was hit on the way down, except for this one. The August 2023 pivot was almost hit, but not quite. It's got a level up here at $45. I've been selling puts and acquiring Altria at about $40 to $41 a share over the course of the past 3 months. I now own 1,000 shares of Altria, and my target is $45. Now, if I don't get paid on this immediately, I'm going to hold this position for a while. Every single week, I sell the $43 or $42 calls, so I make premium, they expire worthless, and I just keep making money selling those calls against my position that I have. So I'm just getting paid, and the cost basis of my shares is going down and lower and lower. I think right now I actually own Altria at like $39 a share, even though it never traded at that level, because I basically sold puts to get into it, and I keep selling calls as I am in it, and I'm just waiting for it to rise. This is like another very, very simple strategy. I'm just waiting for Altria to rise. Now, if Altria takes its sweet time in getting there, I get paid $1 a share. And I get paid 10% in dividends a year. It pays a dividend yield of 9.9% or something like that. So I get paid $1 every quarter per share, thus lowering my cost basis every quarter by another $1. Now you might ask, what happens if Altria drops to $25 a share? Well, then a super profitable company that is eventually going to 45 will be at 25, and I will gladly buy it. But we're not talking about Tesla or even Apple. We're not talking about NVIDIA or Airbnb. We're talking about a real company with real revenues and a dividend, and a well-managed company that makes money every quarter. So I'm not that concerned about it, and I don't do this strategy on stupid companies like Bed Bath & Beyond or some craziness like that. Another one that I like is the Walgreens Boots Alliance. I love anything that sells drugs. So we got two levels here. We've got one at $27 a share and one at $35 a share. Walgreens Boots makes money. It's not going to go away anytime soon. It's not really as sensitive to inflation. And so I am in the process of acquiring, accumulating, and building a position in a company that isn't going anywhere anytime soon. And even if interest rates go up or down, they're still going to be selling all the whatever weight loss drugs and other drugs and whatever. They're going to be selling drugs. So this is a $35 stock. I know that because, well, it was a $35 stock, and it probably will be again. It's actually probably a $38 stock. I might not wait that long. It's actually also probably a $51 stock. It was there before, and the only thing that happened over the past, year and a half, 2 years, especially over the last years, tech stocks did really well, and some of these stocks were forgotten. Well, I don't think that's going to be the case anymore. And even if it does fall a bit more, I'll just keep slowly, quietly, carefully accumulating some shares, and I'll get paid to do it using the strategy that I talked about, and I'll sell calls against the position when I get put into the position. And so over time, my cost basis for the trade goes down, and as it rises, my profit will increase. This is what I do, the money that I make from the shorting of stocks that I do. This is the strategy that I do, and these are the long-term positions that I'd be taking. All right, let's switch gears for a minute. Let's talk about currencies. I love currencies. I spent a lot of time trading currencies. This is where the pivots really come to life. For those of you that are interested in currency trading, I'm going to talk to you a bit about a strategy. I'm going to talk to you a bit about something I've never talked about before. Just kidding, I just told you about it. I'm going to talk to you about missed pivots, but I'm going to talk to you about it in the context of currencies, where everything that I've said is even more reliable than it is on stocks. The US dollar Japanese yen, as it slid lower, missed the December 2022 pivot. And it took about 5 or 6 months, but it was a rocket ship going back up to that level. When it turned around and the trend started to be up, what it did was it bounced off of a monthly pivot on its way up. This is too early over here. You wouldn't have known that the trend had changed. But as soon as the trend changed and the pivots were below price instead of above it, the dollar yen became a buy trade. And what it did was multiple times over and over and over again. The currencies will do this. You can just double check this on your own charts. The currencies will do this. In an upward trend or a downward trend, the currencies will bounce almost exactly off their pivots. Almost exactly. It is an extraordinarily cool way at the beginning of a month to either buy a currency or short that currency. If I were to go back and manage money in the world of currency trading, this is all I would do. This is 100% of the system that I would trade. I wouldn't do anything else. I wouldn't use any margin. On a $10,000 account, I would trade a $10,000 position. On a $100,000 account, I would trade a 100,000 position. When I was trading an $8.7 million account, I was even trading sizes lower than that. All right, so that's the US dollar Japanese yen. So what's it gonna do? What is the dollar yen gonna do? Well, there's a suggestion here that the dollar yen is on the way and in the process of rising up to 148.95. It's got a missed pivot. It missed the pivot in December of 2023. A year ago, it missed the December 2022 pivot, and that was the beginning of an upward trend. It would not surprise me at all to see the dollar yen break through the highs at 146.38 and make its way up to 149. The very, very best place to buy it, however, was back here when it bounced near or off of the monthly pivot. I think there's a chance, because we're in a little bit of a confusing market, that we're going to get a chance to watch this bounce off of the monthly pivot. I think we might have a chance to buy this down here at 143.15 and then watch it climb up. Once again, by not using any leverage in the world of currency trading, what I can do is hold on to that position, build a position. It's not a day trade, it's not a short-term trade. I could build a position that pays off over time. The problem with this is, during that time, I can't sell covered calls, and I can't do some of the things that I like to do when I'm in a trade, and I can't sell puts. Now, I can use the ETF in the US. I can use the ETF that tracks the dollar yen if I want to, but that's not really what we're talking about here. I want to take a look at the Australian dollar Japanese yen, because it kind of mimics the NASDAQ a little bit. It's a nice proxy for the NASDAQ. And in an upward trend, it will just continually bounce off the pivots. But this is a really convoluted looking chart. It really hasn't gone anywhere in a while. And I'm sort of bearish Australian dollar right now. The only missed pivot in the vicinity, or even anywhere, is from March of 2022, and it's at 82.72. If you're asking me if I would be willing to build and hold a short position on Aussie yen, the answer is yes. So how would I do it? Well, just like you saw here, a month ago or whatever, it had missed a pivot here, the pivot for November, and then the very next month it dropped to it. If we can get below that level, if we can get below 93.72, I would be willing to short Aussie yen and build into a position, even like hold that for a long term, maybe even months. So I'm bearish that. I think that's the suggestion that the chart is making. Euro, New Zealand, it's got a missed pivot up here at $1.78. I think Euro New Zealand I'm bullish. It's right on the pivot now. If I were on 8cap right now, I would be willing on Monday morning to initiate and build, starting with no leverage, 1 unit. I would have no reservations about it. I would absolutely 100% initiate that position. And my target would be 1.7877. I love that trade. I love that right now. I love that target. I love that trade. And this horizontal line here is some old level that I had on my chart from I don't know how long ago. All right, let's keep it going. We got a few more things we can look at. Everybody loves Bitcoin right now. What did Bitcoin just do? It just hit exactly its monthly pivot. It's not a magic level and it's not whatever. It just is consistent. It's very consistent. You could have bought Bitcoin on the bounce off of the January pivot at the beginning of the month. The beginning of the month, to borrow a Bone Thugs and Harmony, first of the month, it's important. That was where to buy it. It's now dropped back down to it. And unless we get a really nice green bounce candle here, Bitcoin's probably going to tail off to 36,836. But there's this new ETF, Rob. Yeah, and that's why it went up before the ETFs came out.
It's so funny because you weren't here when Ashraf was here, but he was literally saying the same thing.
Oh, really?
He literally said the same thing as you, that before it goes up, it goes down, and he was saying 36,000. So it's interesting. You guys are coming to the same analysis from different perspectives.
You know, like 11, 12 years ago, we were in Barcelona together, and he gave a presentation, and he literally gave my presentation right before I went up.
Oh, God.
All of his predictions, like we shared exactly the same point of view for different reasons. And it just looked like a coordinated,
And you just went on the stage and you said what he said.
I remember that. Okay, so
I have a question for you, Robbie. Yeah. Like, what happens when you have, for example, you're short Aussie yen but long dollar yen? Those are essentially contradictory positions. Is that because you don't care? Your timeline on one and timeline on the other will be elongated? Is that how you view it?
Yeah. Also because one might never open. So the dollar yen might rise, and the Aussie yen may never open. It may just it may just keep going up.
Fall. Right. Because you're a momentum entry strategy in all of this. Yeah. I understand.
So I wouldn't, for example, I wouldn't short Aussie yen right now. And so you could get the dollar yen rising. The Aussie yen could go to 98.56, for example, first as the dollar yen is rising, and then the other position starts. So they're oftentimes they're very complementary to each other.
I was gonna say, have you had instances where, because long dollar yen is a completely out of consensus trade. Like the macro consensus trade is short dollar yen. So I'm just curious, like, have you had instances where you've been totally out of consensus with the pivot strategy, and it's taken everybody else by surprise and proven you correct?
Yeah, I mean, the best example I can do of that is, so periodically, yes, I will have a contrary position. It's possible that this dollar yen, it will never rise above 146, and it will go down to the monthly pivot and burst and never bounce. It will never print a green bar or candle.
So what would happen then? What would you do then if that happened?
So what I'm looking for is in particular on the 4-hour chart. So what I want to see is, once it drops to that, I want to see green. I want to see it drop to it and print multiple, like a day of green on the bounce.
Right.
What can happen is it can just rocket through. It could just drop right through the floor and never bounce. And it needs to bounce right off of it, like pretty precise. So if it doesn't just bounce off of it precisely, it won't really be a trade. And that's why I get it ready, but don't necessarily take it. But to answer your question, I wouldn't disagree with the bigger consensus that the dollar yen's ready for a sell-off. But what often happens is everybody gets shaken out of that first, and then it goes ahead and does exactly what it's supposed to do.
Watching you deconstruct this, I was thinking he's probably right, because everybody's leaning long yen, and they're all going to get stopped out, because typically that's what currency markets do. They give the max amount of pain to the max amount of people before they reorient themselves. So it's really interesting.
And having been on the wrong side of that so many times as a retail,
you and I both.
I remember riding the dollar Swiss in the wrong direction for a long time, and I was trading with the consensus, and I'm like, well, that we'll see if this executes, and like there's going to be an offer to come back to a webinar next week and stuff where we can expand on this and discuss this. So
exactly. So I was going to say, time is short, so I just want to bring everybody's attention. So one of the offers in this package is that Rob is going to do a private webinar. He's actually probably going to do a couple of private webinars. If you can't make it next week, he's going to have a few of them. It's just going to be a standing offer for him to have a private client webinar where he's going to discuss a lot of these strategies in much more detail and go walk you through exactly like he and I talked about the actual technique, because the secret in all of this is the technique of doing this correctly. As you can see, incredibly interesting stuff. Very, very interesting how you were able to adapt stuff from the floor onto the screen and how well it works, because it sort of shows, I think, how human nature does not change. It's simply a matter of interpreting human nature in a different media, in a different format. And that's what you've done with all of this, which I think is really, really fascinating. So absolutely be sure to please sign up for ACAP. Again, it's less than the brunch I'm going to have after this show in order to be able to get access to him, which is not cheap, believe me. And he's going to be very, very kind to have shared all of this with us. And as he said, we can use this on indices, on currencies, and even on the Mag 7. Like, I'm sure, you didn't get a chance to talk about Apple. We're just running out of time, but I wanted Tesla, Apple, all the Mag 7s. I'd love to have known how you feel about those and whether there are missed pivots over there and, where things are going, because I have a feeling.
I'm very bearish Apple. I'm really bearish.
It looks like Apple is Apple, like the Isaac Newton gravity story, is falling to the ground, in my opinion.
Yeah.
So, anyways, thank you so much for coming in. The people are asking, does this pivot works on all instruments? I think the answer is clearly yes.
Yeah, I haven't found anything that I don't like to use it on. I think that, of course, it's a possibility that it doesn't, quote unquote, work. Remember, there's always going to be an exception to that rule. So.
Right. Well, like you said, it's an 85% bet. That means 50% of the time it's not going to work. That's the whole point of trading. You have to understand when it works and when it doesn't. That's why positioning, size, leverage, all of those things that you're going to discuss in your private webinar are very, very important to understand. It's not just green light, red light type of a situation, but this definitely creates the edge in your favor. So Thank you so much. Everybody be sure to sign up and get access to Rob. As you can see, he's not only very smart, but very, very entertaining to hang out with.
This is great to be here with you. Where are you going to brunch?
I'm going to my diner. I call it my $100 diner, because the diner next door to me, the Fian diner, everybody's just in shock at the prices in New York City diners. It literally is $100 for two people to have breakfast there. But the food is good. The food is good. So
I went to Beyond. I had chocolate chip pancakes there 100 times when I was there for the month of November.
Exactly. Once you get over the sticker shock, you enjoy the taste buds. Robbie, thank you so much. Really, really appreciate it. We have now one of my favorite people in the world, Mr. Forex Analytics himself. Let's see if he's coming up on the screen. Let me see if I can get him up on the videos. There he goes. Oh, look at this. This is of course, the pan to old age to both of us, that we're both wearing glasses. As who was it? Oh, it was Nick who was saying to me, because he's young, he's like, oh, I'm using dark mode because I don't want to kill my eyes. I'm like, too late for me. Too late for you, my friend, right?
Well, it's funny, and by the way, I know you say it's my favorite person to every person, so I'm there. All right, I understand that. Actually, these are the blue light blocker lenses, because if sitting in front of all my monitors, if I do it too long without these glasses on, my capillaries explode.
I actually see the monitors in your glasses. I think you're like 3D.
Yeah. So what happened is actually when I went to Hawaii, I was in Kauai during Brexit. Didn't have these blue light blockers on, and I went to Kauai and my eyes were it looked like I got punched in the face. So but I do have glasses for reading. So anyway,
I know. Old age.
Over the age of 50, it happens, right?
We're still punching. For those of you who are not aware, this is Blake Morrow, the master behind Forex Analytics, one of the really great trading portals. I would say probably one of the best trading portals in the world. They do something which is fascinating. They analyze 30 different instruments, and maybe even more so, from Forex to indices to everything else. And he's going to just showcase a little bit of the product a little bit later in a whole bunch of different technical and fundamental ways that I think is really, really interesting. And Blake today, I asked him to talk about two things: gold and oil. You see we have people kind of intersecting on various products because I wanted different points of view. For example, like you see, Kathy was super bullish yen. Rob is kind of bearish yen on a technical basis. And I think it's really important to see 2 points of view for this 2024 forecast. With Blake, obviously, the key thing here I think is fascinating is the two big commodity trades, oil and gold, are giving lots of contradictory signals, and it'd be fascinating to hear what he's got to say about this. So I'm going to give him the mic. Let me just make him a presenter. Just one sec.
Well, thank you. And just for the record, I'm both bullish and bearish yen. So just I'm
on both sides. I'm hedged.
Yeah, the thing is the thing about this market and this year that we just obviously started is that my trade of the year
going into like this year was being long yen, but I don't want to be long yen, and I'm not long yen currently, but I wanted to be long yen when the dollar yen got towards 146 to 147. And then it happened within the first week. So I was actually short yen, long dollar yen, and then I spun out of it. And then I'm almost nervous that I'm missing my opportunity, but I still want to be long yen overall. It's a hard carry though. You know, the interest rate differentials are so big. To carry a long yen position, if you're doing just spot, is tough, and it's expensive.
I'm just curious, what do you like? So for those of you who are wondering what that means, if interest rates on the yen are very low, or basically zero, interest rates on the US are around 5%, which means that if you're going to be long yen, you have to pay that 5% on a leverage basis.
Yep.
So it's very, very expensive to carry that position. That's why it's called the carry trade.
That's correct.
And you're probably paying what, almost like a pip a day or something, or maybe.
Well, it depends on what pair that I'm attracted to. Like I've been selling a lot of the commodity currency yen crosses as they're up at these levels, but bottom line is it is expensive, and that's why timing is really important.
That's exactly right.
Yeah, because I don't mind paying a pip a day, let's just say, on average, based on your position size too. I don't mind paying it if I got ripped into a position and then it drops 80 pips, and then I end up closing it out for, like, let's say 80 or 100 pips over the course of a few days. Then giving up 5-7 of that profit is not an issue. But if you are layering into a position as it's going against you, it could get expensive. And I know a lot of traders that
really good point. If you're going to be trading negative carry, you better be right or you better be out. Otherwise, you're just going to be bleeding a death of 1,000 cuts just on the interest rate alone, or on if you're trading commissions. If you're over trading, that's what happens with commissions. You give up all your profits and commissions. Same kind of tricks you need to be aware of. I gave you the screen. Let's see if did you get it, Blake?
I did. I got it, and I was just tweeting out something that we're starting right now. That my segment's starting right now. But I guess the first thing I wanted to do, since you asked, is you wanted to. Well, actually, let me.
Yeah, there we go. Now I see the screen.
I don't know which screen you see. That's the problem. So.
Okay, I see Forex, and now I see the Forex Analytics says gold forecast 2024.
Okay, so what I'm going to do is I'm going to actually share a different screen. So let me, because this is, you should be able to see now.
Okay, I see the Forex Analytics website.
Right. All right. Okay. Because when you're using multiple monitors and you hit a PowerPoint and I had a hard time trying to figure out which monitor it was going to. But you asked me to talk about gold, and it's interesting, Boris. And I don't worry, I love having conversations with you and being able to banter with you as I go through this. So if you can disappear if you want to, but you're more than welcome to stick around. When we're talking about gold, though, I'm not. Let me just make something clear. I am not a gold bear, and that's the bottom line. And I think that gold, you have to buy it, and you have to buy it on pullbacks. I have to get that out straight away. Even though I may not be bullish at this one instrument, or excuse me, at this very moment in time, which I'll talk about the reasons why, it doesn't mean that I want to be short. If I see a breakdown in gold, there's different ways that I want to play it, and it's not necessarily shorting gold. One of the things that makes me most nervous about gold right now is that if you like, you can look at like my FX book and some European brokers, they'll show you positioning. Believe it or not, retail is not super bullish, and or bearish. They're kind of neutral. And when retail, and when I say retail, I'm talking to you guys at home, myself even included. I'm not institutional anymore. I don't trade an institutional book like I used to. And size, I just trade for myself now. So, when I'm looking at gold, and I'll look at retail positioning, if retail is super, super bearish and they're just like laying into these highs, I would be extremely bullish gold. also, there's anecdotal evidence right now. It's kind of like, Bitcoin when it's frothy. Gold is, everybody's talking about gold. Everybody, people that I know that I'm in the markets, that aren't typically in the markets, are asking me how to buy gold and how to buy gold bars. And that, I mean, I'm fielding these calls from friends and parents and, people that I know all the time, which is odd.
Right.
And I know that's anecdotal evidence, but it's still, it suggests to me that I have to be really careful. And I think if you look at price action in gold, you have to be really careful as well. But like I said, I'm not a bear. I just think there are better places to be long. So let's start off with just looking at gold.
I'm gonna get off the screen, give you full control and let you run the show.
Sure thing. So let's start off with looking at gold and just understanding that we are in a very, very bullish trend. And so being in a bullish trend, I have to be really respectful of the fact that anything, and whether you're talking about especially geopolitical issues, could really put us in a trajectory where gold doesn't look back. So that's the one thing that prevents me from being short gold. Is I understand, and I'm not oblivious to any of the risks that are surrounding us from a geopolitical standpoint. Whether you're talking about what's happening in Yemen right now, or in Gaza, or the Taiwanese elections over the weekend, any of that. So therefore, again, respectful of gold. Now, what's interesting about the recent highs that we hit, I believe it was in December, when we spiked up, you'll notice that we hit like a channel, what I consider channel resistance, or as you hit new highs, relative strength was divergent. And so, when you zoom in to this chart, and let me just pull up this chart here. When you zoom in, you realize that we hit a new high, but it was a very marginal new high, but also left us a false breakout. Now, technically speaking, whenever you get a false breakout, and everybody, and when I say everybody was looking at spot 2070, and everybody still is, myself included. And what you'll even notice about Friday's price action is, despite the weaker producer prices that came in, and you could argue that CPI was stronger on Thursday. Friday producer prices were a little weaker, and that produced a move higher in gold. It's still, we couldn't sustain and we couldn't get back above 2070. And so therefore, I know that it's a false breakout, and false breakouts tend to lead to breakdowns. They tend to lead to reversals, and especially on such a big level that we all have been looking at for such a long period of time. So when I look at gold, and I factor in what I want to do with it, whether it's being long, or like I said, if it's moving lower, I'm not going to be short gold. I'm going to do a different type of trade, which I can talk about here in a moment. I kind of look at different markets, and I start looking at correlation. So the first one I want to take a look at is gold in the 10-year. And what you're going to notice when you're looking at gold in the 10-year is, over time, especially over the last, since you could argue since the early 2000s, we've seen a very big correlation in gold and 10-year yields. So let's start off by just identifying that a lot of these peaks and a lot of these troughs really just suggest that there's a divergent relationship between gold and yields. But it'd be really, if you take a step back and you're looking at the broader markets here, it's very easy to go, well, there's definitely an inverse relationship. But I disagree with that. Because what you'll notice is, if you dig a little deeper, you'll notice there are periods of time where you get a very strong correlation between yields and gold. Okay, and you'll notice that period between, what is that, 2013, 2012, 2013 through 2018, pre-COVID, you saw a very, very strong paralleled relationship. All right, but then moving along, you'll notice that you started to see those divergences again, especially during the COVID lockdowns, and you would see gold rally, yields were plummeting for obvious reasons, right? Now in most recent times, and this would be over the last couple of years, what you're seeing is a stronger correlation in the same direction. Now, looking at these patterns, you might say, well, if yields go down from here, which by the way, yields are in the black line, right? Gold's the orange. What you'll notice is if yields start going down, will gold go down as well? And that's one of the things that I am contemplating right now, especially understanding that yields are near their highs. Now we've seen both, right? We've seen where yields rally, gold will sell off, and vice versa. But based on the patterns that we're seeing right now, they do have a little bit of correlation there. But not having any conclusive evidence right now, I'm going to move along and I'm going to look at what I consider one of the strongest inverse correlations would be the dollar and gold. So this is obviously the dollar index and the gold market, and gold, the GC gold futures. So what you're gonna notice here is very similar to yields, is when gold peaks, the dollar bottomed out, gave us a good solid bottom, and then you're going to see a lot of those strong correlations really continue to take hold. And even through that period of 2012, if you will, to 2018, 19, you saw a very, even though it was kind of mixed, you get a lot of the divergences. And I always go with the percentage that about 80% of the time, 80%, 75%, and I'm not a statistician, so I'm not going to go back and back test it all and check it out. But I'm going to tell you, based on my experience over the last quarter century of trading, what I've realized is most of the time they do have a inverse relationship. So if gold's going higher, dollar's going down, vice versa. Now they tend to move together when you have periods of extreme risk aversion, but that's not a lot of the time. So you get those divergences quite a bit. All right. So then trying to get further evidence, what I want to pull out, or the next chart I want to bring up to you, is how does gold react during a recessionary period? Now, it is obviously, you talk about where we're at right now being in an inflection point in the markets. If you listen to macro analysts, and you could go back a year ago, everybody thought we were going in a recession. And I am a believer, just so everybody knows, that there are very, very big lags in monetary policy, but the lags are even accentuated more based on the excessive action of central banks globally post-COVID. So in other words, what I believe is we are going to see a recession or a significant slowdown, not only in the US economy, but globally over the course of the next year. And I believe that those are starting to bite right about now. So, probably about the middle of this year, we're going to have some pretty weak data. And then the question is, okay, during a recessionary period, how does gold perform? And it's easy when you go, okay, well, let me get to the next chart here, and I don't know why it's not forwarding. Oh, there we go. Okay. So it's easy if you look at this next chart, and especially if somebody that's not been in the markets for, which happens to be a lot of people. Boris would probably admit, because he's been around the block, a few decades. Did I say a few? Sorry, Boris, if you're listening in. But he's been around the block a few times. I've been trading since the 90s. But there's a lot of analysts, there's a lot of people in the markets that have not been, especially on Wall Street these days. So if you look at like the past two recessions, following the great financial crisis and following COVID, you'd say, well, gold goes up during a recessionary period. And also, you could go back and say, well, it happened in the late 70s, early 80s too. But if you look at other recessionary periods, that isn't always the case. in other recessionary periods, you know, we've seen gold maybe move flat, and we've even seen it move down in certain periods. Now, if you look at that secondary move back in the 80s, so you look in the early 80s and you're like, okay, gold rallied during the recession, and then you had another follow-up recession. What happened there? And that's the question that I have to ask myself right now, and I think all of us need to ask ourselves is, how did that happen and why did that happen? And that's why the next chart is really, really important to me, and it should be to you as well. So if you look at the federal funds rate and you look at what happened back there in the early 80s, and I think most of you already know this, or at least have an idea of what I'm going to say, is that the Federal Reserve raised rates extremely aggressively back in, you know, the early 80s, and then we had a secondary inflation shock, right? They were trying to fight inflation. They thought they had inflation contained. Boy, doesn't that sound familiar, like with what we're dealing with right now? Expectations, you know, rose that the Fed would cut rates. They did, and then you got a secondary inflation shock, and then the Fed had to raise rates aggressively past the previous highs, which, you know, history doesn't always repeat itself, but it does rhyme from time to time, and it sure does seem like a very similar situation that we're dealing with. So if you look back then in the early 80s, it's very reminiscent of where we're at right now. You know, the market's pricing in a lot of rate cuts, and my 2 cents is the Fed is probably going to end up cutting rates. You know, it's you know, I look at monetary policy kind of like a gun, like a revolver, right? You know, they have, you know, so many bullets in the cylinder. They fired off all of them, took rates down to zero. They've been slowly reloading their revolver with bullets, you know, to combat the next you know, crisis, if you will. If we do see a meaningful slowdown in 2024, the Fed's probably going to have to, you know, expend some of those bullets, and they're going to have to shoot some of them. They're going to have to cut rates, and then by cutting rates, it's probably going to fan the inflation flames once again, and then the Fed's going to have to raise rates, and then, you know, you start thinking about, well, what happens with gold? And then if you go back a few charts, what I showed you there is that gold could invariably go down as the dollar rallies and yields start to move higher. And that's why I think it's really important that you look back in history and you look back at how the market responded in the late, you know, or excuse me, early 80s, late 70s, early 80s, and see what happened to gold back then. All right. So if you look at a current chart of gold, and I'm just going to take you to this chart right here, and I can go even a little bit further in depth in analysis here in a moment as far as gold goes. I'm actually looking for pullbacks. Now, let me take a step back and just say that, once again, I'm not a gold bear. I don't believe in buying gold up here, but then again, I'm talking from a person who also owns physical gold and silver as well. So you know, it's like, you know, do I want to acquire more? Absolutely. Is it up at these levels? I think if I close my eyes and I open them a few months from now, I'm going to realize that I could probably had some better prices in gold. Now, that doesn't mean that there aren't risks. And what everybody should realize is that anything can happen. And I know a lot of you listening in at home are probably thinking, you know, well, what if this happens? What if that happens? What if this and that and this and everything happens? Could gold be trading at 2,300, at 2,500, maybe even higher? Absolutely. And you start breaking out of that upper trend line, you know, above, let's just call it, you know, 2150. You start trading above that, then you start going into an accelerated mode in the markets. And we've all seen blow off tops. We've all seen accelerated markets, and gold would not surprise me in moving in that direction moving forward. But I also have to say that, and no pun, don't mean it to any pun here, but given what's happened this week And given what's happened over the last several years, especially with cryptos, if you talk about Bitcoin, you talk about the adoption of ETFs, and Bitcoin and other cryptocurrencies have, whether you like it or not, and whether you believe in them or not, they have been woven into the fabric of our financial system by Wall Street. Wall Street has now, and has over the last several years, adopted a new gold and another way for you and I as an investor to have some low yielding or zero yielding asset that is, limited in quantity in our portfolio. Whether you like it or not, I buy crypto, okay? And I'm sure a lot of you out at home do as well. So that in itself, that action in itself has taken away from what I would have had in gold, or what somebody would have had in gold or silver or any other precious metals, and they've diversified into other assets. So it has taken away somewhat from, if I didn't have Bitcoin or any other cryptos as an option, then we could probably argue gold would be a lot higher than it is right now. I do believe a lot of the monies that would have been allocated for precious metals like gold have gone into the crypto market, and it's just becoming more and more woven, like I said, into the fabric of Wall Street. So therefore we have options, and it's kind of like that market, the market we're in right now. There are a lot of options for investors. There are more investors, or excuse me, more options for investors, especially I think Jim Bianco says it really well. TINA is the acronym that he uses. If you've never heard Jim Bianco, he does great macro analysis. He's like, there are other options in the market. You can instead of just buying stocks, because I have nothing else to, as a baby boomer, I have nothing else to buy. Instead of buying stocks, I can buy bonds now. They yield. They actually yield now. I can go buy a CD. I can park my money in interest rate, or in a savings account, and get interest on it, where I couldn't for so many years. And same thing with gold, or now you have Bitcoin. So I just want to say that yes, gold could rally. I still think that you could buy gold at cheaper levels. So as far as my forecast goes with, whoops, I didn't want to go there. Sorry, I thought I had some animation in there. You have to be paying attention to yields. You should be paying attention to the US dollar. I don't want to chase highs. I do believe geopolitical risks, they could, like I said, they can accelerate a move higher. And I am looking to buy pullbacks. And what I'd like to do really quick is, let me see if I can do this for you. I want to pull up a chart of, and you should be able to see my screen now. Just want to make sure. Yes, you can see my charts. I'm going to just show you something in gold really quick. And let me see if I can zoom out. So you should be able to see it now. So, I know a lot of you, you may be a gold bull and you're like, there's no way gold's going to drop below 1800. Look, I think 1800 is like, around 1800 is like my first level of support as far as gold goes. It is a Fibonacci. Let me zoom in a little bit. Let me put you on a daily chart. It is the 618 retracement. It's horizontal support. You can see around the 1813 level, right? So I believe that if you can get into the 1900, into 1800 levels, those are levels that you theoretically would love. Like I'd love to just be adding to long somewhere down in those levels, like around here, whether it's here, whether it's here. But then the question is, could we go further than that? And I think it's important to understand that you have to, be looking at the markets. It's hard to make these forecasts when you don't know what's going to happen in the future with geopolitical risk, monetary policy, how the Fed's going to respond to any type of slowdown. Will there even be a slowdown? And what's the dollar and yields doing at the same time? So therefore, whether it's being able to purchase some at 1920s, at 1800, low 1800s, that would be it. But I also, and let me put you out on a weekly chart here, a longer term support of gold, longer term. If you start looking at channels or Andrew Pitchfork or something like that, you start looking at like the $1,600–1,700 range, which I really don't think we're going to get down to those levels. But markets can surprise. They surprise you, they surprise me all the time. So, you know, whenever I have like targets in the market, I always have to think about where those targets might be and where extremes could be. And in this case, an extreme could be towards, you can see right here, the long-term 38% retracement, which would be around 1716, and the 50% retracement, which would also be a longer term 618 retracement, or the previous 161% extension right here of this move would take us down to about 1600. But also channel support, or this trend line support right through here, comes in right around those levels too. Again, those are really extreme levels, but the point I want to make with, especially with gold, is that, you know, you want to be buying pullbacks. And if it is going down, and we're seeing a breakdown in gold, my default option is going to be being long dollars in some way, shape, or form, more than likely against the euro. Okay, so I just need to throw that out there. All right, let's continue on, because also Boris had asked me about crude forecasts and what my crude oil forecasts would be. And a lot like gold, I have to say this: I am not a crude bear, and it's a very similar asset class to gold. I don't trade crude all that often, but I wouldn't be short. But there's a few things that I need to point out about crude oil. You know, as you know, last year it was just reported that the U.S. We're producing 13.5 million barrels a day, on pace to be 14 million barrels a day. We're like the largest producer in the world here in the United States right now. So there's an amazing amount of production, and I think it's, and correct me if I'm wrong, and it's almost ready. It's like record globally, almost surpassed Saudi Arabia. I'm not 100% sure with that point. But as a nation, the United States is producing literally almost 14 million barrels a day. But there are other risks that are in the market. You got, you know, what's happening with Russia, Ukraine. You have you have OPEC, which is trying to contain prices, but you know, they don't want prices to go too high because that's going to really prevent them from selling more crude, but they don't want it to really eat into their margins. So they're just trying to maintain a stable price. And then you have, you know, the war in, you know, whether it's in Gaza, in the Middle East, depending on what happens with Iran and Tehran. Then you have what's happening just as far as this weekend goes. You know, what's happened with the Yemen attacks, you know, in response to what's happening in the Red Sea with US and UK forces. So there's a lot of risks that could invariably move up crude oil really quickly at any moment in time. But what's really interesting about all of these risks is prices aren't higher. Despite everything that's happening right now, prices are not higher. Now, technically, we just broke out of a triangle, and I'll take you to a live chart here in a second, which leads me to believe that there should be some buying at current levels. But I always step back and go, well, with all of the risks and everything that's happened in the world, why aren't crude prices so much higher than they are right now? And you could say, well, maybe, Blake, it's an election year, you know, that it's being manipulated, whatever the case may be, whatever your argument may be. Now, I going back to what I was just saying earlier about gold, I wanted to take a look around and see, you know, specifically how crude oil acts in a recessionary environment. And what you're going to notice here is crude tends to move lower in a recessionary environment. And sometimes we get those you guys remember when crude hit whatever it was, $150 a barrel, and then that theoretically could have been, you know, I thought it was a generational top in crude. I don't think I tend to think we're not going to see those levels ever again, but that put us in a recession, or, you know, between that and the GFC. But when we're in a recessionary period, at least the beginning of the recession, we tend to see weakness in crude. So that's something to keep in mind, especially if you think about the macro backdrop, and if indeed this next year we are going to slip into some sort of recessionary period. So now I want to really quick go into, some live charts here in a moment. But like I said earlier, I don't necessarily believe that shorting crude oil is the play. But what I think are the plays are going to be in the event that crude really starts to break lower. And let me pull up the chart really quick. Let me see how I can do that again. I'm going to take you over to a live crude chart. Let me see if you guys can see it. Once you can see it, once I see that you can see it, yes, you'll be able to see it right now. So crude, and this is just a current live chart of crude. Now, when I say that we broke out of a triangle, and that would be as of Friday, we broke out of there, could not get a sustained rally, out of this, descending trend line. We actually closed near our lows of the session, and despite the, coordinated attacks from the U.S. and U.K. and Yemen, I thought we'd probably rally a little bit further. We got to the 618 and we slid right back to the breakout point. So again, it's all of these risks. How come crude oil isn't trading higher? Theoretically, coming out of this trend line, we should trade higher, especially against the backdrop of all this support, but we haven't. All right, then I started thinking, okay, well, what if we break, and this support zone, by the way, I've had it drawn in crude for I don't know how long. I've had it on here for, it seems like literally years. You start dropping below, you see this red trend line here, which comes in, let's say roughly around $66, $67. That's when I, instead of shifting to, okay, I'm gonna short crude oil, that's not gonna be what I'm gonna do. But if crude starts to break down, I'm gonna look at different opportunities. So one of those opportunities, well, those opportunities would be, and let me go ahead and pull this out for you, would be the US dollar Norwegian krona and the US dollar Canadian. Those are going to be my, whoops, let me go back here. There we go. Those are going to be, if crude fails and crude starts to fall, instead of shorting crude oil, I want to play the US dollar Norwegian krona and the US dollar Canadian. Now, let me just show you a couple correlated charts between crude and the dollar CAD and the US dollar Norwegian krona. I think most of you probably know these charts pretty well, but I want to point out something specifically. All right, what we saw back in, and you guys probably remember, I actually have a screenshot of when crude oil went negative on my Bloomberg terminal that I have it saved in my, I should actually bring it up. I didn't think about bringing it up today, but I have a screenshot of when crude was trading negative, because I'm like, that was probably one of the most amazing things that I've ever seen. And so you realize that when crude actually rallied from, that negative print that we got, if you can extend this line, this is a line chart, so the line would have been into the negative territory. We saw a dramatic rally in crude oil. Now, what was really interesting is you saw a bit of a pullback in the dollar Canadian. You can see that during the same period, but then the dollar Canadian had found its footing. That has to do with more monetary policy, with the expectations of the Fed looking to raise rates more aggressively than other central banks. And you remember, you have to go back into 2022, early 2023, when the Fed was raising rates, and the rest of the world was just kind of being left behind as the Fed was more aggressive. And so that's what supported the dollar CAD. Well, what you also notice is, like, the US dollar Norwegian krona, very similar situation, right? When we had a rally in crude, the US dollar Norwegian krona, slipped around the same time. But what you're going to also notice is when crude fell to negative, and right after we got the lockdown in the COVID lockdown, the US dollar Norwegian krona spiked higher, above 1150 towards 12. I think it actually printed 12, if I'm not mistaken. And as crude oil rallied back, I think a lot of traders expected, and I know there's other influences, like what the Norges central bank has been doing with their currency. However, I think a lot of us take a step back and we look at the US dollar Norwegian krona and say it should be a lot lower, but it isn't. And that's important, because price doesn't lie. It doesn't. You can have ideas of what you think is going to happen in the markets, but the price is the price. And so right now in the current market, if you're looking at crude oil and you're like, well, you know, crude oil is at where it's at right now. Why isn't the US dollar Norwegian krona trading a lot lower? And I think everybody globally is like kind of scratching their head. So what happens if crude breaks down? Well, if crude breaks down, theoretically, the US dollar Norwegian krona should head higher. So again, I don't necessarily want to be shorting crude because I don't believe in shorting crude oil. I believe it's you know, it's an asset that is even though we're you know going into energy independence and where everybody's trying to move away from fossil fuels, doesn't matter, you know, for probably the rest of my time in the markets while I'm alive, you know, you're going to have OPEC and you're going to have producers that will cut back on production to keep prices at certain levels. So, you know, even though production will, you know, I would say completely will dry up over time, prices, that doesn't mean prices are going to go to zero necessarily. But if prices do come down from current levels because we're in a recession, then the US dollar Norwegian krona, especially in a slowdown, is exactly the currency pair that I want to be playing. So with that being said, you know, prices should be higher and they could go higher for many, many reasons, but a recession would be bearish for crude. But those plays, you know, especially if crude breaks below 66, I think, you know, the US dollar Norwegian krona long is the play, or the US dollar Canadian. I didn't throw that in there, but, you know, obviously I made the case of that. And while you're above 66 bucks, I think you have to be playing in a range, and you have to understand that yes, crude could spike higher, but you're probably going to be selling into those spikes. So, Boris, that is how I feel about.
Really interesting perspective. I think some really interesting takeaways in the sense that, you know, we're all itching for crude to be a play, but I think your perspective, which is basically that it's a range play, and that we should all get hyped up, you know. So basically 80 to 66, it's a range play, or let's say, I don't know, 77 to 66 is probably a range play, and we should just simply cool our jets and trade the range, which is
exactly. I look at, I think you can still see my charts here. You know, I think crude's a play between, you know, the 70 and $80 level, and if it gets much above 80, you got to be looking to fade it. So
exactly. Now, if I could just trouble you to maybe take people to Forex Analytics just to show them your website. I want you guys to understand that same thing as with Nick's Edgefinder. This is a monster trade idea generator. It is an incredibly powerful web portal that has, as you can see, huge amounts of trade ideas, but also lots and lots of, you got live squawk over there, lots of fundamental data, lots of news data. There's just so much richness, the calendar, everything inside of this, you know, one-click structure. And those of you who are Ellioticians, you know, I will, you know, reserve my comments for that. But my favorite joke. What's Elliotician's favorite instrument?
What's that?
What's the favorite tool of Elliotician? An eraser.
well, here's the thing, though. You know, and thank you for the nice comments about Forex Analytics. But this is where I go to confirm, you know, my analysis, because look, I urge our team, and we, you know, we have a very rich team of analysts with us. If you don't know who our team is, you can scroll through and read all of our analysts that are on the Forex Analytics team. But when I go to, you know, have a conclusion about, you know, what's happening in crude oil, or what's happening in, you know, crude, for example, you know, I might take a look at, you know, a monthly harmonic pattern and say, well, you know, what does the harmonic analysis, you know, tell me about what is happening in crude oil? And then I can go, you know, take a look at, I'll take a look at Elliott wave, you know, counts, and I'll say, okay, well, on Elliott wave counts, you know, where is crude gonna, where's the long-term trend gonna be for crude? And you can do that inside of Forex Analytics when you know, we have 30 different instruments, whether you're looking at crude, you know, you want to look at gold. And,
notice, by the way, guys, notice that you guys, as you're watching this, he's literally, it's a single click thing. You can't imagine, like, just this one chart to create this manually would take you half an hour at minimum. You know, it's like the fact that he's able to just do a single click snapshot look at all these instruments with all these incredibly complicated analytical tools. Really, really valuable.
And we, we have a mobile app, so you can download the mobile app and have all this at your fingertips. But where the core of the Forex Analytics product is really in our chat rooms. Because if you want to spend all day with me, which this is where I'm at. So I'm in, the general chat rooms, and you can see like our staff, like K-Man, and
Right.
his charts and what he's looking at, and he traded on in Tokyo at the bank desk for 40 years, so
Yeah.
and then
One of the things that I think you guys don't understand is that the staff that Blake has is all ex-dealers or traders. I mean, these are guys who literally were on the inside. They truly understand how these instruments trade. It's really valuable to get their information. My point being is you're getting it for free. I can't tell you how much I want to thank Blake for doing this, that he's essentially giving this to you on a silver platter so you can truly understand and enjoy it. I mean, if I was starting out trading right now and I had this as my fingertips, that'd be a tremendous boost, a huge mentorship boost for me as a trader. So take advantage of it. Go open an account with ACAP and get this along with everything else, Robbie and Ashraf and Nick, and even yours truly, if you want to degenerate trade with me on a scalp basis. But this is really, really great stuff. And if you're trading Forex, this is a professional level analytical tool that you guys should all really enjoy. So
yeah, make sure you download the mobile app, immerse yourself in our community. Our community is really it's a independent community that we've created ourselves. We don't use any other we have our own technology, and so our community, we really just talk about what's happening in the markets. You have different chat rooms, and we don't talk about politics, we don't talk about religion, and sometimes we talk about like what's the best Netflix show if the market's not moving on a holiday, like Martin Luther King holiday on Monday. So other than that, I mean, it's
what
really
is the best Netflix show? What is your best Netflix show right now?
I don't know. That's a good question.
Right now. I've run out of shows to watch. This.
I'll come up with some good ones for you there, Boris. But anyway, I want to thank you for having me here and taking my views on gold and crude oil, because look, I think both of those assets, you don't want to be on the short side, and gold is one of those. I think you have to own it and you have to have it in your portfolio. But it's like, from a trading perspective, chasing highs, it shows that it's been very dangerous, and it has been for the last 2 years. And I think that may continue to stick unless something crazy happens, which could start off as early as this weekend with the Taiwan elections.
Right, could be really interesting. And the takeaway from Blake's presentation, by the way, aside from everything else, is this one throwaway line that he said, which is price doesn't lie. And I think if you want to see what price is doing, this is the tool you want to have at your fingertips. So everybody enjoy. My pleasure to have arranged for Blake to give this to you. Blake, thank you so much. Tomo arigato. For being a trooper. He got up at 7 o'clock his time. We're going to let him go so he can go play golf or whatever it is that you do
I'll make my week ahead video, but thank you very much.
Sunny Arizona. Great. Thank you so much. And look who's there. Hello. There's Damien. Hi, Damien. Oh, Damien is leaving us. Are you going to play golf, Damien? Peace out, man. How are you? Good to see you. This is Linda Raschke and Damien, who is her husband, but also trades, is an ex-trader from the Chicago. Did Damien trade on Chicago Board of Trade or on the CME? So we got to get Linda's. Oh, Linda, we got to get your audio up. Okay. Oh, there we go. Hi. I was gonna say, which floor did Damien trade on? Was it CME or?
His name is Damon, and it was he was a broker in the S&P pit, and he also traded before that in I don't know, cattle, currencies,
Right. But he's all-time pit guy, so that it's great to see him. Hi. We are very, very, very happy to have none other than the queen of all traders, is what I would call her, Miss Linda Raschke, who has been around. You know what I was going to say, Linda, that I think is really interesting? Everything old becomes new again. Like you and I, probably the only people who've seen the markets from the 80s and 70s, right? And I kind of feel like in so many ways the markets are repeating themselves, on this grand big cycle of lots of different dispersion, lots of different volatility. And I feel like the 70s, even in fashion, the 70s are coming back. I kind of feel like, in some ways, the 70s markets are coming back. I wonder if you think that.
You don't want the 70s markets. I mean,
no, I know you. No, I'm saying
zero volatility and trading opportunities.
Exactly. You don't want them. The point is we don't want them, but maybe maybe we're going to get them. I mean, that's my point. Is that it'd be interesting to see. Anyways. I invited Linda, of course, to just sort of share her experiences, and just to give you guys an idea. Last time Linda was here, she was very, very kind. She took me through a lot of her framework of how she looks at the markets on a day-to-day basis. And I just told this to her. I pretty much stole all her ideas and created my own trading room out of all those ideas. And it's been awesome. It's been awesome. I open up my minds to so many different things about how markets really trade. That's why, as I said, she's probably forgotten more than any of us have ever known about how to trade. But what I wanted to, I invited her on the show today, obviously, to share all her knowledge and, share any of her ideas and her views on the markets, but also to basically talk about how, we're one thing, whether it's the 70s or not, I think the one thing is really true. We are shifting regimes from this nice, quiet, everybody has zero interest rates and we're moving at a slow, steady pace trading to probably a much more volatile market regime, because just the fact that interest rates themselves we don't know which way they're going to go. They're going to create more volatility. In FX, in equities, in gold, all of those markets are certainly going to have more volatility. And that requires a very distinct set of skills, which she is certainly very, very well suited to talk about, and that's what I wanted to have her talk. So I'm going to get off the screen because I want to give you all the time you need, and let you just guide them through. And then I'll, guys, pump me questions, and then we'll talk to Linda afterwards with all the questions you guys may have.
Hi, gang. I got to say, first of all, it's a real honor to be able to speaking to people all around the world, because Boris told me that some of you are in Asia, Australia, all over the place. And so kudos to those of you who have stayed up to actually see this, or perhaps there's a recording that you can watch afterwards.
Yeah. Actually, they're also here. Listen, I forgot one thing. I'm sorry. I need to give you the screen control. So let me make you a present. Let me make sure that you get the screen control, and then you have. And then we just want to make sure. I gave you the screen. Let me just see if your screen is coming in. We'll just give it a second. Did you get my share?
Oh, it says show my screen. Duh.
Yeah.
Okay.
But now we got it. Yep. Okay, awesome. Now we see your screen, and now I will let you run the show.
I'm curious, with the software, can you actually see a mouse if I have a mouse here?
Yeah.
Okay.
Other presenters have their mouse, and you can move you can see your mouse moving. Yeah.
All right.
What we see right now, just to let you know, is your PowerPoint overlaid behind your charts. So your PowerPoint is the first window that we see. It says copyright notices.
Oh, you're not supposed to see that screen. Hold on.
Okay.
You're supposed to see my main screen, darn it.
Okay.
Let me go back. And I want to share my screen on a different monitor.
Okay. Now what I see is your charts.
Yeah, I don't want to show that monitor. Can I change monitors?
Yeah, you could. There's a drop-down menu that says change monitors. Like when you say, show my screen, there's a drop-down menu.
Yeah, hold on one sec. Hey, Damon.
Okay.
Yeah. I just want to get it so it shows this screen. Is the drop-down menu on your GoToWebinar thing?
Yeah, it's where it says show my screen, right? Like right above. There's
stop. Okay, hold on.
You can stop and you can restart if you want. That's fine. Okay.
Okay.
And
screen of monitor 2.
I'll tell you right now, we're seeing your Skype, just letting you know. Okay. And now we're seeing in Embracing Volatility, lindarashke.net.
You got my main monitor.
Okay. Is that the one you wanted to show?
This one right here, you can see
Yeah.
my mouse here.
Yeah, we see your mouse. We see the words Embracing Volatility 2024.
Perfect. Okay. You'd think after all these years I'd have it down by now, but the problem is the software keeps changing, or there's Zoom, or there's different applications, and so it just a little bit.
I feel
So,
you.
as I
But
was
that's okay.
saying,
We guide you through. Okay, thank you.
honored to speak to all of you. You're welcome to pick my brains. I'll stay here as long as you want. I have been trading since 1980. I started off as a market maker in the options, the equity options, on the floor of the Pacific Exchange and the Philadelphia Exchange, and then I survived the crash of '87, and I graduated towards trading more futures as the options dried up, and eventually in 1992 I became a CTA, and eventually after that started my own hedge fund after being a principal trader for many of them, and then retired in 2014, 15, maybe it was like 2016. I still trade every day, but not as leveraged as I did once upon a time. I am a classic market technician, so despite the fact that I have a degree in economics, it's probably the most worthless degree I could have gotten. I am 100% technical, but of course we're always aware of the macro environment, and I heard quite a lot of talk about interest rates, inflation, et cetera, et cetera. I like the fact that a couple presenters showed the Fred charts. That's a wonderful source of data, FRED, and the problem is you can go through 200 different charts, and the problem with the markets is there's always a case to be made. We can see what we want to see. Statistics, you can torture them and they will lie about anything. So I remain deeply cynical, and I have to trade by the theory that the market is a discounting mechanism, pretty much looking 9 months out and ahead, and everything is priced into the market that I need to know, unless there is event risk, which is the primary thing that we all need to be on guard against with our money management, because there always can be something like a nuclear explosion. That tsunami that hit Japan is overnight event risk that we cannot forecast and we cannot see. So currently right now, in terms of interest rates, I really don't care, because the market has already priced in 6 cuts. Okay, that's already priced into the market and discounted that by first quarter January 2025 they're going to cut. And probably regardless at this point of what inflation does, they had to overcorrect for the boo-boos that they did in the past. They wanted to try and talk the markets down. You have to understand that a lot of what the Fed does is adjust people's expectations, and they very often do that by speaking out of both sides of their mouth, as used to be the case with Bernanke and some previous Fed chairmen. So I just don't go there. It's priced into the market. You can go out and look at the yield curve and look at things that are, the strips and all that. You'll see it's already in the market that they're going to cut 6 cuts, and it's just a matter of, are they going to start this March? Are they going to start in June? That's the only details, but it's already going to happen. And they have to do that just because the cost of financing our debt now, which is all on the short end, is so high. So therefore, they're going to cut rates. They're not going to raise them again. And regardless of inflation gets out of control, and you just have an enormous amount of debt on the books that has to be refinanced, both the Fed, of course, and then the bulk of the corporate debt outstanding comes due in 2025. So I have to subscribe to the fact that there's going to continue to be easy monetary policy. And that, for us traders, is wonderful. We want liquidity, and the Fed is going to do everything it can to ensure that there is liquidity. So that's a great trading environment. Embracing volatility. I wanted to go through some slides and show you data from the past as to like what real volatility looks like. And this past year, 2023, was a very low volatility environment. I look at historical volatility, and the definition of volatility, it's really a standard deviation function that measures the movement in the price. I'm not going to get into statistics or any of the different ways that you can do that, but I also am a heavy quant. I'm a closet quant. So, you know, suffice to say, that's my go-to. My preferred measurement of developing models is with ATR, average true range functions. And I have to, as a trader, quantify as much as possible, or at least in terms of market structure, because it's not that I'm going to come up with mechanical patterns. I mean, the market is just too efficient for that. But it's my only way of eliminating my own biases, because we all have cognitive biases, and that's the biggest trap that we can have as a trader. Once again, I'm a trader. I'm not an investor. I trade all the futures markets. I stopped trading stocks strictly because it was a distraction for me, and I found that I just got my most bang for the buck in terms of leverage and liquidity and ease of getting in and out with futures. So that is my game, but a lot of what I say is really pertinent to all the markets out there. I'm a big student of price action. I just wanted to start off with a fun little chart here, because everybody's talking about opportunities and crazy moves and big losses and so forth. And this was a quote from Richard Dennis in the Market Wizards book. On the sugar market, he says, I made lots of money going short sugar at 60 cents, which was like right up here. He shorted not that spike into it, but as it started to come down. So he made lots of money on the short side, but he made even a much bigger loss trying to go long sugar at 6. Okay, so he went long sugar down here, and I guarantee that the degree of leverage that he was using was 10 times greater down here, because for his position sizing, he uses a function of average true range. So obviously, you're going to use much lower position sizing when you have that extreme volatility. And down here, you're going to put on a much bigger trade only because it's a function of the average true range. So I had to go back and show you this chart. It's not always about getting clocked on the volatility that's going to cause you your biggest drawdowns. It could be something as simple as getting opinionated, particularly from a valuation standpoint of view, as clearly was the case here, because he's thinking buy low, sell high type of thing. We all think of him as the trend follower, which he was in later years, but initially he was a pit trader, and he was as aggressive in catching the turning points of the swings as many professional traders are. So just always be mindful. It's not the volatility that can take us out of our game. In fact, as a trader, I want volatility. The more volatility, the more opportunity there is. And I'm going to gravitate towards the markets which do have the most volatility. And I'll show you some of those. And then, of course, we have to come down with structural models to manage that volatility, to manage entries, trail stops, and hopefully I'll have enough time at the end of this presentation to show you how I do that. Now, this is just a chart that was put together by a friend of mine, and it's simply showing the number of large negative days, and for that matter, large positive days that our traditional bell-shaped curve type of models would forecast, okay? Because that's the world that we operate in. We like to operate in the comfort of bounded statistics where we have an expectation, and just like actuarial tables for insurance companies, we can quantify our risk and so forth. But here you see how many days with a large move in the normal distribution. I just took this 3% to highlight it for you. With a 3% expectation of a move, there were only 246 days that the model would have said it would occur. And this data goes back to 1930. But in real life, we had 627 days that were that extreme move. And even if we went down and looked at the odds of getting a 5% move in the market should be incredibly remote, okay? You see here, it's not even 1% odds with the normal distribution that we would have a 5% move. Yet, in reality, we've had 150 such days, okay? This is again from 1930. So that's that concept that I'm sure all of you have heard referred to as being fat tails. And the arena that I operate in is I play to capture a fat tail. So I'm always positioning myself in order to capture that range expansion, that increase in volatility, and identifying the conditions that precede that on a very short-term basis, because I simply cannot forecast too far out. I've found it really impossible, but I can forecast the next 2 to 3 days with a much higher degree of certainty. So fat tails, we'd all like to think that certain things have low odds of happening, but you know, it doesn't matter if it's looking at weather analysis, hurricanes, trades, etc. So I just wanted to preface that. Now I'm going to show you just a little bit of history with historical volatility, because Boris had mentioned to me that he really wanted to discuss the possibility of increasing volatility going in the future and what that would mean for us as traders or perhaps investors and so forth. So I just put down the definition of historical volatility because that's our way of measuring, agreed upon way of measuring volatility, that we're looking at just the standard deviation value to see how much price deviates from an average price over a given period. And these things can differ with look-back periods, but not significantly. When you start varying the look-back period, you'll just change the degree of amplitude in the swing, but you'll still see the same spike. So I just went back a couple decades and showed you periods where we've had past spikes in volatility above 40. This is a historical volatility, 87, 98, 2002, 2008 with the implosion in the credit markets, 2011, and 2020. And if I were to, you know, apply statistics to this, it's not a fixed cycle, but you see we randomly get an occurrence. You know, it could be every 6 years, it could be every 12 years, but it's not a fixed cycle. So it's very random as to when we see these things. And then I want you to note all these incredible periods that we have had historical volatility staying below 10 and even 20. So I'll show you what that looks like where we are now. I actually meant on that last side to say staying below 20. This is a daily chart of the S&P cash. I always use the cash index for longer look back periods as opposed to making continuation contracts. I just put the standard accepted indicator of historical volatility at the bottom. And you can see here on the far left, a whole entire year with the volatility staying below 20. And we're seeing a very similar case with 2023 last year, that all of this data here, despite this little dipsy doodle here, was actually very low volatility. And then we can also analyze the high volatility periods, which were, of course, a little bit increase in long liquidation and sentiment and so forth. As an aside, not all bear markets have this increase in volatility, and that's what I wanted to caution you against wishing with looking for something similar to the 70s. If we go back in time, I just threw up some other charts to show you very low volatility periods here on the left-hand side, and this was, you know, back in the 90s. And conversely, this is very low volatility environment here in the 70s. Even though there's plenty of trading opportunity, it's not like if you had bought puts and was expecting a huge jump in the implied volatility, that you would have been rewarded. Okay, so just a few more. A lot of times when we do get this increase in volatility, this volatility spike, and this obviously was the COVID situation, they are from unforeseen events, okay? Maybe event risk, overnight type of incident. And here's another period where I tried to normalize it by putting this line at the bottom. This is 10, okay? The historical volatility was 10 all through this first half of 2000 there. And of course, there's plenty of trading opportunities. That's what we want, opportunities. But don't conflate the opportunities with the historical volatility environment per se, and the fact that if the market sells off, you're going to have an increase in volatility. Most of the time, this spike in volatility here was that was it Greece and Italy, the European debt crisis, and the US got its credit thing downgraded. But you see, we immediately popped back up. This, of course, was more significant in the 70s, and this was a bear market that did show this increase in volatility. And this is about the only occurrence on about a 60 years back of data where we actually see this, okay? Most of the time it's event driven. This was our implosion, you know, in the with the derivatives and so forth down there. And this, of course, in retrospect, is our COVID sell-off. And I put up a log scale because it really shows the true picture of the percentage change in price, which is really important, because we would not trade a $6 stock with the same amount of leverage, or I should say a $600 stock with the same amount of leverage that you would trade with a $6 stock. So it normalizes your position sizing and risk exposure. And if we make a log scale, which is just really a percentage change in the prices, this looks pretty normal. This is really well-behaved data, other than one dipsy doodle and another dipsy doodle. So it's on the weekly data, it's been a very steady uptrend with these little dipsy doodles. And, you know, you can go back and look at the underlying reasons why, expansion in the monetary base and so forth. But I do believe that they are not going to go through that quantitative tightening that we just saw in the last year and a half, when they had to undo a little bit of that over exaggeration that all those excess monetary payments to individuals, you know, with Biden taking office. And it was actually initiated by Trump's administration, you know, just floating the money out there because of the paranoia that the economy would come to a screeching halt. There was a lot of uncertainty at that time. And so I think they did what they felt was prudent just to keep the wheels greased. And then, of course, we saw that you know, led to a little bit of extreme overreaction in the other direction, with inflation just built up in that pipeline. So this is where we are now. On the surface of it, pretty normal data. Okay, I want to just mention one thing, because I study history and historical patterns like all good traders should, because I'm trying to train my eye to see what the patterns are in the price charts that lead to the bigger moves. That's my whole game. What are the patterns that precede the larger runs? But with that said, once you start introducing economic variables, you are always going to be comparing apples to oranges. And it's very difficult to say, well, in this decade, we had this inflation environment, this interest rate environment, this global macro overlay. It's just not going to happen. And, you know, we're dealing with markets which are not a closed universe. And I just thought this was a fun bit of statistics to really drive home my point. I love cards. I love bridge. I love all kinds of cards. And with cards, we have a finite system where we can, you know, we know we've got just these number of possible outcomes. But with bridge, which is just played with a deck of cards, there's 635 billion bridge hands possible. And with 4 players, you got 750 trillion possible hands. And that's just with one deck of cards. So I think with chess, I'm not a chess player, but there's 2 players can make their first 4 moves in chess, and there are 288 billion ways that they can make their moves. And the chessboard is a very finite, closed universe. So I'm a huge Wyckoff fan, and he states that the market never behaves the same way as it did in its past. Each price movement is unique. And we can see similarities. And most of the correlation studies that I used to do with Steve Moore in the early 90s, because he had fabulous computing power then, we could come up with correlations based on a lot of data points, and then the correlations would slowly drop off. And if you want to have some fun, you can go to Steve's site, mrci.com, and on the far left side, he has a lot of free information, and you will see his correlation studies where he will show you the top 2 years that the S&Ps and the Dow are correlating with on both a daily basis and a weekly basis. But it doesn't mean that going forward that is going to play out. So I've lost a lot of money on correlations, and you know, like I've said, there's periods where the dollar and gold have been positively correlated for up to 2.5 years, and inversely correlated. And a lot of trading strategies were developed when the yen and the bonds had a very strong correlation, and then that imploded. So these are statistics that I consider to be secondary variables: correlations, commitment of traders, sentiment stuff. I look at all of it because it does add color, but I'm not going to make a trading decision based on it. So always be careful that when we are trading and doing our analysis, it really has to be one data point at a time. And then we update that as we get the next data point. So it's this Bayesian analysis. And it is the #1 way of thinking and process that I don't know of how many of you have heard of Jeff Yass, who was in the Second Market Wizards book before me. And I would consider him to be a 10 times more brilliant trader or market analysis than me. I just have the greatest awe for this individual, and that's what he did to build up Susquehanna, which then sold out to, I'm not even going to get into the chain of things, but suffice to say, he's another unheard of billionaire, just a multi-billionaire that you don't hear of. But that was all his process, just taking one piece of information and updating the models at a time. So I try to pay attention to the people that have made the super big bucks, because I am not a billionaire, and see what they are doing. Just for fun, let's look at some other. Boris told me currencies, gold, crude, and the S&Ps are the main markets that this audience focuses on. Of course, a lot of you trade other vehicles as well. So I tried to focus on gold, currencies, crude, and the S&Ps for your benefit. I put this chart up because here's the gold weekly continuation pattern. And you see the data is very well behaved. I've got the volatility at the bottom, and there was just one interesting spike here. And it was not caused from a sharp downdraft per se, although this was over here. So what's more important is when you have this contraction here, and I'm just going to touch briefly on one or two of the wonderful concepts that auction market theory provides with us, and that is that the market often overshoots to the upside or overshoots to the downside. That's the theory of reflexivity. But with auction market theory, it does talk about how things need to come back into an equilibrium point where all the buyers and the sellers are in balance, and then a move can begin. And sometimes there's a lot of false breakouts and it's a little ratchety start to it, but eventually we get a trend. So you can see right here how dull this gold data is, and you have this big fat equilibrium point here. And at this point in the data, oscillators will tend to be useless. You see the historical volatility has died. It's a wretched environment for a trader. You just don't, it's better just to stand aside, because too often we'll want to force the trade or jump the gun or, you know, get too early and so forth, and it'll be frustrating. But it's important conceptually, okay, to understand that you've formed this equilibrium point. And we see this on data of all time frames, daily data, hourly data, this winding down to an equilibrium point. And it's important. I wanted to contrast this historical volatility here in the gold market weekly chart with the crude market on a weekly chart. And you see the historical volatility is double that of gold. Which would be the better trading market for a short-term trader to make a significant living on? The crude, because you've got better range, better back and forth, better historical volatility overall, and this is just weekly data. So in our market selection, we want to go to the more volatile markets. And again, you can see the crude form this big equilibrium point here, but we do not know when, how, or where this is going to unfold. All we know is that, you know, here is a data point. Something can happen big in either direction. We don't know what's going to be the catalyst for it. But once it does unfold, your best models for capturing it are trend following systems that use channel breakout for entry, okay? And channel breakout is nothing more than, say, taking out the previous swing low or swing high, or making new 40-day lows, or whatever parameters you want to choose. You're better off just setting alert and letting that trigger, and then you can go and get into your normal trading. So just to summarize so far, I'm a classic technician. I love technical analysis, and I trade 100% technical. I'm an opportunistic trader the majority of the time, meaning I'm not a trend follower per se. I can do breakouts, but I'm not going to sit there and hold it for 3 months. It's just not my game. So I'm an opportunistic trader looking for the opportunities that form in the waves and the swings, and I'll show you that, how I take advantage of that. My pivots are 100% swing highs and swing lows, period, on any time frame. And on top of that, then I would just add the opening price for the session that I am trading. And I'll show you how that works, because that is going to determine the trend for the day. So we can be in an uptrending market, but if I gap up and start to trend down basis the US day session, it might be a downtrend for the day, as we saw at the beginning of the year, and be lucrative opportunity. So I really want to be in a position to frame that out, and I'm going to show you how I frame that out. So the swing highs and swing lows and the opening of the session that we are trading. Then with market structure, if I am going to determine that we're in an uptrend or a downtrend or a trading range, which of course, as you all know, varies with the time frame that you are looking at, I'm going to base that market structure strictly on the pattern of the waves. So to summarize Charles Dow's definition of a trend, it's when the market makes higher high and a higher low and then turns up from there. So think about an ABC, and then you take out the top of that ABC, and that will turn the trend back up, be it on a 5-minute time frame or a daily time frame. So that's the way I frame out my structure. I had to laugh that my degree in economics is worthless, but I will impart to you a name, Lynn Alden. You can go onto the internet, Google her. She's got long brown hair down to here, and she puts out a newsletter, very generous newsletter, for free once a month. That's for every 4 weeks. I don't subscribe to her premium service, which is, her portfolio and a little bit more detail on her views. But she has to be the most brilliant economist I've ever followed, and I've been following her for a number of years, just in terms of putting everything in perspective, be it from the need for a digital currency, because, I don't know, 85% of the world doesn't even have a bank account. The need, how we look at inflation right now, how we look at interest rates right now, all these other types of variables. So I'm not going to go into anything macro or fundamental other than just mentioning Lynn Alden's newsletter right here. Fabulous resource. I'm happy to pass her name on. And then lastly, when it comes to all this global macro stuff, when I was on the floor, the number one saying was, money makes the merry go around. So as long as there is liquidity, as long as there is cash on the sidelines, that's one of the things that sentiment does measure, is how much cash is on the sidelines. But we also have a huge amount of money piled up in money market funds, short-term money market funds, just a historic amount, and it's still there. It has not gone into the market yet. So that's going to be a safety brake, because as the Fed lowers interest rates, as is going to be the case, the market's already pricing in 6 cuts, you might start to see some of that money coming out of those money funds as their returns dwindle. And where is that money going to go? So I think there's going to always be a floor underneath the price action for now, barring any event risk, such as a nuclear war. We can't know with the world these days, right? I mean, hopefully these icebergs are going to melt long after I'm dead, but you just can't tell. So there is still plenty of liquidity out there. And yes, the sentiment is a wonderful gauge for short-term overbought, short-term oversold. It's not in and of itself a basis for a trade, because the crowd can be right in the middle, as we all know. Technical analysis. Let's just review the basics here and get back to like my favorite hobby. I always feel like I should be a preacher for the merits of classic technical and analysis. And that's why I like lecturing on it. But Wyckoff, if we just look at his basic summary of his framework: accumulation, distribution, accumulation at the bottom. Ralph Acampura used to say, the longer the base, the higher into space, the broader the top, the bigger the drop. That's simply accumulation and distribution, where price stopped going up. And then the cycles of markup and markdown. One of the things that has changed in the past 20 years, 30 years, and last 10 years is something that Perry Kaufman talks about quite a bit, and that is market efficiency. And we're going to continue to see this extreme divergence between market efficiency and market noise. So as the time has gone by here in the last decade, 2 decades, the markets have become much more efficient on this markup and markdown cycle. So when the horse leaves the barn, you can't wait for that pullback to get on board. It's just a steady grind until about 80% of the move is over. Then you'll get your retracement trade and retest back up. So that's one thing. On the flip side of the coin, when you are in these congestion zones or this trading range style, the amount of noise has also greatly increased. So for example, if I was using a 2.5 average true range volatility stop on some of my strategies, which are just generic models, it really needs to be 3 average true ranges now. And this was one thing that the trend followers had to resolve 10 years ago when their performance completely fell out of bed, is that these broad trading ranges were brutal for stopping them out. And of course, they trade 100% systematically. So Perry's thesis is that as more market participants have entered the arena, we have a global environment, you have retail traders, you have institutions, you have mega hedge funds. Now we have the algorithms that are driven by some type of AI model. And it just creates a lot more noise, short-term up and down and blips and so forth. And that is brutal for a trader that did not get a good night's sleep, you know, and I'm sure many of you traders have experienced a day like that where you zig when you should zag, and then you zag when you should zig, and you know, it's just not fun. But you have to understand when you are starting to enter that congestion zone or that balancing act, which is simply looking at when we start to get price bar overlap again on a daily chart after doing this one time framing or steady trend up. Volume analysis, this is Wyckoff confirms the trends increasing and decreasing demand. Honestly, I don't do anything with volume other than looking at if there's an increase in volume on the NYSE the first 30 minutes of my trading session, only because that is a proxy for if the institutions are around or not. I've found that for my purposes, volume is 95% correlated with the actual range in the bar. So simply understanding the power of that increased range in the bar, 10 to 1, you'll have an increase in volume as well. One of the very few patterns that is much more difficult for these algos now that are very pervasive, and they're just programmed to see what we would see anyway, but it's very difficult for them to capture these false breakouts, these springs and upthrusts. So that can be an area that you can focus on or specialize on if you're interested in the short-term trading opportunity or even false breakouts from daily chart formations. I do feel that that's sort of like the last frontier for really aggressive, discretionary, opportunistic trading. And then looking for signs of strength and weakness. And I'm going to show you a few examples of what I look for. That sign of impulse that will help us make trading decisions. If you want to add color, then we can study auction theory. Some people like to use market profile, reflexivity theory. It's not going to help you make a trade per se, but you will understand what's happening. And auction theory is just simply looking at the dynamics between the buyers and the sellers. You know, I don't do anything with the level 2 or the dome or, you know, all those price stuff. It's just, it's beyond my reflexes, I guess you might say. I'll just see it in the charts. And then this is more interesting because this is where it sort of blows the hole in the macro thesis, this theory of reflexivity, which is something that Soros put out there. And it's highlighting how markets' beliefs, participants' beliefs and perceptions also influence market behavior. And that's a little bit about what contributes to a bubble type of environment or a mania type of environment where we completely digress from any macro fundamental stuff. And understanding this concept of these positive feedback loops and self-fulfilling prophecies, more often than not, they either leave a vacuum on the other side or they'll wind back down to an equilibrium price and then fall back down. But it's something that I don't hear talked about that much. So I'll show you an example in just a minute. this thing, all I have on this slide here is that basically the market is moving between these two states, the balance and the imbalance. I look at that on a 2 to 5 day type of time frame, but you can see that principle at work on all time frames, and that's really important, guys, for determining your trading tactic. So if I'm one that likes to trade momentum and pullbacks in momentum, I need to be extremely careful that I'm not looking for a 5-minute bull flag when we're still in a trading range or a balancing mode, because that is where the market does this test, reject, spike type of action, almost like we had in crude at the end of last week. You know, it looks like it's going to break out and get something going. It's a test of a previous swing high, and I think it didn't stay above that level for very long before it dropped back into the range. So that's just something to be aware of. If you want to have some fun, you can just look at Soros's book, The Alchemy of Finance. He did not come up with reflexivity theory in and of himself, but he did apply it to the markets. And it's an important concept in system dynamics and these types of things. But it was just how prices can influence the fundamentals. Prices can change expectations, and those expectations then influence price. And it just is this self-reinforcing pattern. So I don't want to spend too much time on this, other than the fact that price can overshoot to the upside and overshoot to the downside. Therefore, we're always going to use price structure to frame out our trades, to frame out our entries, and frame out our risk management, regardless of what our opinions or bias is on that market. Okay. I'm getting back to these charts here pretty quickly here. Cause and effect, asset bubbles. I'm not going to really say anything more, but I do feel it's just an important bit of color, because my talks otherwise are going to be very high and dry just with basic swing trading patterns. So just to show you an example of the positive feedback loop, and mind you, this is on weekly data. This is on silver weekly data. This right here is a positive feedback loop that just led to the steady grind up until, as the old saying goes, there was nobody left to buy. And that's where it created a vacuum to the downside. I'm not sure we're at that type of hysteria in our current market environment, but you know, things can go to hysterical extremes that none of us have experienced. And it doesn't take much. The wheat chart obviously was due to the Ukraine, Russia conflict, but you can see how quickly that came right back down. But yet, on the other hand, same thing with these other markets like nat gas and so forth. You will find that the majority of the traders will sit there and try to buy all the way down, because they were so biased by this powerful impact of these events. And it is probably one of the biggest traps when they're like, price is getting bonked down, it's a buying opportunity, look how cheap it is now. And look what happened with natural gas. If you trade that, you'll know it had to base out for an incredibly long time after this vicious evil V spike. And so that's why I say, regardless of the macros, you have to frame it off by our systems. Is it lower lows, lower highs? Is it downside breakout, et cetera, et cetera? This was fun. I just put one chart up there for fun. I heard some other people talking about charts. And here's the interesting thing that I have learned about the markets. I cannot see what's going to unfold. I could have not forecasted that Zoom would go from 550 down to like 70 within literally a year and a half. And there was probably 200 other stocks with this exact same pattern there. We just can't see or forecast that. Yes, this was probably driven up way further past what perhaps value, if anybody can determine what that is, might have been. But anyway, I want to move on and just show how I look at structure, and I'm going to show some longer term trade opportunities, as well as my main style, which is very short term, meaning 1 to 3 days, that type of framework. And what we find is when we do our back testing or modeling, the higher the time frame that you're on, the fewer the frequency of occurrences are. So if I'm going to model what pullbacks or retracements on monthly charts look like, or a trend reversal on a monthly chart, I might get 1 occurrence every decade. And here you see my charts have this red, green, red paint bar. That's simply an average true range function. Wells Wilder put this out in the late 1970s. It's a volatility stop and reverse. It's the same algorithm that makes this zigzag here on the chart. Only I made the bars change color as well, because for me, it really helps me to see those swing highs and swing lows by which I determine structure. So here on the monthly charts, we have a solid uptrend. The monthlies were in an uptrend despite all of that horrible 2022 year. It was just a correction in an uptrend on that higher time frame, regardless if they're saying interest rates increase was the driver. So what? The technicals were here. And something sort of interesting is when we're looking at this higher time frame for opportunities, very often the lower time frame might appear to be in a downtrend, or conversely an uptrend if we're looking to short. So back to that definition of what defines a trend. Obviously on the monthly chart, we have higher highs and higher lows basis these little swing lows. And even though this blip down here from the COVID was a lower low, it was a higher high and a lower low. You would have needed to put in a lower high and then turn down in order to turn that monthly trend down. On the weekly charts, it was very interesting because we came down in this ABC type of pattern, but it wasn't finished yet. When it actually took out this low here, my computer was like, caution, it could be a downtrend. And I'm sure a lot of technicians had that flagged, but yet that would have had to imply a V top on the monthlies, which is really rare for the indices. We often see V bottoms in the markets, but we rarely see V tops. So this was just a complex little wave. If you're into Elliott wave analysis or all that kind of stuff, I'm sure it made perfect sense. But that was really what was going on here. And then we can go down and look at this pullback on the weekly charts that we had after we had come out of all this basing work here. And we can play this game ad nauseum. So you see here on the weekly pullback, which now it had that upswing greater than the previous upswing, greater than the previous downswing. My models tell me you got an 85% probability trade here. Now we start to stalk it, okay? And you can see how that played out. You got your ABC down, and then just that one last little bit that laid a proverbial bear trap. Sometimes it does that, sometimes it doesn't, but you had to, frame it out to get long at some point. And so here we are today. This was what I was talking about. Once the market tips its hand, now you've got the power of those weeklies behind you. And on the daily chart, we see a most efficient trend to the upside until we get all the way up here, and then you finally got your pullback on the daily data. enough of a pullback at least to give me what I call my red zone loading only in terms of sophisticated technical analysis. And now let's just go down on that daily chart. And here we have our pullback. And then how did that play out on the hourly charts? So this is just showing you a process, how important it is to put things in context. Now I don't really have any trade other than at least where you have a nice finite risk level, unless you go down to pullbacks on hourly charts, which we already did, or waiting for another pattern to set up in the swings. And as far as I know, you're in an uptrend on all these time frames. I don't know how high we can go. Obviously, there's that all-time high that still needs to be touched, and the NAS is well above it. So we just have to see, but it's always being aware of this structure. Just for fun, I wanted to show you, I do this on all markets. This was probably, I thought, my best coup of the last couple years. And I put this out on Twitter at the time as well, because I had been looking at this long monthly base in the peso. And if you go back and you can see where the peso was a decade prior, you had much higher prices. So you had this long monthly base. I don't know about you, but have any of you guys ever tried to trade on a monthly chart? You might as well go hit your head against a cinder block wall a couple times. For that matter, same thing with the weekly charts. But we have to be aware of the market structure. And what we're looking for is what Wyckoff would call that change in character, or that impulse type of trade where something is happening. There's a change in the dynamics. And here, clearly, we started taking out the upside swing highs and channeling up. You did have one little flush down on the weeklies, which is nothing to sneer at if you are long and caught with your pants down. What I usually do is I'll trail stops on a 240-minute chart, and if I'm stopped out, then I can always get back in, and I'll show you exactly what that looks like. So that was the peso. And then if we look at that last weekly pullback that we had last year, choice opportunity. Keep in mind, we just broke out of that huge base. This is the detail of, of what it looked like on the daily charts, pulling back down into that pullback on the weeklies. And you'll see sometimes on those lower time frames, in this case, the daily chart, a lower time frame, it looks a little bit dicey and a little bit, wow, downside momentum. Oh my God, look at this big top that we just put in here on the peso. But if you look at the weekly charts, it just puts it all in perspective. Now, you do not have to buy in here on the way down. You don't have to even buy here. You just want to know that you've got the wind behind your back. That's what I look for. I'm not trying to bottom fish as it's coming down. I want to see that it did its test in development. And then if I just choose to trade on a short-term basis, that's fine. I want to just go and look at a few other markets here because I talked about the structure on those. It's a little bit tricky to find good structure right here on something that is just beginning to move. The nat gas had some really good structure. I think the grains is another area that I'm watching because we just had the crop report on Friday, and very often, we tend to make a swing low on those crop reports. The beans and the corn have been in downtrends, and so I'll be aware of this type of data, but then I'm going to start focusing on the price, and I'm going to show you what I look at for triggering long entry as opposed to just trying to, buy into weakness in a downtrend. I'll usually buy into weakness in a strong uptrend because it could just be a long liquidation flush, right? And I'm sure all of us have been caught in one of those before, a long liquidation flush. Right now with the gold, I just put up a monthly chart and a weekly chart. And you can see this red zone loading only on the monthlies here, which also just happened to be that perfect little Wyckoff type of scenario. Look below that previous swing low, trap any shorts or shake out any longs, and then come back up above it. Typically, when we are going to have a trap like that, you want to see it unfold in just 2 or 3 bars, whichever time frame you are on. This little bit of weekly data here, you can see it's just putting it into a bigger picture. But truly, I have a trading range here on this weekly data because I've got support at the bottom and resistance at the top, 2 data points and 2 data points. It's okay if we look below, and it's okay if we look above and then come back in. So this is a 3-year trading range in my analysis in gold. And for the people that tried to position this market too soon, and 90% of the people I do believe were trying to position to the long side, because I rarely hear of anybody talking about the case why gold would have been selling down in these environments. I had my own little theory that Russia was sneakily trying to sell some gold on, they were forbidden from selling it on the open market, but there's lots of circuitous ways that they can dump gold because they were in dire needs of cash. So I think that was going on for a period there, but there's a lot, there's interest rate variables. There's too many things for me to really know. All I know is that this is a big old trading range. Now, let's go down and see where we are now. We're going to look at the daily data. And what do we have? We have a perfect equilibrium point on the daily data. You see? So at this point, I can't really say that I'm a bull or I'm a bear by strict technicals. I can only say that I have a perfect equilibrium point forming. And if this does start to trend, it's probably going to go further than people think, as that's usually the case. If you wanted to really project, which I don't like to do, take the width of the trading range and double it, and that's where you could get possible targets. But that works sometimes and it doesn't work other times. But those are really the only tools that we have for projecting price. And they're marginal tools. So we have an equilibrium point. This was a really nice trap below that swing low where the last upswing was greater than the previous downswing and the previous upswing. So criteria number 1, this was 100% trade. I should say 95% trade because nobody does 100% trades, but it was 90% look for long opportunity. And then you had almost equal swings to the upside. By the way, I don't really believe in equal swings, and I don't really believe in Fibonacci retracements and stuff, but sometimes it does happen, I think it was Paul Tudor Jones or somebody said, throw enough lines all over your chart and the price is bound to hit one of them. Somebody said that at one point. So it's true. You throw enough lines and pivots and retracements all over your chart and lordy, price is going to hit one of them. So now we've got this, we had another pullback and now we're just triangulating. That's all I see with gold. That means that we have 2 choices for trading it. If you do have a bent that you are leaning towards, you can go down to short time frames and look for entries on those time frames, and then just see if you can, if it does catch fire, then once it does, is all the time in the world to add or retrace it. I wanted to show the flip side of the coin. This is the copper market, and the reason being people confuse metals and metals and metals. Palladium was in a horrible downtrend. Platinum was in a horrible downtrend. Copper, not too perky here. But this is why it keeps us out of trouble. With copper, no matter how bullish you were, this chart was still in a downtrend, making lower highs, lower lows, channeling. And I put this up because I have a friend on Skype who was insisting that a bottom was in copper on Friday. And I captured this and I said to him, I'm not going to say names, I said, hey, you know, this is not a bottom, it's just a 4-point triangle, if you will, 1, 2, 3, 4. And in general, 4-point triangles or chart formations tend to resolve in the direction of the trend. This is just basic technical analysis. Whereas a 5-point triangle, which would be analogous to a wedge, is more indicative of a trend reversal. See, these are just all these little gems. You know, you want to look for nice trend reversals, look for little wedges where you have 5 data points that you can make, and you'll see a contraction in the volatility. Now, if I take this chart and I told you where copper actually closed on Friday, and I did not trade it, I'm always honest about that. It closed down, I think it was like at 373. So it did this ginormous flush to the downside, but this was the structure leading up to it. Oh, I put it right there, 373.50, and this was around 377.50. So 4 handles in copper. That was a nice chunk of change. Could have made a down payment on a car. Okay. I heard a bunch of people talking about the yen, so I thought, well, let me pull up some yen charts just for shits and giggles, and we'll look at that and see the structure there, what's going on there right now. As an aside, I started trading the currency futures listed on the CME, and this was back, they were listed there in the late 70s, okay? So at that time, most of us in the US could only trade the currencies on the listed on the exchange, the listed currencies. I do have Forex, you know, data and stuff. I have not found any difference. There's not going to be any difference in the charts, whether you're looking at a CME contract or the, you know, raw Forex data. One of the differences, just the way that the you know, you have to buy on bid, sell on offer type of thing with the Forex market. You can also do denominations that are in smaller pieces, which may be very helpful. You don't have to pony up for a big futures contract if you don't want to, because sometimes the margins can increase if there's too much volatility. But I had to say that because you'll see all my charts might be inverse to what you are used to looking at. And this is just, you know, the data. As a funny aside, my first husband, he used to say that if you turn a chart on its side, you know, and then see what you see, it just gives a different way of looking at it. I'm not sure how I would turn this on its side, but, you know, you can flip it upside down with this CQG software. If I put a 1 in front of the symbol, it will reverse the chart. I probably should have done that for your purposes here. But if you do find yourself with a downside or upside bias, and that's pretty common that most traders either like to trade from the long side or they like to trade from the short side, it's a nifty little trick to invert the chart so that you can see what you want to see, but in the other direction, if that makes sense. I don't know. Okay, long consolidation up here with this massive trend to the downside. And of course, at this point, everybody's pulling out their monthly data and looking how far back to see where that last monthly low was and so forth. And, you know, by the time the market hit down here, had a reaction back up, automatic reaction, pure Wyckoff type stuff, retest back down. Where are we now? We have now defined support, okay? Support, if you wanted to use these 2 data points, they're a bit far away. You could say resistance. So at this point, I have to say we are in a trading range, probably consolidating this massive standard deviation move to the downside. You guys know all these classic technicians are my heroes. And Charles Gann always used to say, price equals time. So the larger the move that we have in terms of a standard deviation move, the more time is needed to consolidate that particular move. And that's probably what this market is doing right here. So it would be premature for me to say I'm bullish or bearish, which I really never say because I might miss some really great short-term opportunity. It just gets in my way and it's irrelevant. It would be more appropriate to say we're in an uptrend on the dailies or a downtrend on the dailies, or we're forming an equilibrium level. And that takes away, whoops, sorry about that. That takes away all this cognitive biases and emotions that tend to be associated and interfere with our trading when you say, I'm a bull or I'm a bear, that kind of thing. So if I can frame it out and say, oh, we're still making lower highs on the weekly charts, but we did find support, it's going to be of more value to me. So let's go down to the dailies now, and you can see I've got 2 data points to the upside here, 2 data points to the downside. That is what it takes to declare a trading range. And we may just fill out some of this range a little bit more. This is sort of an ambiguous swing right here on the daily charts. I mean, obviously you can look at, we had a big push up, and this so far has been a partial retracement down, a halfway retracement, something like that. It is in the context of a large trading range. So we don't want to go projecting too far out once you're in these larger trading ranges. And at this point, it's sort of balanced, and we'll go down and look one more. Okay, so I wanted to show you some detail overlaying on top of all this daily, weekly, monthly structure. How do I actually take advantage of it, unless it's going to be something like that peso where it's just a slam dunk, you know, once every 5-year type of pattern. And so this is the bottom that we had in that yen. If I just go back and look right here, okay, this was 66.48 level, 66, well, it was right in here. This is where the yen started to get interesting. And again, if you're trading the Forex, you just want to inverse all this type of thinking. But this is that Bayesian process, taking it one data point at a time. And then I free myself of having to make the right call or something. What happened here is there was this 3-bar balance period at the bottom. I didn't even bother looking at the yen for the previous 2-3 months because the average daily range was so low. There wasn't opportunity. Remember, I want to go where there's opportunity. And it was just a dead market at that time until, of course, it's not, right? And it came to life. And this is a 2-period rate of change, which I'm sure many of you have seen some of the numerous videos on YouTube that I've put out there for free of past presentations. And I just like the 2-period rate of change because it has a better frequency or signal to noise ratio than a 1-period rate of change. And it's the only derivative of price, meaning it's not price itself, that has any modicum of an edge, even though it's pretty small. So usually with my models, I'm using average true range functions and retracements, but this is the only momentum indicator that I can have confidence in that it's going to provide a slight leading function. So these 2 dots, just in case you're wondering, I also have a 310 oscillator, which is the daily 3-period minus the 10-period simple moving average. You could just as easily use a stochastic with say, for example, a 12 fast and a 16 slow, or a 9 fast and a 16 slow. I mean, make it to please your eyes. It doesn't really matter. But we did see an increase in the momentum greater than the previous 30 days. So something is happening. There's a change in character here. Buyers are stepping in for the first time in a while in a significant level, and I would bet there'd be an increase in volume at those points as well. So this is change in character right here. And this slow line on my 310 oscillator is pretty similar to the slope of this 20-period moving average. So here's my game. I get this pullback in the rate of change, a little pattern recognition, 1 or 2 days high to low, and it's poised to flip up. So I've got a buy day, and I like using George Douglas Taylor's approach, the Taylor trading technique, to capture that buy day. But I'll show you another trick before I'm through. So I have to say to myself, the market's been down 2 to 3 days, high to low. It's turning up low to high. If I bought on the close of that first low to high day, there's odds of upside follow through because now it's in play. And it might just be a test above that high, or it might give you 2 or 3 days. Depends on the overall structure. So I've got a buying opportunity. I've got another buying opportunity where this pulls back 1, 2. Here you've got your 3-bar consolidation. I've still got that positive slope in the momentum. Another buying opportunity down 1, 2, and upslope in the momentum. Still yet another one and one more until this short-term loss of momentum right here on that 2-period rate of change says, okay, better take a break from buying the dips. This has been a good run up. They're again showing a loss of momentum. Of course, we break to the downside, and this was also a 3-bar balance period where the high of this bar was below that 2-day high and the low was above the 2-day low. So on my morning trade sheet, I have breakout mode. I'm not looking for the directional play. I'm in terms of I'm a buyer or I'm a seller. I have to say to myself, it's breakout mode. I have to be in that go with, follow the price movement now. And you actually got a downside push, and then you see the game to this side. We've got that downslope in the momentum, a nice little short sale opportunity. But now we are at Neutralville because we've got that